Good morning, everyone. Good morning, everyone, and welcome. Can I ask a favor? Can everyone just move in a bit? There's just a few people already standing. If you can just move in just so that can make some way for some seats for some people to come in, that would be great. Thank you. And if we can ask to get some more chairs brought in, that would be great as well. Maybe another sort of 20 more chairs. All right, welcome everyone to Private Capital 2025. I'm going to give you a bit of a debrief as to how this event was created and the sort of thematics of it. First thing I'm going to do to kick off is I just want to give a big shout out to the Wholesale Investor team. Said people have no idea what we've pulled off in the last month, which is pretty much almost a miracle from an effort perspective. But to give you some idea, in the last month, this time last month, we were hosting Emergence in London, where we had 380 people turn up to our conference in London. Then a week after that, we were hosting Emergence Dubai, which was the first time ever that we've gone to Dubai and was just an unbelievable success. We initially were expecting 125 people. We ended up with 250 people, and they were all European fund managers, UK fund managers, Asian, and also from the Middle East as well. So incredible success, and we're so bullish about opportunities sort of in Dubai for Australian investors and Australian companies. And then obviously, you see today, over the last 2 days, we've hosted a capital raising boot camp over the last 2 days. And just because that wasn't enough doing stuff across 3 different countries, we also had an office move in the middle of it. And everyone knows how much fun office moves are at the same time. So it's been a massive period for us as a company in this last one. And then also hosting today, I think is a really important time to be looking at this space. And I sort of outlined, you'll probably notice that there's 3 key thematics that drive through today's session. And, in this sort of, to give you a bit of an introduction to the journey as to how we sort of got to this thematic, and all you guys have your own investment themes, your own cases for why you're focused on what you're focused on. How we got here was 2 years ago at this event, we had Cameron Blanks from PEP come and talk at the event. And he gave a great introduction to talk about, how much private markets is going to be expanding across the next decade. And he talked about how the private markets is going to be expanding to a $30 trillion opportunity over the next 10 years. And he also highlighted at that same time some of the issues that were taking place with exchanges around the world. And it was interesting to note for me when I did my own sort of research to find out that effectively it's basically in the US, for example, listed companies that are at 53% of what their peak was 20 years ago. Then also to find out sort of through the AFR where they sort of did some research, and effectively the ASX now sits at the same amount of listings as what it had in 2006. And so you can see that around the world, there's this trend to move away from the listed markets with a focus on the private market side. And likewise, if you go and have a look at the upcoming listings on the ASX website, you'll find there just isn't too many there. So private markets then become a dominant theme. Now, for us as a company, most people knew us. If you go back 3 years ago, everyone knew us purely from, the sort of innovation startup side, even though we've been showcasing property and fund managers since 2012. So that was my first introduction. That set a light bulb off inside of me to realize that the innovation market, whilst it's an area I'm super passionate about, and I'll explain the panel session today as well, was really actually quite small in comparison to the true market opportunity that's available to all of us in the private market space. So you would have noticed the messaging from WI over the last 2 years that goes around all those areas, whether it be private credit, funds management, property, and then also now business succession. And how that come about was I basically had a shareholder come on board. His name is Jim Lowry, and his background was sort of from private equity, but he's moved into basically in part of a business called the Valoop Exchange, which you're also going to hear from their ANZ CEO, Giles, today, which many of you may even know in this room. And he really opened up my eyes where he talked about this is going to be the greatest wealth transition, in history. And for me, I thought that the greatest wealth transition was going to be from the baby boomers to their kids. That's where I was sort of thinking about it from. How do I think about my investment thesis, or how do I think about my business case? And so that changed a lot for me. And when I did further research, it was then discovering that this market, there's going to be 400,000 companies in Australia alone that need to go through succession over the next decade. More than that, the value of those companies, it's a $3.5 trillion transition. And it's interesting to note at the same time that innovation had its own sort of challenges, that this has become an area where a lot of the deal makers and a lot of the investors that I was dealing also started to make this a priority for themselves as a focus area. Likewise, at the same time, you notice there's a lot of trends coming out of the US and also in Australia where it's entrepreneurship through acquisition. There's even been groups set up throughout universities where they're focused on acquiring existing businesses and then adding a layer of innovation to it. So this has become quite a substantial opportunity. And then likewise, on the private credit side, to know that effectively there's about 200 billion in funds under management through in private credit, and that's expected to grow over the next few years to between 350 to 400 billion. So that really sets the baseline for the thesis of everything that sort of comes from today's event. And as I said, I got asked last week, what are the value points that investors, get from Wholesale Investor? And I sort of articulated it in three different ways. One, we all know the first part, networking. You guys love a good chat with each other, right? Second one is that we're always trying to provide insights in some direction, but provide access to the people that are in this space, working in it, operating and investing and allocating money so that you can understand their investment thesis and make up your own mind how it relates to your portfolio and how you want to act, etc. And then the last one is the direct access to opportunities. So in the room on the left, you'll obviously notice, so this is the presentation room. All sort of catering and all the companies that are being featured today are going to be in the room next door. So you'll have an opportunity to talk with them, throughout the day. Now, the one part that I didn't mention in that, as far as what I see as the biggest opportunity for the next decade, is the early stage VC area. And for me, that area has always been a minefield, and I've always admired the people who are in it because, often you sort of meet super early companies and, there's just such a, it's just such a different thing when, you're sort of meeting companies really, really early. There was something interesting that I noticed at Emergence was when we did the venture capital panel session. Who came to Emergence, by the way? Okay, perfect. During the venture capital session, I noticed that the fund managers were a little bit lower energy than what normally they would be. And it was also interesting to note last week where the sort of announcement around the Airwallex deal where sort of Blackbird and Airtree went in for the first time into Airwallex in their Series F, which was also interesting. And you just wonder, you think about what are the signals that sit around this? My thesis, I did a meetup at the start of this year, and I had a thesis that I think that for companies that are building businesses now, for the founders that are building businesses that are AI led. Now, I know that word, people feel it's hype. I actually don't think so at all. If you experience it every single day, I think it's just not been articulated enough how much it changes a lot of areas. And yes, there's going to be mistakes along the way. But what's really interesting is everyone talks about sort of AI from how they're putting it in their product. The part that I think is really interesting to talk about is how people are using AI in their business. And I just can't understand how if an investor's going into a company, how they can't be asking the company about what does their tech stack look like internally and what are they using from an efficiency and a productivity perspective, because right now it is still the most unfair advantage for a company to be an AI-led business or a software, and by the way, software and AI in how they actually use it. Because to me, I just use the example of someone lining up for a 100-meter sprint and they've literally got a jetpack on them and they've got the sort of Blade Runner shoes as well. Like you're just giving yourself such an unfair advantage to win in a race of building business. And also, likewise, I've noticed that the amount that startups are raising has dropped significantly. 3 years ago, everyone was looking to raise 5 to 10 million. Now everyone's looking to raise $1 million. People are raising a lot less. And also, what I'm really looking forward to in this sort of early stage VC panel is I would love to understand how they're thinking about that sort of productivity, because most of the founders I've been speaking to, the way they're thinking about things is they're thinking about how, number one, they can, effectively, if they want to increase productivity in their business, their first thought isn't, how can I hire someone? Their first thought is what tools are available? And what's super interesting, if you notice the way in which AI products are being built, they're not being built just as products to solve problems. They're literally being identified as products to take out roles. And that becomes interesting, right? Because it then becomes I think someone made the great statement of, you either basically utilize AI or you get taken over by it. And I think that's whether that's a team member, whether that's a company, it doesn't matter. That's the reality and the way we have to think about it. So today, the three key thematics, that we really wanted to provide around is help understand that business succession area more. And it's something we're going to be talking about a lot. Then also the early stage VC panel section. Obviously, there's a focus on AI. There's a focus on product-led businesses. This, it's being curated in a very specific way because it's some of the observations that I'm seeing. And then likewise, on the alternative part, the other thing that I've really noticed is that for the family offices, there's a lot more active family offices that are providing access to high net worths to get access to some of their deal flow and the opportunities that they're participating in. So for me, part of what we do with doing this is we want to provide access to that and make it simple for you to actually participate. And then also one of the, in the all sort of alternative part as well, is then, and obviously the private credit side, that's been sort of well documented over the last 2 years. The really fortunate thing for us, and you'll see this today, we've got some great companies that are featuring their sort of opportunities today that give you guys access to high yield. They're all been experienced. They've all been doing, the majority have been doing this for 5, 10, 15, 20 years. Guys like Acura are incredibly well known, sort of in their sort of ecosystem and in their world. Guys like Dan, who's going to be one of the first presenters from Pindar, has actually built and sold a business in this space. So you got some incredible people that are operating, and this is their first time actually sort of providing direct access for investors, outside of their existing sort of networks to actually participate. By the way, can we actually get some more chairs brought in as well, Plank? That'd be great. For me, I said, I started this year with my thesis, and of course, it's, by the way, since emergence, it's obviously been a wild time with tariffs and, all the sort of global aspects. I don't really expect that noise to stop too much soon. But effectively, interest rates have come down. There is obviously pressure to try and bring interest rates down more, but it's interesting to see how they sort of go in the US. But the reality is, it's still set up from a foundation perspective where you as the investor or you as a business, whatever hat that you're wearing today, whether it's investor, business builder, advisor, etc., there's an opportunity for that access to high growth on the innovation side where companies can actually can launch and get to profitability so much faster than what they could do previously, and also go to market a lot faster. The access to growth, right, through sort of private equity, business succession, etc. And then likewise, the access to yield. And the other thing I found super interesting, someone's got the party started. So, and then the other thing I found really interesting is by doing all these conferences and running these different panel sessions, there was a comment that Chamath from the All In mentioned about how private credit was starting to eat private equity, right, as far as getting access to opportunities. The part he missed was it's also doing the same to venture capital, because it's interesting now how many different sort of product solutions are coming out that are non-bank lending related that are also providing access to returns in going into, early stage companies. So I think this is such an interesting time for what was the traditional VC model of raise big fund, deploy over 2 years, raise next big fund, deploy over next 2 years, raise next big fund, etc. Because the question is why do companies need so much money in those big funds? And that's what's also interesting. If you notice that a lot of the bigger funds in the US have started to change their approach in how they're actually deploying capital through their funds, and they're basically giving themselves more flexibility in how they actually deploy, so that they can access the early stage opportunities. So today is such a random thing of talking about early stage VC right through to business succession, like businesses that have been around for 20 to 30 years, and then likewise, access to sort of property and yield. But I said, I suppose that's our job, and it's like, how do we make this unique for you so that you can access the type of opportunity that you're looking for at this stage of the game? So that sort of gives you a bit of a summary to how we've thought about the sort of building of this private capital event. and the opportunities that we want to provide you across this day. The day is absolutely jam-packed, and there is going to be one sort of disappointing note. One of my favorite people to have speak is actually Tim Trumper. Unfortunately, he just come back from Japan and currently has no voice. So unfortunately, I've invited him to now sort of speak at our Venture and Capital conference. So unfortunately, he won't be able to do his keynote today on AI. But I tell you, if you haven't checked out his book, go and check out his book. His book is called AI Game On. It will really give you an insight into the way some of the world's biggest companies are thinking about AI. And I know that a lot of people have these concerns. There was a report that came out about how team members are concerned about their jobs and all that sort of stuff. It's rightly so, because this employment aspect is something that I really sort of struggle with my own head in how I sort of think about it, because, you know, if you look it seems like twice a year. I thought it was going to be just the start of every year, but it seems like 2 times every year, all the largest tech companies go through an announcement of layoffs. Now, in Microsoft's last announcement of layoffs, they didn't even bother to announce that they were investing into AI. They just said they're announcing layoffs after announcing record profits. So you can see how internally in these companies, they're just consistently removing layers across middle management. And what's interesting is, one of the theses I have is that you can see that most companies, early stage businesses, and this is why I can't wait to hear what Georgina says from on the panel today, is that this product-led growth strategy that companies are now building, effectively, they're also going for the removal. You know, it's literally, you remember that book, The Death of the Salesman? You can see that this is now being targeted. Like, for the first time ever, you know, this is an area that sort of people are really targeting. So, you know, this is, you know, I'm pretty excited about today, as you can tell. We've got, and I'm going to go through some of the talks. I haven't even clicked on one slide yet. Obviously, we're going to have William Houston. William has come over from the US. He's an incredible guy. He's absolutely going to be bringing energy to the room. He's going to be introducing everyone to quantum mental analysis. Who's heard of quantum mental analysis before? Great. I hadn't either until I heard it from him. It's a really fascinating way in which he looks at how he deploys capital across hotel investments around the world and how they assess opportunities. Right, so William, himself has actually built and sold his own capital business, and now has got a specific focus in the hotel space. I'll turn my notifications off. Steve Baxter, he needs no introduction. If you think about warfare in general, innovation has played a massive role in the outcomes of wars in history. You know, one of my favorite stories was listening about how Leonardo da Vinci basically paid for, you know, what he would do is he would go to kings and he would sell, you know, his capacity to build them warfare, you know, weapons, you know, and then he would use that money to then go and experiment with, you know, doing the first sort of autopsies on humans to understand the human organism. But that's how he did it, is through, you know, basically innovation in warfare. And so he's going to be focused on that as far as what the opportunity sits in defense tech and innovation in defense tech specifically. And then Alan Hunter talking about the energy transition. You know, we've been working with Alan now for 5 years, and we've just watched him build an incredible sort of growth, high growth business. But it's because he's on the forefront of a trend that's taking place with, you know, in the B2C space as it comes to energy. So we'll be listening to him. And then Giles, you know, the majority of you would know Giles, you know, from his, you know, basically experience in debt. He's going to be the one that's talking about what is this opportunity in SME succession and the ability for investors to participate in that funding or be involved in that as an area. To me, that is probably one of the most exciting opportunities in the marketplace at the moment. So Giles is going to be talking about that. I've gone and done a breakdown of all the different sort of panel topics that we're going to be covering today. We've got some incredible panelists and speakers that are involved in all those different sessions, and it's very diverse, right? Especially the alternative investment trends session. I could not get more diverse in how we're approaching that from the different topics. And we've got some great companies that are presenting today as well. So first one I'm just going to give a quick mention to, coming over from WA. Basically got a Cura Asset Manager. They deliver high yields property syndicates with consistent 8+% annual returns. Refield got a great setup. You know, Ryan and his team, if you actually see their setup in the background, these guys count like Google, Facebook, and so forth as their clients. They've started expanding into Singapore already. Incredibly, you know, high energy entrepreneur. They're revolutionizing packaging with scalable, eco-friendly, reusable solutions, reducing plastic waste. What's important is they're doing it at a B2C focus, already, getting close to that sort of 1 million in sort of ARR from a revenue perspective. So he's really kicking goals. As I mentioned, Dan from Pindara Partners is going to be talking about how he's sort of delivering strategic capital, through flexible real estate investments, strong, been there, done that experience, built and sold. Westbridge Fund Management, etc. Industrial properties being one of the sort of highest areas of interest from investors in our ecosystem. They're going to be showing how they're sort of providing investors with access to monthly returns and also capital growth as well. Vest Capital offers access to private credit, real estate backed opportunities and targeting 10%. Also, strong team with the experience in sort of scaling in this area. Enviro Invest, sort of renowned team, with once again that sort of been there, done that experience. They're allocating capital for lasting environmental impact. As I mentioned, William from Bay Street Hospitality is going to be presenting. Matthew, one of my favorite humans, is from Cosmo Innovations. He's going to be delivering award-winning affordable med tech and also consumer health solutions. It's actually a really highly focused beauty product that's got some of the attention of the world's largest sort of beauty manufacturers and distributors. He's also got a product that you can check out today. And then Bankstack. Bankstack's a great example of someone who runs their own family office and own VC fund. They've noticed an opportunity for themselves that basically provides full stack infrastructure to disrupt the legacy infrastructure around payments and also e-commerce globally. So really taking on an important area. So that's they'll be focused on that and also be on the panel session. NovaPep, Jay's an incredibly experienced executive. Once again, specialty in taking companies out of taking IP out of universities, then sort of commercializing. He's developed peptide to treat sepsis and acute conditions with cytoprotective anti-inflammatory effects. I'm sure he'll make it simpler than what I did. New Orphan is targeting multiple sclerosis therapies through protective nerves and promoting repair. This technology actually come out from one of the I just forgot the I think it's out of Monash University in Melbourne. So these guys have secured the IP, created a fantastic team around them of specialists in sort of life science and are now going through the process. Varela delivers high yield projects through in-house expertise and exclusive access. And also they've vertically integrated all aspects of the actual process. Alex Bank, which many of you would know, these guys, what they're building as far as 100% digital retail bank to basically provide a scalable and deliverable offering. Said great team, really experienced guys in this background, obviously kicking some goals already. My Farm Investments, basically providing direct access to farm opportunities in New Zealand with obviously potential for growth and also yield. iMoney providing unique access to a range of sort of exclusive and unique funds in this sort of early stage space. And I'll let Andrew can talk about sort of some of the unique opportunities that they've been able to position themselves to get access to. Memento Blockchain. They're building secure and compliant digital asset solutions to basically bring together the sort of new world of digital assets and also traditional finance, traditional and also decentralized finance. And Ocean is basically delivering strategic property finance solutions with end-to-end solutions for it, and have got a specific offering today for investors. Once again, team, like I think 15, 20 years experience in this space. And then also our sort of sponsor for today is Bybit. Bybit's probably become known as one of the sort of bigger, I think there's sort of top 2, top 3 crypto exchanges. They're basically providing now, sort of making it easy for investors that they've got crypto that basically want to get access to their crypto and spend it through their cards. They'll be, providing the ability to access that sort of card offering so you can actually spend your crypto if you wish. So that's our lineup for today. So, ladies and gentlemen, it's been a long introduction to go through all the different thematics and all the different companies that are sort of presenting today. I said we've done our best to stack the day with relevance and value, whether it be through the sessions or whether it be through the companies that are presenting. And the thing I always note is the founders and the people we're working with, I said, not only are they experienced, but they still work 24/7 every single day to build what they're doing and to create opportunities for you guys to participate in. Everything is inside the Capital HQ app. You would have received an email this morning with all that. You can access the opportunities. You can actually find the agenda inside of there. Likewise, you can connect with the companies that you see featured. Obviously, they're also presenting in the room next door as well. And then the last thing, as I always say, my final part, the power of one conversation. Every single time this happens at one of our events, one conversation can make an incredible difference. It was one conversation that opened the door to us to take Australian companies to Singapore. We've been doing that for 11 years now. It was one introduction that allowed us to now start being able to take companies to Dubai. It's one introduction also that now has created the opportunity where, sorry, not yet, I built up. Actually, I'm going to go forward. There's one other opportunity, one introduction that also made this possible. So we're super excited to announce that we've now basically created a partnership to now assist with Capital HQ in India, where we're going to be helping, not only we're going to be partnering with with Irfan and his team to actually not just run events in India, but also make it that trusted pathway for Australian companies that are looking to test their potential in India. If you've been sleeping on India and haven't checked out what the potential for that market is, go and have a look at Modi's 2030 vision for what they've been building for India and have an understanding of their transformation they've done over the last 5 years. If there's any country that's been winning so far in the trade wars, it has absolutely been India, doing deals with everyone. They've got a strategic vision which they're relentlessly building towards. And so we want to create that opportunity to now not only take companies to Singapore, London, Dubai, but also now to take them to India as well. And then lastly, I'll mention, whilst you guys are sitting here today, the rest of our database is getting let know that we're launching Venture and Capital 2025. That's going to be hosted on July 29th and 30th. It's actually going to be hosted in this venue. This will probably be up there with Emergence as far as the biggest event that we do this year. It will attract between 750 to 1,000 investors at that event. For the first time, we're actually doing it as a 2-day conference, right? And this is just simply because the amount of opportunities that are coming through, but also the potential that I see for not just the companies and the opportunities, but also from the investment side is something so significant that I said, I want to sort of place the spotlight on it that it deserves. So there'll be a focus on the innovation side and there'll be a focus on the capital aspect. So Venture and Capital will be on July 29th and 30th, and it'll be hosted here at the Hilton. So ladies and gentlemen, for the first time ever, I've actually finished my introduction within the time frame. So on that note, I'm going to introduce to our host for today. Please welcome Jay to the stage and enjoy Private Capital 2025.
Thank you, Steve, for setting the stage for what promises to be a truly insightful day. Good morning, everyone, and welcome to Private Capital 2025. I'm Jade, and I will be your MC for today. And it is my distinct pleasure to kick off our program to introduce our first company presentation. This is an opportunity to hear directly from a company that delivers strategic capital and alpha through flexible real estate investment opportunities. Let's give a warm welcome to Daniel Ares, partner at Pindara.
I feel like Tony Robbins running on the stage like that. Thanks very much, Jade, and thank you, Steve. Good morning, everybody. Wonderful to be here at Private Capital 2025. My name is Daniel Ares. I'm one of the partners here at Pindara Partners, and today I'm here to share with you our differentiated approach to real estate credit, and I have 8 minutes to do that. Let's give it a crack. So as Steve touched on very briefly, we founded New Grand Capital Partners in 2015. Prior to that, myself and Robert, also partner, were in the development and construction industry. Robert is a QS and a development manager, and we were both delivering projects across the different sectors, myself in Australia, in Brisbane, where I am, and Robert in South Africa. In 2015, we started New Grand Capital Partners because we saw the shift in APRA's lending, or rather the regs they were pushing into the banks and the change in behaviour of the banks. And so we built a real estate funds management platform in Brisbane, Sydney, Melbourne, and we were exclusively investing in real estate credit, primarily debt and mezzanine debt, occasionally preferred equity. And then in 2021, we sold that company to ICG, who are relatively unknown here, but in Europe, they're the Blackstone of Europe. They're a FTSE 100 global alternative asset manager, and we traded that business in 2021. And we stayed on for a period of handover, integrated the business and the 3 offices and so on. And then in 2023, we began our gardening leave. But like all good entrepreneurs, one can't garden forever. So in 2023, Robert and I founded Pindara Partners. So this is our version 2.0, as you were. We're probably one of the only firms that I can think of in the real estate credit space that have sold and started again. We'd like to think we take some expertise with us. So when we were thinking about what our next adventure was going to look like, we thought we'd stop and take a look at what's going on in the marketplace and where are the opportunities. And what was happening over that 22 to 24 period was obviously much higher base rates compared to the 21 period where money was free. Money was now no longer free, and it was having an adverse impact on asset values across all, be it real estate or equities. The real construction cost inflation, it's a very topical one that we interact with every day, 30 to 40% cost increases since 2021. Population continues to grow, which is obviously is a political issue and one that drives the growth here in our great country, Australia. And that was having a lot of flow-on effects in terms of cost overruns, time delays, against a backdrop of growing need for more housing and associated real estate infrastructure. So we thought to ourselves, given what we know, where is the best risk-adjusted returns? And the backdrop to that is, how could we is it possible to generate equity-like returns while still benefiting from the downside protections of credit? Because once you're a credit investor, you're always a credit investor. You never go back. And the answer to that question was tactical credit. So tactical credit leverages the benefits of exposure to development construction and the tailwinds that support that in Australia with the benefits and the downside protections of credit. And given our backgrounds, we felt we were uniquely placed to capitalise on that. So what is tactical credit? Tactical credit is a series of sub-strategies that are displayed and can broadly be defined as construction gap financing, equity recycling, some people call it monetisation, asset recapitalisation, and of course duress. Now, we don't have time to go through each of those for today, but if you're interested, we can certainly have a discussion afterwards. But why invest in tactical credit now? Like, why now? It's always existed. Why is now the best time to be thinking about tactical credit? Well, we think it's for 3 reasons. Number one, it's a very competitive senior lending landscape. There are a lot of senior lenders. We used to be a senior lender. We're not so much anymore. I want to apologise if there are people in the room whose logo is not on the slide. We simply just didn't have enough room, and we felt that is having the effect of driving down returns, absolute returns, and creating softer terms. Also, as we enter this interest rate cycle of declining interest rates, more often than not, not always, more often than not, the returns from senior debt are linked to a base rate. Ordinarily, the base rate is a BBSY or the RBA's OCR. And as the base rate moves down, so too do the absolute returns generated from senior debt. At the same time, tactical credit tends to be a fixed return and tends to trade within 200 or 300 basis points through the cycle. So what it actually happens is, as interest rates decline, the risk premium that you get paid from tactical credit increases. Now, what's particularly interesting is that when interest rates decrease, as you all know, asset values tend to rise. Certainly real estate, both in the commercial sector via cap rate compression and via the residential sector as mortgages become more affordable, people can afford to buy, transaction volumes increase. So the actual underlying fundamentals of the market actually improve, asset values improve, while the risk margins improve as well. So we think that's pretty interesting. So how does it compare to alternatives? And it should be said that this is an alternative. There are places for real estate equity, there are places for senior debt. We just happen to focus and have a specialty in tactical credit. Tactical credit still gives you the benefits of senior debt, being securities, being mortgages over properties, personal guarantees. You still have priority of payment, and importantly, you have a buffer to first loss. As a comparison to equity investments where you are the first loss. So any change in value is felt by the equity investors, whereas a credit investor, you have that buffer to first loss. And we think that's a really nice thing to have to protect against capital loss. And it should be said that those returns for the credit investments being senior debt and tax are unlevered returns, whereas the returns from the equity are levered returns, i.e. you are geared and you have usually a senior debt facility in front of you. So those are geared returns versus ungeared returns. Something to think about. The other point that we'd make is when you invest in a project, to us, actually matters more to risk than where you invest in a project. I think there's a view that being senior debt is safe, and in many cases it is, but it's not the only risk factor. What tends to happen with senior land loans is you're investing earlier on in a project's life cycle when the risk is typically higher and things such as planning and or construction haven't actually crystallized yet. Tactical credit tends to invest and enter a project later in its life cycle when certain elements have been removed and thus risks have been mitigated. We tend to only invest once we have those things in place and we're a lot closer to the point of cash flow. Some examples, because everyone loves examples. This is a subordinated debt facility over 61 townhouses in Brisbane, an 8-time repeat client where the project had an approval, had 50% pre-sales, CBA was the senior lender, and the client needed some gap financing. This is a senior B note where we're actually introduced to the opportunity via a senior lender, a very well-known institutional senior lender here in Sydney. They had a cost overrun, or the construction cost, surprise, changed during the DD process. The senior lender, they were capped in terms of the leverage they could provide, and so they called on us to come in and provide that vital piece of tranche of capital to enable the project to proceed. Again, an equity recycle project in Austral where the project was already underway and we were able to take the capital out. So we, based on our experience, are very well positioned insofar as underwriting and managing construction development related risk. We've got a track record that goes back 10 years in this sector. And if you have an interest in accessing, we have a flagship fund that provides a diversified exposure to a series of these tactical credit strategies. And we also offer on a selective basis direct co-invest. So if anything I've said today made sense or piqued your interest, we'd welcome a discussion. Thank you.
Thank you, Daniel, for that informative presentation. We now move on to our second company presentation. Our next presenter is a company that transforms packaging with scalable, eco-friendly, reusable solutions, reducing plastic waste. Please welcome to the stage Ryan Nelson, founder and CEO of Refilled.
Hello, everyone. My name is Ryan Nelson, and I'm the founder and CEO of Refilled. Thank you for being here today. So, as you're probably all aware, we're facing a little bit of a plastic crisis. But what you may not know is that we are now at a point where we are producing a staggering 481 billion single-use plastic bottles every year. That is 1.3 billion bottles a day, and less than 20% of them are ever recycled. The other 80%, they end up in our oceans, landfills, and environment, taking over 400 years to break down into harmful microplastics. And recent studies have found that we are now finding in the human body up to 1 credit card's worth of microplastics that are being linked to all sorts of brain, heart, and lung diseases. Once I started researching the plastic problem, I quickly realized that it was actually beverage brands that are leading this climate catastrophe across household goods, cleaning products, pharmaceuticals, cosmetics, FMCG. It's Coca-Cola, PepsiCo, and Nestle. And that's because their products are found on the shelves and storefronts all across the globe. So the beverage industry hasn't changed in nearly 100 years. You know, we've gone from glass to plastic to aluminium, back to glass and recyclable plastics. But the best solution by far is elimination. And so if we've got a growing plastic problem, how are we going to change and become more sustainable? Refilled, my product, which, by the way, we've lugged it upstairs and brought it here for you all to try. It took a lot of effort to get here, so please come around and try it when you're done. But it's a smart drink dispenser that can pour hundreds of different flavoured still and sparkling drinks with zero waste to landfill. So we've built a circular economy where you or I can get peach, mango, strawberry, cola, caffeine, vitamins and minerals, electrolytes, alcohol even, all sorts of drinks refilled into your own reusable bottle without producing any single-use waste. We launched the product 12 months ago, and we're now at Google, Atlassian, Meta, Uber, JP Morgan, Woolworths, Asana, DocuSign, and we actually just signed our first customer in Singapore last week, which is a huge milestone for us. So these businesses, they want to eliminate waste, they want to encourage the return to office with their staff, and they want to do it affordably. So we actually save them money, we're getting their people back in, and they're getting to tick that ESG box. Our vision is to be the most sustainable beverage company in the world, and it's an absolutely enormous market. $899 billion worth of soft drinks are consumed every year, with $9.2 billion worth of soft drinks consumed out of home in Australia alone. Our go-to market strategy is to install these in offices and warehouses, gyms and fitness centres, car dealerships, airports, hotels, anywhere that you would typically see a vending machine or a water bubbler. We can hydrate people more sustainably. It's the razor blade business model. So we give them access to the machine, the client, we're B2B. They get the machine at a relatively low cost, and where we actually make all of our money is in the high margin consumables. So we've developed our own proprietary syrups that we make upwards of 80 to 90% on, depending on the SKU. And once that machine's installed, they're exclusively having to purchase beverages from us. So the machines, that's a picture of the machine on the left there, but there's a real one outside. It's available from $3.95 a month. And then we've got clients that will purchase anywhere from $400 to $5,000 worth of beverages a month, more affordably than RTDs, ready to drinks, and they're all incredibly happy with it. A good customer case study here, Google have now had machines for over 12 months. They're spending on average $1,700 a month with us with $1,000 gross profit, which gives us a 12-month ROI on every piece of equipment that we roll out. So we can actually pay off this hardware in 1 year with a 5-year effective life. Some of the key milestones, which is probably what you're all most interested in. So the business is about 3 years old. The first 2 years we spent in R&D and manufacturing. We launched the product in July 2024, and we have now had 10 record consecutive months in a row with 20% month-on-month growth. We're sitting at 840K ARR, and we should hit 7 figures and profitability inside of the next 6 months with the pre-sales we've already got lined up. We've saved over 428,000 single-use plastic bottles from being consumed, and that's with just 40 machines in the market in Sydney, Brisbane, Melbourne, Canberra, and the first going to Singapore next week. Defensibility-wise, PowerPoint stuffed up my design here a little bit, but it's the intersection of the hardware, software, and service that really creates our unique value proposition. So in the last 3 years, we have built a hardware company, a software company, and a drinks company. And the unique use of all 3 of those together allows us to exclusively dispense drinks in this way. Our roadmap, we've got product market fit, 840K ARR. Inside of the next 2 years, we want to get to 500 units in market and 9.6 mil ARR. And then beyond that, by 2030, we can forecast that we can have 5,000 units throughout APAC. We're looking at maybe even expanding into a residential model, and we'll have a suite of products that will allow us to serve drinks sustainably across the board. But at that point, we're looking at a 100 mil ARR business. And what does that look like for investors? Well, there's plenty of comparable exits. So Australian born and bred, Zip Water, you've probably all used it before. They focus on still, sparkling and boiling in both businesses and residential. They got acquired in 2017 for $550 million. SodaStream for 3.2 by PepsiCo, and Billy Australia, another Australian water brand, for $78 million in 2022. So how are we going to have a similar outcome? Well, we've realised we're actually so close to profitability that we've just announced a pre-Series A. So we need a little bit of a bridging round to just get through the next 6 to 9 months, be profitable, and then we want to go to the market and raise $6 million. But we want to roll out the first 100 machines. So we're doing $1 million safe note. You're welcome to come over and talk to me about the terms of that. We already have $500,000 committed, so we're incredibly close. Not far to go from there. So if you're an angel investor, high net worth, family office or VC that's interested in the sustainability space, please come and say hello. My QR code's there. You can book a call directly on my calendar. But I'd say take the opportunity and come talk to me over in the corner. And we've got cups for you to try the drinks yourselves. But yeah, I'd just like you all to imagine, a world without single-use plastic. Thank you very much for your time. Cheers.
Thank you, Ryan. It's really great to see the innovation happening across the private market. Our next segment features another exciting company presentation. Let's welcome Andrew Waters, CEO at My Farm Investments.
From protecting the environment to the natural environment. This is a shot of kiwi fruit, an iconic New Zealand product. It's less than 1% of the fruit bowl around the world. It's grown 571% over the last 20 years. Not only does it taste great, owning part of the industry is also a great investment. So My Farm is a real assets investor, focused on property and the agri sector. If you're looking at where sovereign wealth funds and endowment funds are investing, they typically have 5 to 15% of their portfolio in this sector. So why invest in New Zealand? Why come to Sydney to talk about investing in New Zealand? We've got a unique geography. It's a temperate climate. We get the cool winters, which is very good for flowering and fruit set. And we get those mild, wet weathers, which is great for growing product. We are the probably most successful economy in the world in terms of food production. It's about 10% of our economy, 50-60% of our exports. We are the best in the world at producing food. And that supports a whole innovation sector focused on productivity growth, new products, new ways of doing things. Because we're big in our chosen sectors, we've got a lot of infrastructure that supports us, service companies, packing companies, export companies, and science sectors. Obviously, New Zealand has a stable first world tariff-free economy, and we've got a market which is increasingly inviting overseas investors. So in terms of the subsectors that we look at, we have some economic moats. So these are products which are pretty unique to New Zealand. We've got some specific direct attributes. They generate high operating margins. Those margins drive reinvestment and investment growth. The long-term competitive advantage we have is supported by plant variety rights. That's the plant equivalent of patents. Our biosecurity protections, our unique growing systems, and so forth. So I've just brought up this SunGold slide again. It's a high-yielding product. It's easy to grow. It stores very well through the supply chain, and it sells very well to customers. They pay a high price. And it's the basis of our kiwi fruit fund offer. So as I said, we've got a $200 million investment vehicle. We're looking to raise 40 to 50 million in coming months. It's supported by strong growth. It's very productive, very profitable. Our profit margins are about 60 to 70% of our revenue. We've got this funny little company called Zespri. It's a monoxemy or a single desk seller. You can only invest in it if you're a grower. And because of that, it's providing attractive margins, 15 to 25% dividend yield. We're protected by plant variety rights, so that's the plant equivalent of a patent, and there's huge potential for future growth. And obviously, like any good food product, high vitamin C, it's part of that natural whole diet. Where do we sell our products? Largest market is actually Europe, obviously Japan and Southeast Asia. China is a large market for us. North America is around that 7%, but growing. So look, we provide a diversification opportunity into New Zealand's kiwi fruit industry, as an example. Targeted returns above 10% per annum, most of that driven by cash-based returns. We're spread across a range of properties, 160 canopy hectares, mostly the SunGold licensed variety, and we're building our ownership of those high dividend shares. The kiwifruit is an example of what we do. We've 600 million assets under management. The kiwifruit investment is a third of that, $200 million. We apply our rationale of looking for competitive advantage, high margins, that economic moat. And so Sequest is into forestry. We have a well-developed carbon market in New Zealand. We're able to earn 15 to 20% returns from growing good forests between years 4 and 15. And of course, we've got a valuable timber product at the end of it. We've just completed an exit from an investment with a 16% IRR, and we're just looking to redeploy funds as we're going forward. Core of our investments have been food-based. We've also moved into the natural capital space with deforestation. It's the carbon, the natural fibre, the biodiversity benefits. It's been natural, given that we've invested heavily in that carbon-based market, actually to move further across into the renewables market. In New Zealand, the core of our electricity system is hydro. So if the sun goes behind a cloud or the wind stops blowing, we can turn a hydro plant on a lot quicker than you can a coal plant. So where renewables sit in New Zealand is probably a lot easier than here in Australia. So 10 to 12% cash returns, no or little tax for the first 10 years because of the depreciation rules. And this is a major growing sector in the New Zealand economy, targeting mid-scale, regionally based facilities in the energy deserts that sit in New Zealand. So my farm is been around for 30 years. We have 600 million assets under management, looking to grow. 2/3 to 3/4 of our funds are from New Zealand high net worths and family offices. About 10 or 15% from overseas investors, and the remainder from a European fund. We've got deep experience. Over 30 years, you certainly learn a lot, and we believe we've got a tried and tested investment approach. Most of what we offer is a co-investment opportunity. So investments from as little as $20,000 New Zealand, income generating and growth related projects. We think we provide a great opportunity for portfolio diversification. On the other hand, we can also help investors establish their own strategies by buying and acquiring property themselves to build your own portfolio. So myself, Andrew Waters, Lou Bignell, we've got a stand over in the corner. We represent an important investment niche. Please come and see us. Thank you.
Thank you, Andrew, for that insightful look into my farm investments. We have one more company presentation before our first panel session. Our next presenting company today offers wholesale private credit investments backed by real estate, targeting 10% plus returns. Please welcome to the stage Andrew Beaumont, Director at Vest Capital.
Good morning. Yes, my name's Andrew Beaumont. I'm a Director at Vest Capital. I'm here to talk to you about our firm, which specialises in real estate private credit. So I'm sure most of you are already aware, but for those who aren't, what is private credit? So private credit, very simply, is where loans are made that are based on funds provided by private investors. So typically, when a borrower, and we focus on business borrowers in the market, would go out and get a loan, traditionally they would have gone to a bank. Or more recently, maybe a large non-bank. Now, all of this, these institutions are enormous public institutions. Where we come in is we raise funds. We raise funds from private investors, and we manage wholesale funds, and we basically give direct loans out to companies secured by Australian real estate. So that's all this term means. real estate private credit, and we're targeting capital preservation and leading risk-weighted returns. So we're sitting very much in the most defensive part of the private credit market, secured by Australian real estate. So why would this asset class be interesting to investors? It's quite conservative, as I said, compared to other asset classes. And it's offering more attractive yields than other debt products such as bonds or term deposits, and significantly so. And so the reason we believe in this asset class, and particularly real estate private credit as a sub-asset class of private credit, is the returns that are getting generated for investors are outsized compared to the risk taken against other asset classes. So people often talk about, equity-like returns for debt risk. That's very much how we see things. We're not in the market trying to generate massive returns like hedge funds or anything. We're very much about sensible vanilla loans backed by Australian real estate with moderate LVRs to preserve capital. And with that investment thesis, we're still able to generate returns for investors above 10% per annum in the current environment, which is really exciting. Obviously, this is one asset class. It would form part of a broader portfolio. And, under advice from your financial advisors, where we see this asset class sitting is in the most defensive part of your portfolio, but generating healthy income yield. And obviously, returns are paid monthly in arrears to investors. So this is a nice graphic showing where this asset class sits. And again, you may see private credit firms in the market offering quite a varied range of returns. Well, they're often based on a varied range of risks inside those funds. So again, as I said at the beginning, we are real estate private credit, and we're sitting in the most defensive part of that real estate private credit market. But you can see for the returns generated against this defensive asset class, those returns are significantly higher than equivalent returns from similar asset classes on that risk scale. It's lower risk than equities. It's lower risk than property equity because it's the debt against the property, which by definition is lower risk than the property equity itself. And it's probably sitting slightly under the risk profile of a typical sub-investment grade bond or a junk bond for a mid-market corporate. And where we sit in the capital stack against the real estate is critical. We sit in senior secured debt. Obviously, somebody who owns property may have some mezzanine financing. They may have some preferred equity. And then obviously the owner of that property is going to be holding the equity component themselves. So there's a place for all of these, and that's great. We want to sit in first place. And we want to sit in the most senior secured position on that capital stack against the properties we lend on. And this goes about this talks about the downside protection. Adverse events happen. Property markets correct. Borrower doesn't repay. You need to step in and enforce that property and possess and sell. You may need to do it in a situation where you may need to sell quickly. Whatever the scenario is that creates that adverse event against the property equity, we're still sitting in that senior secured debt position, which protects our position. With the right properties, at the right points in the cycle, with appropriate LVRs or loan to value ratio positions against those properties, we believe we're in a very, very defensive position. The outlook for this market is positive. So we're exposed to two main markets. We're exposed to the property market and we're exposed to the credit market. And those two things may not work together. But the underpinning demand for the loans that we're writing at the yields that we're generating is strong. So there is an acute undersupply of residential properties in Australia. I mean, the estimated from the government, the estimated undersupply of housing in Australia through to 2029 is 79,000 homes, which is significant. I would say that that's a very conservative estimate of the undersupply. Net migration continues to be strong, although down slightly from last year. Last year was the first post-COVID year. Still, migrant intakes are still 30% higher than the 5-year average pre-pandemic levels. So strong net migration. Interest rate outlook is easing. Nobody knows how far the cuts will go or how many there will be, but we are in an interest rate easing environment. And that supports property prices. It also supports the volume of transactions, and so the demand for these sorts of loans for borrowers. And it also supports the general economic conditions for borrowers to be able to service and repay their loans in an orderly fashion. And critically, the large lenders, they're very important systemic institutions, but again are still providing us that opportunity where they're unable to provide loans to borrowers quickly in a flexible manner. Why Vest? We have a very experienced team with excellent capabilities. We have over 50 years of experience in real estate private credit in our team combined. Obviously, we have a very good track record with 100% of capital and interest returned to investors since inception. And we have also built our own custom investment platform for you to be able to log in and very simply invest and build a portfolio in real estate private credit. When we write a loan, we obviously take security. And so we've talked about the real estate itself. We take a first mortgage over the property. We also take 2 more layers of security. We take a general security agreement over the borrowing entity itself, all of its fixed and floating assets. And we also take personal guarantees from the key persons involved in that borrowing entity. The Vest Private Credit Real Estate Fund 2 is currently offering a 10.25% per annum net yield to investors, paid monthly in arrears. No management fees. You'll often see in this industry up to 50 basis points of management fees on these types of funds. We don't charge any fees. We only make the money by generating the difference between what the borrower pays and what we're paying to investors in a net interest. As I've said, regular income paid monthly in arrears to investors, and you're getting all the benefits of being diversified across a number of properties, a number of loans, geographical, property type, and a whole bunch of other diversification benefits. I welcome you to come and meet the whole team out in the booth later on. We'd love to talk about what we do and who we are and how we can help you get into real estate private credit or otherwise diversify into this asset class.
Thank you, Andrew. All right, following the company presentations, we now turn our attention to a highly anticipated panel session, which is the private credit and yield investment trends. This is a crucial area for investors seeking to navigate the current economic landscape and identify compelling opportunities for stable returns. Leading this important conversation, we have a distinguished panel of experts, each bringing a wealth of experience and unique perspectives. Please join me in welcoming Francis McDonald, co-founder and director at Capstone Funds. Please come up to the stage as I call the name, please. Thank you. And then Anton Phillips Chantelwa, CFO at Delay Pay. Daniel Erez, partner at Pindara Partners. Campbell Newman, managing director at Arcana Capital. Angelo Del Borello, founder and managing director at Accure Asset Management. And Andrew Beaumont, director at Vest Capital. Let's give them a warm welcome.
You'll get a lot more attention from me, so watch out. Well, welcome everyone. We've had a great array of presentations already, and this is certainly a hot topic on private credit and property. There's been no shortage of attention from it in the marketplace. It has been, private credit particularly, has been delivering some very strong risk-adjusted returns over the last few years, and in the recent volatility, It's certainly really highlighting its appeal for its defensiveness, which has been already mentioned many times today. But with the growth comes scrutiny. And with that, also investors need to look at, there's a lot of new entrants on the marketplace. Where are you truly getting that defensiveness, and what are the protections being put on place on your investment? So we're going to kick off. I'm just going to hand over for each panelist to introduce themselves. I've asked them not to hold back, not to be polite. We want to get into the nitty-gritty.
Hi, Andrew Beaumont, Director at Vest Capital.
Anton Phillips, CFO of DelayPay and Bridgemill Ventures.
Hi, Angelo Del Borello from Acure Asset Management.
Daniel Arez from Pindara Partners.
Campbell Newman, Kana Capital.
What a panel. So across the spectrum, we've got people in both debt and equity, in property, agriculture, you name it. So there'll be a lot of different opinions today. I think the first thing I want to dive into is yield. That's what we're here for, right? But where is the risk? And how do we manage that risk to make sure that you are all getting the right risk to return? I'm going to jump in with Anton. Your model is all based on extending working capital to farmers. And that is an industry that is exposed to commodity prices, climate change. How do you manage that risk to make sure that your investors get a reliable yield?
Thank you. So, albeit that we are exposed to commodity risk, I guess by providing the sort of funding at the back end, we sort of reduce that. And we do that by taking a sort of caveat on property. So we take a position on farmland, not just fertiliser. The outcome of fertiliser is it gets put on the ground, and how we're going to recover that. So it doesn't work. We do get the grain sale at the end, but land out the front. In addition to that, we sort of look at ourselves as more of a trader. So rather than just providing funding, we're trading a good in, which means that we can sort of back solve some of that with an insurance product. So in essence, we've got 90% of our entire portfolio covered by a QBE insurance product. So if they trade default, we can lodge that in and take a claim. And then, the margin's at risk there. So we have to work with property to get that.
Thank you. That's quite sophisticated. Daniel, once you're a credit investor, you never go back. I like that. But you are in an interesting position. You do preferred equity, you do tactical credit. Would like to understand, what do people misunderstand about tactical credit and second mortgages? And what advice would you give them?
Sure. Yeah. What do they misunderstand? I would say that I guess the word mezzanine debt means more to people coming out of the GFC, and there were obviously a lot of losses that occurred post-GFC across the capital structure. And like most traumatic events in your life, most people anchor to those traumatic events. So when they hear that word again, they think back to those events. But the reality of today is that, and I guess this goes back to our story of when we started Pindara Partners, we'd sold a business, we'd made some money investing, and we thought, where is the best place for our capital? Where are we going to invest? And that's how we embarked on that journey to get to tactical credit, where in our view, we could generate equity-like returns from credit protections. Now, that relies on a few things. One, having the expertise and the background to underwrite that construction or development-related risk, but also recognising that when you invest in a project actually matters more often than where you are in the capital structure. For example, on one end, you've got unzoned land, which is very hard to finance, if at all. On the other hand, you have a completed product, which a bank will lend up to 95%. So clearly there's a difference in the risk, and you can move up the risk curve as you get closer to the point of completion. So our takeaway was that if you get closer to the point of completion, you can actually invest higher up the capital structure, get paid appropriately, or in some cases mispriced in your favour. And we think, that's really interesting, especially coming into this interest rate environment.
In my fund, we actually do a lot of the before and after construction, and I actually agree with you 100% on that. We see that every day in what we do.
Right.
And Campbell, thanks for joining us as well. Your model is quite different. You give investors direct property ownership rather than in a diversified pooled fund. That's quite a deliberate choice. Why have you chosen that model, and what do you give up in diversification for having that control?
Well, it's really very much driven by our investors because we actually have a particular slice of, if I can call it that, of investors who are very sophisticated people themselves. Many of them could afford to buy some of the things that we buy, whether they be shopping centres or fuel stations, office assets, in their own right. But they've worked out a few things. They don't like the hassle of managing them. It doesn't matter if you employ a top end of town property manager to do that, you're still going to be bothered. There's still decisions to be made. But they also have worked out that they would like to be diversified through participation in a whole range of investments. So what we essentially are doing is we've got a sausage machine, which is or a conveyor belt of these opportunities that are popping out in front of investors, and it might be, this quarter it might be an office, say in Brisbane, or next quarter it might be a car showroom in Darwin, and they go, well, I don't like office buildings, but I love car showrooms tenanted by Eagers, and so they pick and choose. And what we say to people is ideally try and participate in a number of the opportunities. But again, it's about their choice, and they're going, well, I don't like a diversified fund because it's opaque, I can't see into it, whereas I'm going to back myself looking at the IM, the information memorandum I've got from Arcana. I'm going to sort of get into and see if I really like that investment opportunity. So it's driven by investors.
Yep, I think that's very true. Some investors want to trust the management, go in a diversified pool, whereas some like to really look at the asset themselves. That makes perfect sense to me. Angelo, similarly, you're also invested across a diverse range of different property type investments. Where do you see the biggest opportunity, and what segments do you see declining?
Yeah, thanks. Well, like Campbell, we do play in yield-focused property investments and right across Australia, and we are agnostic on sector. So we tend to try and focus on counter-cyclical opportunities, which does involve convincing investors to follow us with our money. I've probably been around too long because I've got too much grey hair, and I've seen cycles change across all sectors. So right at the moment, we kind of like office because no one else likes office. So from that point of view, it's been down for some time. We've gone through COVID. We've had the work from home experience. I think there is a focus of corporations getting people back to work. So I do think there's probably some good times coming for the office market. We've played strongly in industrial in the 2013, 2015, we bought about 100 million worth of industrial, and we've now sold all that. We still like industrial, however, the risk return probably isn't there for our investors to chase that asset class just yet. But we are watching it closely. It is softening a little bit, so as it gets more attractive, we might jump back in at some point. Geographically, it's interesting. I mean, we see, Melbourne suffering a lot post-COVID. The taxes that have been imposed on property owners is substantial. We've sold all our assets in Melbourne, and we're waiting to see whether there's an opportunity to go back at some point once that flushes out a little bit more. But that gives a bit of an idea. I mean, retail is very popular at the moment with investors. I think retail is a very active asset class, so probably has more risk in some areas than people think. We also own a few shopping centres, so we do like to position ourselves across the country.
Right, yeah, I certainly think Melbourne will have its boom again. And I'll be returning to the office if there's some good drinks there from earlier. I'm saving on plastic bottles. Andrew, I'd like to finish this first theme on yield with you. Private credit is often touted as real assets, low volatility, equity-like returns. What's to lose? But I'd like to hear from you around what's the blind spot that investors might not be aware of, and what should they really be looking for in their review for red flags?
I think the blind spot is risk. As yields compress with interest rates naturally falling through this cycle, and more competition from private credit operators coming into the market, which is providing more liquidity and dropping yields, I think there may be a tendency for fund managers to put more risk into their investment products, and I think that's a mistake. We are very clear about what our investment thesis is. Job number one, protect capital. That's it. Job number two, to generate yield after that. And if we can still generate more than 10% returns to investors while sticking to our very clear priorities of what our investment thesis is of protecting capital first, we believe that's the right way to do it.
Okay, great. That's actually a really good segue into the next theme that I want to explore. Each of the gentlemen here have built very successful businesses, have scaled them up, but I'm keen to get into how do you scale without blowing up? When you get a lot of investor demand in, there's a lot of capital in private credit, there's the temptation to chase the deals. When do you say no? And how do you maintain discipline while trying to get money out the door is what I want to get into. So Anton, I'm going to start with you. You've just had a big influx. You've just recently raised $16 million. So congratulations on that. How do you manage that pressure to get the money out the door, but keeping the quality up?
It can be hard because there are the pressures of paying for money that is sort of sitting latent. So we're very lucky. We managed to deploy a lot of capital when commodity prices were shooting through the roof. Livestock had doubled in price week in, week out for a long time. But we were very sort of conservative in how we put that money out and made sure that we were tied up on the back end because we knew at some point that's going to go down. And it did big time. And we saw a lot of pain in the market from some of our competitors who were solely sort of isolated in livestock. And Stockco was a big business that grew very, very quickly. And a lot of people tried to follow them, I think. And so we sort of looked at it and said, well, let's make sure that we diversify across everything. We don't just want to be in cattle. We want to be in sheep. We want to be in fertilizer. We want to be in water. We want to be in land. And that sort of helps with that, just to make sure the money comes back. The other side is we're a very short duration as well. So we only lend out for 180 days. So we have a good pathway to money back in the door. And it's very seasonal farming. It rains a couple months a year. They get paid once or twice a year unless they're a dairy. And so we can manage that. For us, it is definitely, we need to get more money out. We charge about 30% per annum effective rate. And so it's not cheap. But we just manage that with a team of 3 and say, well, let's just sit slow, pick the deals that we like, and not sort of go outside of our barriers. If we have to give money back, we will, and that's the priority. So
it also helps to have a cash yield account that allows you to bring money in and out and still get not 0% on your money, undeployed money. I'd like to go a little analogy. Being a private credit fund manager is a little bit like when you buy a boat. Your happiest days when you get the money out the door, and your second happiest day is when you get it back, like when you buy and sell a boat. Daniel, I'm keen to get into, from your perspective, you've scaled before. You've sold to London giant ICG. How does the learnings from that shape what you're doing now?
So much, Francis. So much. For us, it starts with first principles. Make good investments, generate returns, return capital, build a great business.
Easier said than done.
Yeah, it's as simple as that. That's all you need to do. People are asking us this time, are you going to build this to sell again and so on? And honestly, having done it now, we're not interested in selling. I think for us, we just want to make great investments, invest our own capital. We're now at a point where, because of our network and relationships, we're out originating our own capital base and starting to think, we've got a couple of families that invest with us, but maybe it's time to start, expanding that out. And, I've been friends with Steve for a while now. Once he hears something like that, you end up at a function like this. That's very different to building a business to sell. And we've seen a number of fund managers that have, onboarded AUM in our view, perhaps for the sake of AUM growth, and that's not always aligned to the interests of investors. In fact, it's generally not aligned to the interests of investors. So I think as an investor, if you can get to know the manager that you're working with and try and determine their motivations and how they approach what they're doing, are they investing themselves? Why are they doing what they're doing? That can help somewhat in mitigate that risk of perhaps, a manager behaving in a way that's not aligned with yours.
Yeah, certainly co-investment offers true skin in the game. Your manager has a lot to lose as well. Then at our fund, we've got a first loss position for management. So that gives an extra level of protection that if we're putting the product forward, we want to stand behind it.
Yeah, because you lose first, right?
Absolutely.
Yeah, that's great.
And Campbell, you've closed a string of deals lately, so well done on that. Interested in what's the red flag that at the last hour might make you walk away?
Oh, gee, there's any number of things that could sort of trigger a deal falling apart and you're pulling out of it. But I suppose just to go back to perhaps the earlier part, for us, our process is really, it's one of consensus. So there's three managing directors within the business, Christina, Peter, and Cam, and if we're going to buy something after we go through our process, it has to be a consensus decision. It's not going to be a vote. Everybody's got to be green lighting it. And the beauty of what we've got is that we've got quite different personalities. And there's for example, a great deal of conservatism in Peter. And if it can go wrong, Peter believes it will go wrong. Volcanic eruptions and tsunamis seem to be in his mind as well. So, but seriously, the dynamic is what I think is important to us. We always invest alongside our investors, so we've got real hurt money in there. And preservation of capital is our number one consideration. Back in the early stages, we had some spectacular deals. We also had a bad deal as well, which we've continued to have to work through, and we don't take fees on that particular deal, but ultimately we're going to sort of give our investors their money back. So that experience, the good and the bad experiences, sort of factor into everything we do. But when you're doing a property deal, you just have to be exhaustive in looking at, there's the location, the market, that you're going into. There's the fabric of the building itself. There's the tenant and their prospects. There's legal due diligence. All those things have to come through. Occasionally you'll make commercial decisions where you go, well, we've just found that the air conditioning system's going to blow up. It's going to cost $500,000 to fix. Do we still want to proceed? Well, we've always factored in CapEx for things like that. But if it's bad enough, you might pull the pin at that stage. So there's lots of things that can kill a deal, and you do have to be prepared to walk away, and we have and will.
The last minute Google search sometimes reveals a lot that doesn't come up in the due diligence. You find out there might be a nefarious manager, or that the building developer had actually had a string of defects in past life. So there's a lot that needs to be done in the due diligence. And I think something I always say, it's good to learn a lesson once. You don't want to learn it again. So when you're looking at a fund manager, actually looking at fund managers who have managed difficult situations, who've been through the cycle, that's really important because it's not all sunny days. Angelo, I'd like to turn to you now. You've been recently vocal about the murkiness of transparency in private credit. What do investors need to be looking out for?
Look, I think private credit has expanded enormously over the last 5 or 6 years, and there are lots of players who are out with capital, and I think there will be pressure to deploy that capital. So I think investors have got to be a bit careful, because most of the lending is in the development sphere. In my experience of investing in development and running development projects, which we don't do now, is that everything takes longer, everything costs more. And we've seen that in the last 3 or 4 years where, a lot of builders have struggled to survive. So obviously there are a lot of talented private credit groups that are experienced enough to see through a lot of that. But I think when you're investing in non-stable assets, there's always a bit of risk, and that's got to be managed carefully.
Absolutely. Now, Andrew, you've mentioned that Vest is focused on stability and you're careful not to stretch for the yield. A similar question to I asked before, but what makes you say no to a deal?
We say no to a deal where preservation of capital is at risk. We're just very clear on that. We've solved this problem with technology. So we've built our own investment platform from scratch. And the reason we did that was so when we put up a deal for investors to look at, they can either take the deal or not take the deal. Now, when they invest in that particular loan, and the loan runs its course and then it repays, we return capital to investors. So this gives us the flexibility, which is quite different, I think, to the rest of the market, where we don't have a pool of capital that we always have to have out the door. If a deal is a bad deal, we just won't do it. And then if a deal pays off, we pay the money back. And so that flexibility of being able to put deals out to investors, raise the capital and return in a really efficient way through our investment platform is a real differentiator. And I think gives investors the confidence that we're not just doing deals for doing deals' sake, just because we have to move the money. We just won't do the deal. And I think it's been a common theme across the panel as well that obviously we're co-invested on deals as well as a first loss piece with investors. And I think that really putting your money where your mouth is so important.
Absolutely. I know we say no to about 95% of what we see, which I guess makes my daughter right, but I do always say no. Now, I want to turn to the outlook. We've had, private credit in particular has had about a 15% CAGR growth in the last 5 years in Australia. It has gone from niche to the mainstream. The Australian property market also has been incredibly resilient through a very turbulent time of affordability crises and high interest rates. But it's held strong, but returns are not what they were of the past decades. So I want to now focus a bit on the outlook. How do we keep this sector healthy, credible, investable, while managing new headwinds? Anton, I'll start with you. Responsible lending is under the microscope. How do you stay ahead of regulatory scrutiny, and what do you do?
Yeah, I think there's probably going to be 2 points that hit home for that. Is private credit is going to get more managed and sort of scrutinised from a valuation perspective. So as investors, they're going to sort of get a bit more insight into that. We're not that, so we sort of don't have too many investors, and if we do, they're sort of equity. So what we obviously lend money out, and we don't lend it on a consumer basis. So sort of the regulation for us is almost doesn't exist. It does, but it's very, very small, and so business to business. And a lot of the effort from a government is focused on protecting the consumer and protecting sort of the non-wholesale network. Well, that's great if you're buying iPhones and things like that and you're taking some debt out for that. And I think that's very important. But, we're lending money to a market where, it's also, it's an asset and revenue generating asset. So, they're buying some fertilizer at the end of a season. They're going to put $10,000 or $50,000 of fertilizer on a crop. And they're looking at sort of 2 month turnaround with a bit of rain. They're going to generate 40, 50, 60% yields overall. So that small amount of money that we put in is going to multiply by about 6. So yes, regulation's important, but it's also sort of relevant to the outcome. And so for us, we're obviously not going to put money into things we're not going to get money back on. And I think, from a regulatory point of view, that's just as important. We do all of our ACL training. We sort of lodge everything we need to. Separately to delay pay, we invested in a business called Financial Education Professionals. So we provide all the AFSL training and ACL training to probably some of you guys. And so, hopefully we're across that well enough. But I just don't see it being a big influence in sort of business to business lending soon.
Well, you certainly sound like you've got the right amount of skills. I'll be very interested to hear your story later. I think just to touch on there, one of the really important things in all private credit lending is the valuation. That's what you're basing your LVR on, the level of equity buffer that you have. If there's not an independent, verified, good quality valuation, that could mean very little. So that is certainly something to look on in your due diligence. Daniel, you've been across a lot of spectrums, invested in debt, invested in equity. What's your What's your view on the outlook for the sector and your one piece of advice you'd like to leave people with today?
Well, I think the outlook for the sector is positive. I think it's a sector that's here to stay. It's a sector that's growing. Clearly, investors like it. Clearly, borrowers like it. The regulators have a responsibility to make it safe, largely for the retail market, and we all welcome that. So I think the future for private credit across the spectrum, be it real estate, corporate, asset-backed lending, and otherwise, is bright, and it makes sense to have it in a portfolio. In terms of advice for an investor, I kind of think of, I would say to someone, well, if roles were reversed, what's the best question that you could ask me? Like, what do you know that I don't know that I should know? And it's, how do I lose money on this deal? How does it compare to the last 3 or 4 deals that you did? Tell me about the time you lost money or almost lost money, and what did you learn from that, and what are you doing differently? That's what I would be asking if I was interested in investing in this sector.
I think that's fantastic. That's a really great takeaway. Campbell, you've been across big policy decisions, infrastructure development, fund management now, been the former Queensland Premier, Lord Mayor, and a big career across the army and infrastructure. So I think you've got a lot of experience and exposure. We're going to see a lot of change in the macroeconomic environment this year, and already have. Interest rates look like they're going down. Interested in your view on commercial property, how you think that's going to change dynamics over the next 1 to 3 years.
Well, I think the lower interest rate environment's going to sort of see the compression of yields pick up again. Retail, it's happening now. Industrial is massively overpriced. Office has been an opportunity, and the yields didn't soften when when interest rates went up to the same degree. So stuff's quite expensive. I'd like to have a real go though back on this on private credit and regulation. Don't be so nice about it. Anyone from ASIC here? Well, it won't stop me. There's a real problem with our regulators in this country, ladies and gentlemen. AUSTRAC, APRA, ASIC, they need to be brought under control by the political class, but it's clearly not going to happen after the election we've just had. The reason that private credit has exploded is that APRA dramatically tightened the lending standards on the banks. They moved out of the higher risk lending, which meant that property development couldn't get off the ground without private credit. And now that private credit is funding it, now our regulators, bless their cotton socks, are looking over there going, ooh, what's happening over there? And they will hurt it. They almost damaged it last year by changing the definition of a wholesale investor, which would have been devastating to private credit. It also would have been devastating to what we do. It would have been devastating to start-up tech companies, biotech, etc. So, ladies and gentlemen, if I've got a message today, when you see this stuff in the AFR or the Australian, you need to pick up your phone or get on the keyboard. You need to go to your local, probably your local Labor member, and actually tell them why it's bad. We can't engineer out risk through regulation. Regulators should be going after dishonest, shonky people, incompetent people, but at the end of the day, you can't regulate out business failure. It's just never going to work. That's what concerns me. My final salvo is this unrealised gain thing, is this most diabolical proposal. It's not about higher tax on super. It is about upending the principles of the tax system in Australia, and somehow this has to be headed off before it becomes black letter law in the coming weeks.
I knew you'd have a lot
Couldn't
to
agree
say.
more.
Hear. I think at one of the last conferences, Steve joked that the role of the AFR in private credit was to build it up and then tear it down. I think we've only got a few more minutes, so I need to wrap up. So I might just ask Angelo if you've got any final words, and then over to Andrew if you've got any final words before we wrap up this panel.
No, look, I think Campbell summed it up pretty well, and I'm 100% supportive of what he just talked about. I think in commercial property, we're probably, for owners, it's probably going to be a good time with interest rates dropping. For new opportunities, it's going to get harder. And we've found that as we're looking for our new opportunity, certainly yields are starting to tighten. So we need to be more cautious going forward and making sure that the right opportunities are presented.
Great. And Andrew?
Thank you. I might make a couple of points, if you'll indulge me. The first is one of the things that ASIC's looking at in private credit on the investor side is transparency on valuations. Since day one, we've actually shared the independent valuation reports on every single deal with all of our investors. Very simple. It's quite, that's what we're leaning against. Why wouldn't we share it? So that's a very clear-cut way to deal with that. The second thing is on the Division 296, the unrealised capital gains tax on SMSFs, on super funds rather. Our modelling shows that on an SMSF balance of opening balance of $5 million, generating a 10% net return to the SMSF, that super fund would have to generate about a 6.2% cash yield to cover the pension to somebody between the age of 65 and 74, as well as the Division 296. Now, if you look at corporate bonds, a diversified listed corporate bond ETF, investment grade is paying about 5.5%. Government bonds, 2 years, is paying about 3.5%. The yield on the ASX 200 is about 3.7%. The S&P 500, forget about it. So where do you go? How do you generate 6.2% on investment grade investments in Australia for an SMSF with a balance of $5 million? And so private credit is a fundamental part of a portfolio, I believe, for super fund investors and investors in Australia more broadly.
I'm getting the look, so I've done a terrible job of keeping to time, but I would say that this has been an excellent discussion, so I thank you all.
Welcome, everybody. Welcome to, hope you enjoyed the first session. Just want to say thank you for taking our instructions and coming back into the room. As you guys know, one of the hardest parts about being an organizer is getting people back from breaks. So this next session, I first spoke to William a few months ago, and as far as, and he'll sort of talk about himself, but this is going to be, for me, when I watched his presentation, I really got some insights into a unique way in how, they actually think about property investment and actually specifically in, going into investing into hotels. So the other thing I was just going to talk about quickly before he comes up is that tomorrow I'm going to be sending out an email out to the database. And just out of curiosity, has anyone heard about the government's plans around unrealised capital gains? Anyone heard about that? Just out of curiosity, anyone think that's a great idea? Okay, one person, fantastic. So for me, one of the key things is that one of the biggest areas, obviously it impacts a lot of different areas, but one of the big areas is two areas that I'm super passionate about, which is around life science and also in the sort of energy, renewable energy, sustainability. We've done a lot of work in that area going all the way back to 2010. So one of the challenges is when you're making these arguments, against different policies and dealing with different governments and so forth. And we were very successful in our campaigning with the Wholesale Investor test. They actually decided to shelve that for the moment. So this one's the next one where absolutely, just to be clear, I've got zero interest in taking on sort of public policy and, dealing with any of this sort of stuff. But I know it impacts our ecosystem. I know we've got the largest ecosystem that it impacts outside of sort of banks and sort of financial services companies. So you will see an email about it tomorrow. And the thing that I would ask is that please complete it, because we want to basically be able to provide some data to some of the politicians that will have an impact, around this, about how it will impact investment into healthcare, how it will impact investment into renewable energy, and also obviously technology. Now, there is a specific reason why we're going that angle other than property. So you just have to sort of, trust that why I'm focusing on that as a specific area. So do note, you'll see that email out tomorrow. So please, assist in complete. The more data, the more responses we have, the more impact it can ultimately have. I said we were very successful with the campaign last year around the wholesale investor test. This one, I think, is just so fundamentally bad for Australia on so many. And I'm sure you could get Campbell talking about it, Steve Baxter talking about it. And the other person we're going to be collaborating with this is Jeff Wilson. If everyone knows sort of Wilson Asset Management, we're going to be collaborating with Jeff on sort of compiling this report. So yeah, please assist when you see that email from me. Now, what I'm going to do is going to hand back over to Jade. You guys are going to love this session as far as what William's going to be talking about. It's a completely unique way of how, an innovative way of looking about how to invest in the hotel space. And one of the things I said fundamentally to him, I said, for high net worth and for family offices, it's not too often they get the opportunity to come across the opportunity to participate in hotels from an investment perspective. So, really happy to have William come out from the US and to be able to sort of speak on this as a topic. So I'm going to hand back over to Jay to do the introduction, and look out for the email tomorrow. Thank you.
Thanks, Steve, and welcome back, everyone. I hope you had a refreshing break and ready for more valuable insights. We now have the pleasure of hearing from our first keynote speaker of the day, who will be delving into how institutional investors are using quantamental strategies to drive property investment success. Please join me in giving a warm welcome to William Houston, General Partner at Bay Street Hospitality.
Thank you. How's everyone? It's good? Good. I'll tell you now, it's my wife's birthday and I'm in Australia. So the first thing I want to start with, I need everyone to tell my wife happy birthday so that when she watches this and I'm back home on Wednesday, I'm not in too much trouble. So on 3, let me hear everyone say happy birthday. My wife's name is Pauline. So happy birthday, Pauline. Happy birthday. Louder, louder, louder. All right, brilliant. Thank you. Thank you. You don't know, you're saving me a lot of headache. I'm actually flying home to get her. And then we'll fly to Singapore for a couple of months. And I said, well, why don't I just go from Australia to Singapore? It's much shorter. She said, no, I'm not bringing the 5-year-old and 10-month-old, on this plane by myself. So I appreciate you guys helping me. So I'm going to be speaking about quantamental investing. And before I even get into investing, I'm going to talk a little bit about poker to set the framework for how do you make better predictions when you're investing as an individual. Kind of getting back to my wife, believe it or not, she paid a lot of her student loans by playing poker. And there's a couple of terms in poker that translate over to investing. So one of those is cash is what? King. Cash is king. So using the same logic in investing, if cash is king, what would you say are the queens in investing? It would be the liquid securities, right? You've got your money, now you can go and deploy into liquid securities. And using that same logic, you would say, well, what are illiquid securities? And now it starts to break down, because with illiquid securities, they're highly unregulated, they're very opaque, they're inconsistent in terms of the data that you receive. So something that we were looking to do is make sure that when we built a platform for institutional investors, they could look at these private deals and get the same sort of composite so that they could understand, what am I looking at with this individual deal, and how can I speed up the diligence process in a way that's going to take a unstructured data room and give me feedback so that I can predict what's going to happen with this outcome. I have a view that investing is part art and part science. So today I'm going to speak mostly on the science part of investing, and we will jump into it now. So a bit about myself, I'm William. I founded a firm called Bay Street Capital Holdings in the US. In 2023, I was Entrepreneur of the Year. I was selected by Damon John, that individual on Shark Tank. We've got Steve in the room somewhere. He's on the Shark Tank version here. In the same year, we got the #1 fastest growing firm by AUM, or assets under management. The same year, we were recognized as top 100 investors in the US, top 10 in California. And I think you can imagine what happened the following year. I sold the business, right? So we got a lot of notoriety, and from 2021 to 2023. The end of last year, we ended up selling the book of business to a group out of New York. And my partner is also here, Katie Way. She is the other general partner. She was an executive director at AQR. It's a $100 billion quant fund, for anyone who's not familiar with the group, out of Connecticut. Spent some time at Bank of America, Merrill Lynch, Deutsche Bank, and did her undergrad at University of Toronto and master's at Stanford. Ken is one of our advisors. He was one of my professors when I was at Cornell. 40 years in the hospitality space, built and sold a company called Unifocus out of India. Good friend of mine, and has been pretty influential in helping us get into the right doors. All right, so let's talk about what is quantamental. I like to sort of make things super simple. So what's the difference between quant and quantamental? We'll start with that, right? So quant is like math, right? Quantamental is like a method on what to do with that math, right? So quant is like counting. Quantamental is connecting together what is it that you are counting, right? Quant is like a calculator, and quantamental is like a chessboard, right? Quant is looking at a moment in time. Quantamental is like measuring momentum. Quant is looking at the past. Quantamental is projecting the future, right? I'm going to go through 4 formulas that we've adapted at Bay Street to help us when we're looking at these private deals. And as you're watching this, whether you're a hospitality investor or not, you should be thinking through how can I put together something like this so that the portfolio that I'm building is performing to the way that's appropriate for my risk tolerance, right? So we're going to start with the Sharpe ratio. Has anyone heard of this before? Cool. All right, so Sharpe ratio was developed by a guy named William Sharpe, also out of Stanford. He won the Nobel Prize on this. And effectively what he was trying to determine is, from a risk-adjusted rate of return, what is the most optimal portfolio? So what you'll see here, let me see. I want this to, yay, look at that. So what you'll see here, this bottom line is standard deviation. So just think plus or minus, right? Standard deviation. And then the line going up on the y-axis is your expected return. When you're running a portfolio, like your personal portfolios, the most optimal portfolio is right there, yeah? And so the bottom line that you see here, that's your risk-free rate of return. So think, if I were to just go buy US Treasuries, that's risk-free, right? And when I'm building a portfolio, I want to build the most efficient portfolio that I can, because if my portfolio is sitting in any of these other dots, I have too much volatility relative to the return that I'm getting. Now, how we've adapted that at Bay Street is through something called Bay Adjusted Sharpe. And what we're looking at is, what is the return that the developer, the asset owner, the operator is promising? What is the risk-free rate of return? But then we add an additional element of illiquidity. So when I make this private investment, how much do I need to account for like how much do I quantify the risk that I'm taking when I get into an illiquid asset like a hotel? Now that we understand risk-adjusted rate of return, we're going to talk about just return, which is alpha, right? So this is called Jensen's alpha. What this is telling you is, what is the additional unit? Am I actually outperforming, right? So when you have managers, some managers are lucky, right? And over long periods of time, everyone reverts to the mean. So when you're looking at a deal, you want to understand, for risk, which is on the x-axis, if you're looking at 2 equal portfolios or individual assets or 2 anythings, and they're both performing the same, what you want to understand is, yes, but what's the risk profile on that? If you have an asset that is getting the same return but has systematically less risk, that means that that asset has alpha. And that's what most investors are chasing. You want to make as much money as possible with as little risk as possible, yeah? Again, how we've adapted that at Bay Street is through something called adjusted hospitality alpha. You saw on the previous slide that we used that same formula to calculate our Bay adjusted Sharpe. Now that we've spoke about alpha, we're going to get into downside risk, which personally for me is my favorite thing to monitor as an investor. The older I've gotten, the more risk averse I've become. The more kids we have, like the more paranoid I get. I'm convinced that insurance was invented by parents who were like stepping on Legos, because I never needed it until I had kids, right? Like, it's like all of a sudden I'm terrified I'm going to fall down the stairs on some random toy that, it's going to kill me, literally. And so CVAR, this is something banks use quite often. It's called conditional value at risk. And what you want to measure isn't just what happens if we're going to lose money. Again, you want to be able to quantify it. So looking at the formula here, the C just stands for confidence. So how confident am I that I'm going to lose money on this deal? Let's say I have 90 to 95% confidence that if something bad were to happen, I'm pretty confident 90, 95% of the time that this is what it's going to look like. Now, this is what it's going to look like is this big S. That's the integral sign. It's basically just adding up the types of things that could happen. So let's say you think that let's say you're making an investment in a restaurant, how often is it the restaurant could burn down? And if it did, how much money would I lose? It cost me $100,000 to build out. Well, that could be one time. But then second time, maybe it costs $150,000. Then the third time, maybe it costs $200,000. So that integral is saying, on average, I'm going to lose about $150,000. I've taken the average of the potential losses. This section right here is probability. So what's my probability of loss? Let's say in the worst case scenario, 5% of the time, my deal is going to go south. So now I've been able to identify a range for my downside risk. And now that I have that downside risk, when I go into my investment where I'm speaking with the developer, the asset owner, the operator, I can already have in my mind what's the worst case scenario here, and I can now contractually obligate to get to delete all of my downside risk because I've quantified. I'm just making up like a term sheet. I can put in the term sheet, what do I want to do to protect myself from a downside risk standpoint? And when you do that with the developers, operators, asset owners, you don't really get too much rebuttal because it's data driven. It's backed by, and you're saying, hey, look, 5% of the time something could go wrong. I'm confident that 90% of the time, 5% of the time, something could go wrong. And if we were to lose money, I think it'll look like this. So whether it's through an insurance policy, whether it's through some sort of sovereign guarantee with a public-private partnership, whatever that looks like, I want to make sure that I've deleted the downside risk that I have in this particular deal. Yeah. So now, how do you put all of that together? Once you have understood how do I build a efficient portfolio that from a risk-adjusted rate of return is giving me the optimal amount of return with the least amount of risk possible. How do I add all of these government incentives to my portfolio so that I can get rid of my downside risk? Imagine now you're looking at a deal. I use Paris, France, because it's a popular place for hospitality, right? And before this presentation today, what most investors would do is say, hey, I've got a deal in Paris. It's a $50 million equity deal. Most investors' follow-up question is, what's the IRR? Right? But after today, the idea is a wholesale investor, you would ask a couple of more questions to see, is that the right, not just is it a good deal, good to see you, bro, but is it the right deal for my portfolio, right? So a question like, hey, does this beat the benchmark after liquidity? Most investors in this space, if you were to say, well, what is the benchmark? Just having a clear framework as what is the yield that I'm supposed to be getting in France, in the submarket, Paris, and then globally, what is the average return that I should be getting from a yield standpoint? That's the same thing as adjusted hospitality alpha. The base score, how strong is the sponsor? What's the market risk, government risk, repatriation risk, currency risk, right? Say you're in a market where the currency is devaluing. That's all being made up in a base score, which is scored from a score of 0 to 100. 90 to 100 is a good deal. 80 to 90 is worth taking a look at. Anything 70 and under is typically your public market stocks, right? That's why they're illiquid. That's why they're liquid. You're giving up the additional return for the liquidity in the stock. And then, what happens if something goes wrong with this asset? What if it's delayed by 12 months? How does my IRR get eaten up in that deal? That's your liquidity stress delta. And then last but not least, are we even getting paid enough for the volatility that we're going to see in this deal? And that's your Bay adjusted Sharpe. So what I'm going to do from here is I'm going to pull up our platform so that you can see how we apply this when we look at hospitality. And again, feel free to be thinking, how could I apply this to any asset? Like the framework, how could I put a quantamental system in place to better diligence my deals and more efficiently diligence my deals so that when people are sending me opportunities, I can quickly take a slice, see if it fits my risk tolerance and profile. And then from there, be elegant in my approach to determining whether or not it's suitable for my portfolio. Yeah. All right. You can take a picture of this if you want. It's just a QR code that gives you access to myself and my team. And we've also got some folders. We're sort of in the back corner over here that have some of the white papers that we've written on this. If anything you felt was compelling, you're able to see how do we create this process and what is the actual math behind a lot of the formulas that you saw today and how do we apply them. Yeah. I'm not sure. Oh, it's going to play by itself. So what you're seeing here, I have putting an example that says Hotel California. I'm looking at the IRR. I'm looking at the illiquidity premium. I'm looking at the benchmark. I'm looking at the volatility. I called this one Hotel California. In California, ESG is a big deal, so I slid that to the right. You can see I can pick any asset that I want here. For this particular case, it's a hotel. Here you can see all the current assets we've already invested in. And now when I save that investment, it's going to add it to everything that we've already diligenced over the last couple of decades. So that stuff in blue is everything that's now publicly traded. Right? The stuff that's on the top left, these are all the private deals that get sent to us. And here's where the problem starts, right? All the private deals always, they're hockey stick. They're all going to be 25, 35% return. And you have no idea what you're actually getting yourself into when you look at it. So from there, we look at what are the tailwinds that we have in these countries. We can compare any country and the macroeconomics to another country. Like say we get a deal in France and then we get another deal in Portugal. We can take a look at what's going on from an economic development standpoint, from an incentive standpoint, from land concession standpoint, and see not just is this a good deal, but how can we make additional yield and return from this without taking an additional unit of risk. After we've done that, you can see the investments in gold. Those are investments that our portfolio made. I wish I could pause this, but that is the efficient frontier. Did you see it? Like right there? So we're building a portfolio that's sitting right on the efficient frontier. And when we go, what just happened? Somehow it went backwards. I don't know if I did that, but let's let it keep going. Yeah, so you'll see like that's Marriott stock, that's Capital Land. Yeah, these are the private deals right here that we've diligenced. Let's let it come down. I have no idea how I did that, but yeah. These are all the countries and how we've ranked them. Z-score is basically taking to equal weight the countries because all the countries are different sizes, so you want to get an apples to apples comparison. In this example, I compared India to Ireland just to show you like two drastically different countries. You can see that we're looking at like, hospitality and revenue relative to GDP. Okay, fine, here we go. There is the line that I was showing you guys, right? Here is a bunch of deals that we looked at that we didn't pass diligence. And then here's our optimal portfolio and how we're expressing our investment thesis at Bay Street. Yeah. From here, say a new deal comes, we need to make a deal with the sponsor. We come here and we show them, hey, what's a deal breaker for us? That's the stuff in red. So they send us some deal, hey, I want to make X amount of money. We're going to be able to show them with data, this is what we can pay, this is ideal for us. Here's where we can fall back, and then here's where we're going to say this is no deal. This is just showing benchmarks, so it's tracking all the data, and this is showing alerts in real time of policy changes that are happening in these countries, so that as we're running our portfolio, we can see, do we need to be opportunistic and deploy capital into regions where certain things have come. And then the last piece is that predictive confidence. So as we're deploying capital, our goal is to get that to 90-95% statistical significance in our portfolio. That 85% that you saw is globally, as we're tracking returns, what do we think is going to happen with these assets and how often are we right? So thank you guys for listening. Happy to get to meet as many of you as possible. If you don't see me, do see Katie. She is right here. Katie, why don't you wave? Yeah, Katie. And we will go from there, yeah? So thank you guys for listening.
Thank you, William, for that interesting and very informative keynote. Now we'll move directly into our next series of company presentations, offering a closer look at specific investment opportunities within the private markets. Please join me in welcoming Elio D'Amato, co-founder and executive director at Enviro Invest.
Okay, good evening all. Hello everyone, how are we doing? It feels like evening, but yes, a sustainable tomorrow, that's what we do at Enviro Invest, if you can't tell by the general clothing that we're wearing. And ultimately, that is what we're about, although we are a little bit of a different, unique investment proposition than I think many of you are familiar with. Our mission, of course, is to allocate capital responsibly so that ultimately when our toes turn over, that it's a better place than where we started. And ultimately, we want to invest in assets that generate a very solid return for investors, but also are beneficial to the planet. Now, I can see that many of you are nodding off at the moment, and I totally respect and understand that, although it is important that my business partner and I are coming at this from important to say that my business partner and I are coming at this from a very different perspective. Many of you think of environmental investing like, I'm going to save the planet and therefore investors will benefit. Well, we actually take the approach that we invest or we help the investor by saving the planet. Now, it's an important distinction, I know, a very small play on words possibly, but nonetheless it is important because it does give you a bit of an emphasis in regards to where our thinking is and where we're actually aligning our sentiments. And I think it'll be even more evident when you do see who we are and what our background is. Ultimately, why invest in Enviro Invest? So it's important for me to say here at the moment that we are the head company. So this is not the fund, many of which you've heard of today, which is great. But ultimately, this is your opportunity to be a wealth manager, for the use of a better term. Ultimately, we want to manage money in a socially responsible way so that ultimately we can invest in low carbon sort of indirect investments that ultimately we're all very proud of being attached to. So as you can see at the moment, we're no Robinson Crusoe. We haven't discovered this, right? The world of environment is already, if not, and it will be ever increasing on the lips of future investors, which means that we actually need to invest in it today. But of course, it is a very opaque, very difficult market to be able to enter. And that's the bridge that we want to cross. We want to, ultimately, when someone thinks that I want to invest in the environment, we want them to think that of EnviroInvest. And ultimately, that is what we want to do. As you can see there, the two experienced investment managers, which include myself and my business partner, Chris Batchel, you'll meet him in a moment. And we want nature to become its own asset class. So at the moment, nature's bundled up in whether it's direct equities, whether it's unlisted assets, whether it's alternative assets, even private capital, dare I say it. But nonetheless, we want to turn nature in itself into its own asset class so that when people say they want to invest in nature, now yes, diversification and all that sort of thing, Sharpe ratios and all that sort of stuff, we'll look after, okay? That's the idea. We will look after all that. Ultimately, what we want to do is provide a diversified investment vehicle which does not only focus on things like, I don't know, energy capture, which is a big hot topic at the moment, renewable energy zones, which are very much a hot topic here in New South Wales at the moment, through to things like our friends in New Zealand in regards to their projects in regards to carbon capture and the like. So there's a whole, in regards to planting forests and the like. So there is a whole wide range of possible investment vehicles that we can invest in. But the problem is that we do so either in this very opaque way or we do it by putting our entire eggs in that one basket because, let's face it, unless you're UBS, there's no chance of you actually having access to this or someone of equivalent stature and the like. Or alternatively, you'll be going blindly because really, can you actually analyse these sorts of businesses? And that's the bridge that we cross. Now, investment in the vehicle, 70% of it is currently owned by Chris and myself in a firm by the name of Spotty, where we shine the light on the investments ultimately, and 30% is what we're looking for in regards to capital that we look to raise. We hope to raise $2 million, and I'll touch on that in a moment, but you can see that on our banner. But ultimately, we do take $250,000 lots. And I put this slide in for the particular purpose because so many people think that they're investing in the fund. No, this is an investment in the head company. In fact, when I approach the traditional channels in regards to possible investment, some would say, well, can you raise 20 million? Hell, I could raise 30 million if you want, but the reality is that we only need 2 million to get this off the ground. Chris and I have spent an inordinate amount of time in regards to budgeting, planning. We've met contacts with regards to establishing the funds and having them up and running, and also our various pitch and slide deck also includes what those funds will be used for. And obviously, we want to make sure that we use those funds responsibly and do so in a way that ultimately leaves the place better than what it was when we first looked at it. And I mean, you've heard a lot about the term AI, this particular conference. This is our firm, or our firm's version of AI, otherwise known as actual intelligence. So Chris Batchel, who you see up the top there, who joins me down the front as well. Go, Chris. He there is a investment manager with 3 decades worth of experience, predominantly in direct equity space. Started a firm by the name of Scaffold with a chap that you may be familiar with by the name of Roger Montgomery. He did establish that business together with him, to which ultimately that was sold and moved on. And I've been very fortunate enough to join with him. That's myself at the bottom there. I was with the firm by the name of Lincoln Indicators. Some of you will know that as Stock Doctor. If you are familiar with Stock Doctor, you're looking at hands here that created it, very much in direct equities land as well. We had a quant model that lent heavily, or well, for those quant nerds out there, including down the front here, Ed Altman. This was the first of Altman's scoring systems here in Australia back in the 60s to 70s. Ultimately, that was then created into a computer program in the 90s to 2000s, to which it's become a stock doctor today, and recently sold as well. So investing with Enviro Invest is about investing in a real business and also business owners who understand what it is that it takes to get a business from the ground up and then sold. We also do have ideals, as it were, in regards to do that, and I'll discuss that in a moment. So that is our form of AI. Very quickly, we're looking to raise $2 million. We will take $250,000 parcels. We're looking to raise, at a bare minimum, I think it is $750 to get things started. Funds will be holding trust in order to do that. As you can see there, the exit is in 5 to 7 years, so we are not intending to build this from the ground up. I mean, this wasn't passed down from my father and my father's father and my father's father before that, et cetera, et cetera. We have a clear eye in regards to the exit strategy, and ultimately we want to be so big that we can't be ignored. And that is really what we have aspirations to do, and the opportunity that lies to one or many of you in the room here in regards to investing in Enviro Invest. As you can see there, it's not your hit out of the ballpark 10 times revenue sort of startup model. We're not in regards to doing that. We are not a commodity in itself, other than we are a fund business. So we do have aspirations of growing that, I think, over 5 years to $1 billion Australian dollars in time, to which then there'll be massive synergy benefits that can be aligned in regards to that and making that meet. So just very quickly, this was a saying in the very early days that did resonate with me. It is part of our pitch deck, and that is that we intend to live off the environment's income, as a word, rather than its capital. And to me, that actually means a lot. And if you want to learn more about that, please do come see us at our stand. Both Chris and myself will be there, and we'd love nothing more than to bring you on this journey with us, so that ultimately we can leave the place better than what it is, again, that we first turned up. Thanks very much for listening. Thank you.
Thank you, Elio, for that insightful showcase on Enviro Invest. Next up, we have a presentation from Accure Asset Management. Please join me in welcoming Angelo Del Borelio, founder and managing director at Accure Asset Management.
So today I'm not here to pitch any product, because we're in the process of putting our next product forward. However, I'll give you a bit of a background on who we are and what we've done in the past, and where we see some opportunity going forward. So Accure's a boutique property fund management and syndication business. Started up in 2012. It's our 13th year. We've got a national footprint. We have people in every state employed with the group. However, we've only got 20 staff all in total. So we'd like to keep it small, but hopefully manage and acquire a number of properties that we all like to invest in. We've been around quite a long time. My very first property syndicate was in 1998. So, and we've been across all sectors, and from stabilised assets to development to developing office towers, hospitals, land development. We've done it all. These days, Accure over the last 13 years is focused more on stabilised properties. When I mean stabilised, that we look across sector, we look across geography in Australia, but we're looking for income, and a sustainable income that can grow over time. We have a very simple philosophy. If you can grow the income of an asset, the capital growth looks after itself, and typically you'll see that at the end of the process if we get it right. We like to think we take a fairly disciplined investment approach. We do have a number of people involved in the due diligence process, but typically we'll look at an asset that's been put to us, whether it be in Queensland, West Australia, Sydney, Melbourne. Last year we looked at 85 properties and we bought 3. So there's quite a lot that we need to go through before we find the one that we really like. And typically when you see one that you do like, it comes across quite strongly after the experience we've had over a long period of time. the last 25 years, I think I've been involved in acquiring about 94 properties, probably $2.5 billion worth of real estate. So we've seen a fair bit over the journey so far. We'd like to think that the more you do, and along that process, we have made a few mistakes from time to time. As I'm getting older, we're making less mistakes. So it's one of those things that experience does help you learn a few things. Typically, we're looking for assets. Quite often, they're single asset syndicates. Although, having said that, we just recently launched a hospitality fund for the hotel sector, accommodation hotels primarily, where we've bought 4 assets in that vehicle so far. But typically, our investors tend to like to know what they're investing in. So open-ended funds need to have quite a defined period of when we open and close those funds. We don't take pre-committed money, so we typically back ourselves in. When we find a property, we'll do the due diligence and then launch an IM, and then we'll raise the capital at that point. So people, we don't want to be in a position where we're pressed to deploy money into something that may not be the ideal investment. This slide just covers off on a few assets around Australia that we're involved with. Our last syndicate, which we just closed in March of this year, was a Gold Coast asset, A-grade building in a pretty tight market, vacancy rate of about 6%. We bought that at a 9% yield. Our intention is to try and find assets that can deliver at least a 7, 8, 9% income stream. And we have some that are well above that, that over time, the beauty about Australia is that normally our leases are structured in a way where there are increases every year on the rent. So that the aim is to keep those buildings as full as we can. Our next slide is just a bit of a summary on some of our exits, I suppose. Over the last 3 or 4 years, we've sold about $250 million worth of real estate. We've acquired in the last 13 years about $650 million worth of real estate. Buying well is a theme that we try and focus on as best we can. I mean, we're big believers that you make a lot of money if you buy well up front, and then timing your exit is the next important focus that we really focus on. Over the last few years, we bought a number of industrial assets in 2013, 2015. We started selling those about 3 years ago into what we considered a very strong industrial market. We bought them 10-year leases at 8.5%. We sold them at 5.5% in the main. So what that did was create some strong capital growth, and along the way, our investors have enjoyed some pretty steady income, typically around 11% in that sector. We still like industrial. It's still quite a strong market. It is softening to a degree as supply starts to kick in. And typically any sector will be affected by supply and demand. That over the last 25 years, what we have seen is the cyclical nature of every sector. And that's why we like to be in broad array of sectors and also across geographies, because every state will move at different times. I suppose an example of the way we think, we do tend to focus on themes, and obviously COVID was an abnormal period of time. It threw up a few opportunities that we saw post-COVID. As we all know, the hotel sector was on its knees through COVID. If you didn't have a government contract that brought in people that were detained for that 2 weeks, you were in a lot of trouble. So post-COVID, we launched our hospitality fund to buy hotel assets, and we targeted those assets that we thought could bounce back quite quickly. One of the themes that came through COVID was Australians got used to travelling locally, and probably was a good thing for the local economy and hospitality, and that was a big theme of the type of assets we focused on. We also started looking to acquire some office assets. People were working from home, office buildings were empty, and there was a big question mark of, is this a permanent thing or is this a transitional thing back to normality? I think we are starting to see people going back to the office for their own mental health, and I'm a strong believer that office buildings are going to be having quite a strong period of time going forward. Probably had a tough time behind us, and that's a sector that we kind of like going forward, and where we think there's going to be some pretty strong returns. If you look at across the different sectors, how do we see it? I mean, industrial still has some pretty strong demand, but we are starting to see a bit of supply coming into that market with new land being available for operators in that sector. Shopping centres had a pretty tough time through COVID, bounced back. We are now starting to see quite a lot of demand for shopping centres and large format retail centres, which is typically forcing prices to go up. So from an acquisition viewpoint, it's becoming more challenging to buy value. We're in the process of selling our last large format centre at the moment. Office, I've talked a little bit about. I do think that that's a go forward for us. We are looking in that sector. Traditionally, if you look back over, pre-COVID, you had office buildings in Sydney and Melbourne were very sharp, and now you're starting to look at buying assets around the 8-9% mark, which we think is pretty attractive. I do have to wind it up, but here's a bit of a summary on some of the type of assets that we've owned and sold in the last few years. And by all means, come to our booth if you want to know a little bit more about those and what sort of opportunities we have in the future. Thanks very much for listening.
Thank you, Angelo. And that was Accure Asset Management. It's really great to see the diverse range of investment approaches that are represented here today. Our next company taking the stage is Westbridge. Let's give a warm welcome to their chairman, Damian Collins.
I was going to say good morning. I think we're nearly at good afternoon, everyone. So to give you a bit of background on Westbridge Funds Management, we've been in business for 20 years. We have about 943 million in assets under management, although we've just purchased some more, so we're getting very close to that $1 billion mark in terms of assets. Our average distribution over that journey has been 9.9%. And our average client invests 4 times with us, which is something we're particularly proud of, that our clients keep coming back for more investments, and that certainly gives us confidence that when we go and buy assets, we know we've got the backing of our clients who want to come into those particular funds. Just a bit about our team. We've got a broad range of skills and experience across the team. I'm the chairman of the group, a chartered accountant by background, but I've been in real estate now for 30 years, sadly, so it tells you how old I am. Our chief financial officer worked at Lendlease. Our head of commercial funds worked in a lot of large British institutional property investment companies. Simon, who's the head of capital transactions, is ex Charter Hall and Goodman's, and Mark, who's here with me today, head of capital, has got a broad range of experience in capital raising and experience at CBRE as well. So we've got a great team, which is something I'm particularly delighted to have. So we've got that real broad spectrum of experience, and we sit down in our investment committee. Many of those members are on the investment committee to really nut out an asset and coming at it from all different angles. In terms of our portfolio, we've very much take a thematic approach. We like sectors, and then we'll go and buy assets in those sectors. And 7-8 years ago, we could see what was happening with the industrial market, particularly around logistics. So we decided that was a great sector that we wanted to be part of, and we went to very heavily in industrial property, and we're 51%. We still knew that retail was going to be still important, but some retail was going to suffer, particularly product retail that you could buy online, and those with large rent overheads as percentage of turnover. So we targeted very much the neighbourhood shopping centres where Coles, Woolworths, etc. are paying around 3 to 3.5% of their turnover on rent, and the large format retail as well, where the rents in some cases are $200 a square metre, very low overheads with outdoor parking. But consumers like that sector because they can drive up to it and pick up the goods, a lot of click and collect. So they're the sectors. Also healthcare we like. We haven't been in the office market for some time. We could see the trend was happening with more people looking to work from home. Obviously, COVID sped that up dramatically. There will be opportunities in office, but I still think there's a little bit of pain there. So we're monitoring it. There might be some really great opportunities that come up in the next 12 months, but still cautious on the office market. But one day it will come good. So in terms of the types of the funds that we run. So we've got income-focused funds where they're generally assets that are well leased, long-term tenancies to national tenants and who are going to be still in business. Everything's about risk and return, so you're going to get decent distributions, but moderate capital growth, basically in line with the increase in value of the underlying rent. Then we have income plus, so we take on a bit more risk. There might be leasing risk, might be refurbishment risk. So ways we can add value to that. So we'll be targeting 10 to 15% internal rates of return. And then we have opportunistic type funds where we buy assets that we think are significantly undervalued or they might need complete redevelopment. I'll give an example. We bought a lot of assets in the Pilbara, over 110 residential properties at the bottom of the market. The market had come down 80%. We've just sold out our first fund. That delivered 14% return, and our second fund is on track to deliver an IRR of 30+% per annum. So we look for those opportunities where they come. Obviously, they've got to be fantastic opportunities for us, but certainly also an area of focus. So it's a broad spectrum of funds. Just give you a case study of one of our funds that we've recently finalised. It's the Diversified Property Trust. So we set that up some 10 years ago, bought a lot of assets, again, in that industrial market. We could see the opportunities there, and the assets were across Victoria, Western Australia and Queensland. Obviously, lots happened in the last 10 years. We had COVID and a lot of market volatility, but we were delighted we've just closed out that fund, and total return for investors 156% over that journey, average income 8.6, and internal rate of return 17.3% per annum after all fees and costs. So a really good outcome for investors, and they're delighted with it. We did lots of leasing transactions, lots of deals during that term, and for a passive fund, that was a particularly exceptional result to get 17.3% internal rate of return over that journey. So what we do have at the moment, look, we're always looking for great opportunities. Our funds typically go fairly quickly when we're raising capital. So we do certainly encourage you, and I'll at the end here, certainly if you want to come and see us at our booth, to get on our early list, put your name down, and you will get access to our early list for investment. But what we're running at the moment is an industrial opportunity fund. So we're still confident in the industrial market. Yes, it's performed particularly well over the last 5 or 6 years, but pure and simply, we still have a massive shortage. There was a study done recently, and all the major capital cities of Australia are amongst the lowest vacancy rates in the world. And building sheds is a bit easier than residential, but it's still not easy. The costs are up significantly across the country. Land values have gone up a lot. So replacement cost is very high. So when we're looking for assets, we always want to make sure that we're below replacement costs, and that means that someone bringing new assets to market has to set the rent at a higher level simply to get it off the ground and make it stack up economically. The other thing we do is we target assets that are about between 10 and 40 million. So they're assets that generally out of the range of most private individuals, not all, and generally below most institutions, bigger institutions or groups. They tend to target assets 50 million plus. So it's that sweet spot where we find there's less competition, and we certainly have found over that we're able to get in and buy great quality assets. Our team have an amazing relationship with the real estate agents. We often get access to deals that no one ever sees. They know we're good for the money. They come to us, and we always complete the deal. And so that's another thing that certainly benefits from 20 years' experience, is that ability to be able to close the deal and confidence in the agents to bring us those opportunities. In terms of the Industrial Opportunity Fund, it's an open-ended fund. We're looking to get to about $250 million of assets. First asset we purchased was Pinkenba in Queensland, fully leased to HMG Hardchrome, which is a part of a big global group, Syme Darby Burhard. Second asset we've just acquired is leased to Coates Hire, that's wholly owned by Kerry Stokes' Group 7 Group Holdings. So two different states, different asset types, but again, they're good seed assets, and that we've been able to put into the fund. In terms of the fund's target, we're targeting 11 to 13% internal rate of return. Very focused on industrial, some with value add, some a bit more passive, but generally a bit more value add. So the distributions will be 5 to 6%. So we are focusing on some income, and also as through that journey where there's special distributions, which we've done with a lot of our funds, where we find an asset we believe has reached peak value, we take money off the table and return that to investors during the journey. It's an open-ended fund in 2029. If you want to get out, you can. There will be a liquidity event in 2029, and then every 5 years thereafter. It's open to 100,000 initial minimum investment, options for 10,000 more after that. Wholesale only investors, which I'm sure most of you are in this particular space. So if you're interested in not only this fund, but also our future investments, you're certainly welcome to come to our booth out there, put your name down for registration, and you'll get a quarterly newsletter, but you also get access to all the opportunities that we have in the market. And sometimes we just go straight to our database, don't go any wider. So thank you. Thanks for listening, and look forward to seeing you at our booth and over lunch later in the day. Thank you.
Thank you, Damien, for sharing your investment opportunities with us. Finally, for this segment of company presentations, we have Cosmo Innovations. They will be presenting their award-winning affordable medtech and consumer health solutions. Let's welcome to the stage Dr. Matthew Javarsade, CEO and founder of Cosmo Innovations.
Good afternoon, everyone, and thank you for joining me today. I'm Dr. Matthew Javarsade, founder and CEO of Cosmo Innovations based in Melbourne. It's a real pleasure to be here to present SkinGate, which is a revolutionary transdermal skincare delivery and facial rejuvenation and hair care technology, which brings advanced science directly into your home. Excuse me. So before we dive in, a quick disclaimer that this presentation is not for informational, it's for informational only, and it's not an offer, excuse me, or financial advice. Just a good science and great business and exciting potentials. So imagine this, we spend hundreds, maybe thousands on luxury creams, serums, and treatments, and we apply them carefully, hoping for youthful, glowing skin. But as studies show, up to 80% of the active ingredients never make it to our skin surface, so which is like pouring premium fuel into a tank with blocked pipe. So this creates unnecessary cost, time, and discomfort, not to mention the multiple salon visits. So now consumers are looking for something more smarter, innovative, and more greener. So here's the pain point. People want results, and they fear the side effects. So downtime, the cost of repeated clinic visits, but they crave for safe and alternative home solutions without any compromise. So here's the solution, SkinGate. So SkinGate is a device that is not just a gadget. It's a technology that delivers not only skincare, but also offers maximum skin rejuvenation, hydration, and firming. With its bioimpedance real-time skin analysis, it's designed to pick up skin's oil level, moisture, texture, and vitality under 4 seconds. And then by using a multimodality of iontophoresis, which is a technology that changes the galvanic energy of the actual cream, which the capsule built into the device can push the actual cream further, and we can get an exact amount of the skincare that the skin needs. So by pressing the button, we get 0.25 of the actual cream that comes out of the device, which is enough for one side of the face to be treated. So this completely eliminates the need of manual application of the creams and serum that can result in delivering of or transmitting germs to our skin and absorbing the actual product into the hand. So this pretty much pushes the actual cream, and by massaging the device for 5 minutes daily, within 2 weeks, you can achieve a maximum skin hydration. So the actual device, as I said, has a skincare capsule. It's a 15 ml skincare, which helps us with the recurring revenue. And this is something that we can come up with different formulas. And the box that I put here, so this is actually a formula that we have on this registration. So this is a daily nourishing formula that consumers will purchase after they finish the product, after usually about 20 applications for each capsule. So it takes about 3 months for them to finish it. So with a third-party application AI company, we are partnering to use their app that can be put into a phone where you can take a selfie and the phone will pick up skin's imperfection, which can straight away instruct the user to purchase the right product for their skin. So what's behind the magic? Science. We have developed multimodality technologies that can, without any side effect, offer maximum hydration that can last up to two days or longer, and immediate firming of the skin that can be highly visible. You can see a remarkable improvement around the jowls, nasolabial fold. This is just after 10 minutes use of the device. So this technology requires no training, so it's very easy to be used by both consumers and professionals. So you can see that clinical studies show a significant improvement in all the clinical trials that we have conducted. And in terms of the clinical trial results, we have achieved from 24% increase in skin texture up to 64% in minimizing lines and wrinkles of the face, and 100% satisfaction of those who have undergone this clinical trial, which was highly encouraging for us. In terms of the competition, we are highly competitive against big, major, multi-billion-dollar global brands such as L'Oreal, No Face, Philips, and so on. So we tick all the boxes in terms of the delivery of the actual skincare. We are the only company in the world that has the capsule delivery. So no other devices have ever invented a solution that would be able to push the cream within its capsule. I mean, they could make it, but it would have been very, very large and very heavy, so it would be more suitable for the professional market. But we managed to get top engineers together to come up with a solution that light, very easy, and smart device could deliver all the results that we want. So this is the next evolution of the SkinGate that is called SkinGate Pro, which is the device that I have in my hand. So this device that we have just received the prototype last week is just one device that comes with different heads. So this head is designed for skin cleansing, scrubbing. Different head does, for example, hair loss. So the actual hair serum could be placed into the capsule, which I've got in my hand, and can deliver the hair serum for hair restoration as well as hair coloring. So ladies and some gentlemen can enjoy hair coloring at home by purchasing the right dye and use. So this comes with all different heads for different purposes, which we are raising the capital, which I'm going through shortly, to finish the manufacturing and FDA submission. So in terms of the market size, it's quite large. In terms of the global market, we're looking at between 65 to 750 billion, where there is home beauty devices to overall skincare and anti-aging, hair loss, and acne. So when we look at the consumers that are engaging with a global beauty market, we're looking at around 571 billion, which was by Statista the market size last year, and skincare alone accounts for 171 billion, which if we go conservative and we target only 0.5% of the population, that means that nearly 100,000 units per year could be sold. In terms of IP, our IP is highly secured, and we file patents across the US, EU, China, Japan, Australia, New Zealand, and other countries that we are expecting most of the patents to be granted this year. We already, In terms of the traction, we already secured $250,000 by Capital Q Ventures, Florida, as well as a recent agreement was signed by Chemist Warehouse Marketplace. They get over 2.7 million unique visitors per week. And we also have been confirmed by Royal Family of Dubai to join the group. So let's talk numbers. In terms of the cash and the required fund, we're raising $3 million US to scale manufacturing and the fuel global distribution of the initial SkinGate and SkinGate Pro, and obviously commercialize the device together. So this technology we are aiming to apply for 510K FDA, which is for hair loss, acne therapy, and wrinkle reduction, which could really push the bar in terms of the prices that we are asking for both consumers and professionals such as dermatologists, doctors, and so forth. So our team, this is just the use of fund, which we quickly go through, which is obviously what we just discussed about the manufacturing cost that is needed, as well as clinical trial. And our team is quite a strong and diverse background in both beauty tech and med tech and consumer health. And I'm truly proud to lead the journey alongside with such an expert. So my background is dental surgery, but about 25 years I've been practicing in the field of advanced cosmetic medicine. I was the former vice president of the Australian Institute of Laser Therapy. Our company is a proud graduate of Johnson & Johnson Innovation. For 5 years, we've been using their amazing mentorship in both Shanghai and Singapore. And in closing, SkinGate is not just a device. It's a platform with a recurring revenue and a global opportunity. Thank you so much.
Thank you, Dr. Jafarzadeh. So if you're into the anti-aging cosmetics market, Cosmo Innovations is really one company to watch out for. So following our company presentations, we now turn our attention to another compelling keynote speaker. Today, he will be shedding light on a sector with significant growth potential and increasing investor interest, which are investment opportunities in defense tech. Please join me in giving a warm welcome to Steve Baxter, the founder and lead investor at Beat and Zone Venture Partners.
Thanks very much. G'day, my name's Steve. There's no screen here. Right. There's a disclaimer if you like a big green tick in a box, you can read that. I like defence. I actually like sectors that are irrationally unloved by other investors. We plan. I like things that, for whatever reason, people don't like. And if you look at the various themes around defence, ESG, for example, defence is pretty unliked. I don't know why. It's a $1.7 trillion US market in the allied sphere. There's roughly 50 countries in the world that we can sell stuff to as an Australian defence company without being arrested as a gun runner. That's essentially our target market. That's in the old 2% world. So there's a lot of news lately. There's a new US administration. They're talking a lot about increasing defence budgets. These defence budgets are at the moment, or have been up until recently, near record lows. US defence spending, believe it or not, despite the fact that last year they spent $864 billion, was actually at a near record low at 3.45% of their GDP. In the non-wartime years of the Cold War, non-combat years of the Cold War, they were spending close to 6% of GDP on defence. European defence spending was embarrassing, way south of 2%. If anyone understands why Donald Trump hates Canada so much, they were contributing 1.3% of GDP to defence. So there's been a chronic underspending. Even with that being the case, it's still worth $1.7 trillion as a market right now. That's about to double, if not double and a half. European defence spending is getting better. So just in the last few days, last sort of 6 days, the NATO nations came out and agreed to take their spending up to 5% of GDP over the next 5 to 10 years. I think they're just waiting out the current US administration and they'll go back to their old ways. But there's a real impetus to that. Poland is not in that bucket. Poland has been occupied by Russia before, and the new saying is hell no, never again. So the Poles are doing what the Europeans should and spending lots. So the US has been out there busily resetting its relationships in many areas. We could talk about tariffs, but in this area it's defence. So, and this has provoked a lot of activity. So a lot of nations have come out and basically, probably everyone except Australia, have come out and said we'll aggressively actually increase our defence budgets. So all this is pointing to an amazing, massive opportunity in defence. You'll also notice I speak very fast. If I'm going too fast, please slow me down, but I'm in between you and lunch as well, so I want to get through a lot of this. And so why is so much being spent on defence? You know, every 70 years we go collectively insane as a species. 3 years ago, a madman started a mechanised ground war in Europe again because we forgot how bad the last one was. You have the issues in the Middle East. You have the issues in India, Pakistan just recently. And you've got a particularly bellicose tyrant in China who is requiring his military to be ready to seize Taiwan from 2027 onwards. The last time we ignored a dictator was in Ukraine in February 2022. And so I think when dictators threaten to do things, we should listen to them. There's an amazing amount of opportunity out there in the way that combat and defence is fought. This is best exemplified by drones. And I'll use drones. I actually hate drones as an example, but it's the best example to use. So combat and defence forces are going away from very expensive, very exquisite, very few military systems, so like big expensive missiles, down to systems in the hands of getting closer to the front, smaller systems, cheaper systems that exemplified by drones. So you're seeing this technology shift. There's a lot more to it than that. There's an entire layer and stack of things that occur there. I think what's exposed to the public through some of these dreadful videos you see out of the European theatre is drones. Drones doing all sorts of things. And the amount of innovation that's happened there, I mean, that conflict started with the Ukrainians very successfully using a Turkish unmanned aircraft, a drone, that went to shop-bought drones. Now there's things called Queen drones. Queen drones carry smaller drones. There's fibre optic drones that drag a fibre optic cable behind them so they can't be jammed. There's thermite spewing drones, which I think should be banned under the Geneva Convention. So there's no end of things out there at the moment. So the pace of innovation in this sector is off the charts. So the general macro environment out there for defence is great. Back at the end of 21, start of 22, venture took a bit of a tumble with the zero interest rate environment sort of going in the US and exits becoming uncertain. AI came to maturity in an investment sense or an investor sense. It came to visibility to investors around them at the same time. Very much a confounding feature in the tech space. AI is tough because if you've got a technology that can change the way that business is done between sort of 5 to 15% month on month, and you take 3 months to make an investment decision, it's not hard to see why it's really confounding. Like within 3 to 4 months, something can be twice as good or half as cheap. So it's a really confusing spot to make investments in. So we see there's numerous factors that make sort of an allocation of capital to defence, we think, really quite beneficial. I'll pick some of the eyes out of this because this keeps ticking down. AUKUS, much is made of AUKUS. AUKUS is a three-nation project between Australia, the US, and the UK to essentially purchase 3 US nuclear submarines, then build 5 submarines here. It's a $372 billion program over 32 years. I don't think anything we invest in here will ever go near a nuclear submarine. But what will happen in this sector is that hundreds, if not thousands, of engineers and scientists will come into this sector. They'll work for a large defence company. They'll have a better idea. They'll get annoyed. They'll start their own business in defence. So there's all this activities coming into the sector. The other thing that AUKUS did was it actually liberalised the transfer and the trade in defence goods and knowledge between those 3 nations for the most part. Loosely before November last year, that was governed by something called ITAR. ITAR is a set of regulations out of the US that the US force on their allies with respect to military and defence technology transfers. If we're going to build 5 of their submarines here, there's no way known that could stay in place. So for want of a better purpose, Australia is going through a process of becoming the 51st state of America with respect to defence technology transfers. So we're being brought inside the tent to make that easier. There's some things we'll never get a hold of, nor should we. Specifically in that legislation, nuclear weapons secrets weren't included, nor were implements of torture, which is a good thing too. The really curious thing in the whole defence investing environment was that Russia used to be an 18.6% supplier of global arms exports. And the latest set of numbers here, which I think I've got, I do, cool. They're down to, I forgot what they are now, they're down to 11%, almost a bit over 10%. So in a time when militaries are expanding their budgets, one of the largest supplier of military goods in an export sense in the world has been much reduced. So in essence, they've been embargoed. Everyone understands their systems aren't that good, to be honest, and they have to refuel their own arsenals. So there's been a large player from the defence export moved. Now, in those 50 countries that Australians can sell to, Russia wasn't a huge supplier as well, but it was a material supplier. So, which is sort of one of the more curious aspects to this. Now, defence is or was hard to invest in. There was a perception of a single customer risk. Your only customer is the Australian Defence Force. 50 countries out there that we can sell to. Each one's got an Army, Navy, Air Force. God bless America, they've got Coast Guard, Marines and Space Force as well. Each one of those has an organisation that can buy off tender. You can ring up the purchasing officer, and if they've got if you've got what they want to buy, you can sell it to them in a very low document process. Taking months, not years, would be the best description for it. Is it easy? No, but it's a lot easier. So there's a lot of customers out there, so it's not the single customer risk. Defence is mostly hardware. When we look at defence, we're trying to think about the 5 pillars of defence. So defence is broken into the 5, domains of defence: sea, air, land, space, and cyber. Then we look at portfolio construction. We look at hardware and software as well, given the different return profiles there. So very conscious of how you actually build a durable portfolio in this space is to understand, I suppose, the components that make it up. And ESG. ESG keeps people out. ESG is just a societal pox. It's a very, very, very sort of high-minded first world consideration that only exists in robust Western democracies, which, to be quite blunt, are defended by robust men carrying heavy things. So ESG, for irrational reasons, keeps people out of the market. I actually like that because, to be honest, the opportunity in defence is on the buy side. Because everyone's scared of defence, either for ESG reasons or for other reasons. You tend to make a lot of money on the buy side. So defence equity is well priced. Done that slide. So how do you make defence easier? Forget the small customer. The allied defence market is currently $1.7 trillion US. The Australian defence budget's $35 billion US. Even if the Australian Defence Force was the best customer in the galaxy, you should ignore them because they're just too small. So the biggest customer in that is the US at 0.9 trillion, growing to 1 trillion. Europe is growing from 385 billion to a bit over 500 billion in the next couple of years. Lots of big customers out there, lots of easier customers out there. In the US Department of Defence, there are 265 organisations that can buy off tender. In Australia, there's 7. You really can't build it and they will come in defence. That just does not exist. You have to find a demand signal. So everyone publishes, well, all the Western democracies anyway, publish their demand signals. The Yanks are great at it. They'll talk about hypersonics, so they'll talk about drone, counter-drone, whatever it might be, naval warfare, mine warfare, etc. Then you find a unit with a budget that can try your thing. So you find one of those 265 different units out there that can essentially buy it, and they've got a budget behind it. So you can get it into the hands of a person who will test it, probably in very real conditions. But you better hope it works, because if it doesn't, there's nothing worse with a soldier with a toy that doesn't work. They'll talk about it forever. But you can find very, very proactive, very front-forward buyers out there to get your product in the market very fast. And portfolio construction in this space is massively important. We went through before about the 5 domains: sea, air, land, space, cyber, and then hardware, software. You have to really understand where all that lies. And hardware, as we know, it's well named. As an investor, it's really hard to make money from compared to software. And there's lots more momentum coming into the space. There's some standout names here. Andrew, Palmer Luckey's company. If you know Palmer Luckey, only a California skater boy can have a name, Palmer Luckey. But he had the company called Oculus Rift, sold to Facebook for $2 billion, poured a lot of that capital into a defence prime called Andrew, who have a large part of their engineering bases out of Australia, actually. He sort of appropriated the old Boeing Skunk Works workforce. So they did a round recently. They raised $2.5 billion on a $25 billion valuation, only after October last year, raising $1.4 billion on 14. So very much go ahead, seeing a lot of these contracts out there at the moment. So there's a lot of money coming into this at this point in time. The US does not have the hang up on ESG that Australia does. They're very, very proudly, national security focused. When I pitch in Australia, as an example, I always talk about how I'm going to make money for my investors. When I pitch in America, I always talk about protecting democracy, because it's just a difference in audience. So that's me. I've actually got 2.5 minutes spare. I don't know where Steve or the host is. If I can keep going or take a question or two, I don't mind taking a question. Oh, you're just there. Sorry, there you are. Societal pulse. Environmental social governance. It's basically, I don't really know what it does other than sort of rip off people who contribute to super funds. I want something good about it. So there's a perception in ESG that defence that if something does harm, therefore it's not a societal good. So whereas I believe defence of the realm is a societal good, to be quite honest. So difference of opinion. ESG hate us, we hate them. We call it a draw. Yeah, so there are particular. We have a defence-oriented VC fund. Beans and Venture Partners, come and see me for a deck. That's all good. So generally, we target sovereign Australian businesses. We're an ESVCLP fund, so we have to do 80% of capital inside of Australia. We target businesses that do not sell to the Australian Defence Force. We think the Australian Defence Force not only is a small market, but it's the most dysfunctional market in the allied world, and it's actually a sovereign risk to our businesses. So we ignore the Australian Defence Force. We will only, however, invest in businesses that produce products that the Australian Defence Force would use legally. So no weapons of mass destruction, no landmines, which is a shame because they're pretty cool. We've done 3 investments so far. One in the space reconnaissance area, so non-Earth imaging, a business that uses spacecraft to take pictures of other spacecraft. We've got a business that has a hyperspectral sensor. Think if you've ever seen the movie Predator, like Predator Vision, basically, which is pretty cool. In a small package you stick on a drone. And then the third one, which I should remember, is a business that does digital twins of constellations of spacecraft. Space is 80% militarised at this point in time. There's a looming conflict coming in the Indo-Pacific, and what happened recently with the US withdrawing military and intelligence support, or the threat of, or actually withdrawing military and intelligence support from Ukraine, and the implied threat to their allies was stark, and now everyone is racing to get more assets into space because that's the biggest gap that the US would actually withhold. So that's actually got everybody terrified, to be honest.
All right. Do we have more questions? Okay, that's it.
No. I can talk all day.
Yeah, just sort of wondering on how you see the impact of confidentiality and transparency on values with some of these companies.
The impact on
value.
On value, right? Yeah. So look, it's hard. So we don't have a single person inside our company that actually has a security clearance. It would. And we don't want anything other than commercial and confidence information. It would triple the cost of the business, understandably, for security reasons. So we work to what we call minimum viable capability. So typically, what happens is defence non-dilutive grants have created these things. They've been accepted by the Defence Force, and then it goes into a valley of death. So we take the capability from the valley of death, and we fund it into the US. So we do have one person inside an organisation with a defence clearance, but he's still a serving member. But he doesn't bring that in. So it is hard, and so you have to have very exceptionally trusted networks, and I can take you through our advisors that we use in the business as well to moderate a lot of those risks. But for the most part, it's something everybody wants, but the Defence Force doesn't know how to pay for it.
Welcome back, everyone. I hope you all had a refreshing lunch and are ready to dive back into the afternoon sessions. We now have a fantastic panel lined up to discuss a dynamic and exciting area of the investment landscape, which is the early stage venture capital investment trends. This session will explore the current opportunities, challenges, and key trends shaping investments in emerging companies. Leading this discussion, we have a panel of highly experienced individuals at the forefront of early stage investing in Australia. Please welcome Maria Halas, the new ventures lead at UNSW, Yash Varma, the founder and general partner at Empress Capital, Georgie Turner, partner at Tidal Ventures, Ben Simai, investment manager at StartMate, and Maxine Lee, the COO and Investment Director at Scalata Ventures.
Good afternoon, everyone, and welcome to this early stage investment panel where we're going to discuss how the startup ecosystem has been changing. My name is Maria Halaz, and I lead the new ventures at UNSW. In our portfolio, we've got about 140 deep tech companies, quantum computing, AI, biotechnology, advanced materials, etc. Next to me, I've got an esteemed panel, but before I introduce them and before we launch in, we only have about half an hour to talk about some really important topics. And why early stage investment in this forum? And one of the reasons is that while we've been used to the thesis of investing in early stage companies, of really, several years of hard slog and bootstrapping and then, raising some money, scaling, and if we're lucky, then we make some money. That kind of paradigm has completely shifted. And when you look at companies like Lovable, I almost forgot my companies, and Midjourney, these are the companies that can scale, and even in Australia, when you look at Perler, these are the companies that can scale within a few years from 0 to 1 million, 10 million, or even 100 million size. So I guess the question is not whether the way we invest in these companies is going to change, but how we're going to respond and how the way we invest in them is going to change. So with this, I want to introduce the panel. Next to me sits Yes Varma, who is from Empress Capital. And I've got Georgie Turner. Georgie is from Tidal Ventures. I've got Maxine Lee from Scalata. And I've got Ben Simai from StartMate. And by the way, Ben shares a surname with half of my family. And I haven't had the opportunity yet to figure out why. But we'll do that after the panel. So first question to all of you. Can you quickly put us in a picture of how you fit into the startup ecosystem? Yes, maybe we can.
Excellent. Sharing is caring. Yeah, look, my name's Yash Varma, founder of Empress Capital and general partner. Look, we're a VC focus on early stage AI companies, so hence we've talked a little bit here at Wholesale Investor, but we're really excited by what we're seeing right now. We think this is a once-in-a-generation opportunity right now, particularly at the early stage, and so we really believe AI is changing the way companies will be structured, how businesses will grow, and so we think it's a massive opportunity. Hence, that's where we're looking at.
Thanks. Good intro, because I think that sentiment's probably well shared. So I'm Georgie Turner. I'm a partner at Tidal Ventures. We are an early stage technology investment fund. We're on our third fund at the moment. So we've got about 30 portfolio companies. We are currently investing a fund that will be about a $50 million fund size. And we will go out and just specifically find the best AI native software companies that we can find in the Australian market that are expanding from Australia into the US. So we've got about 6 investments so far in this fund, and we'll do another 15 or so. In terms of where we fit in, we're looking at tracking the early stage ecosystem and founders who have probably been chipping away at an idea for about 12 to 18 months, and we're coming in and giving them their first, I would say, institutional capital as a fairly large minority holder in the business that supports them through to a US Series A.
Hi everyone, Maxine from Scalata here. We are an early stage VC fund based in Melbourne, and we look to back founders that we think have the unique insights and the endurance to build category defining companies. We have 2 funds under our belt on to raise our third fund, so very much in that emerging fund category as well. And we tend to lead most of the investments that we make. I was telling Yash over coffee earlier that while we're a generalist fund, we do like for our founders to be specialists and people who come from specific industries and verticals where they do have that domain experience. They've been deeply entrenched into the ecosystem of that market. They know where the problems are. They know where the pain points are, and that's why they're on a mission to solve them.
Cool. And I'm Ben from StartMate. Can I just go rogue for 1 second here? This is like definitely not my usual crowd or room. Would love to know, and I was just listening to the panel before and kind of everything that was said there, very different side of the market, all about defensibility and being conservative, and like we're at the complete other end of the spectrum here. Just so I understand who's in the room, like by show of hands, has anyone heard of StartMate here? Okay, probably like half the room. And has anyone like invested directly in an early stage startup? And like mentored early stage startup? Okay, cool. So yeah, Ben from StartMate. We are kind of like the epicenter for early stage startups in Australia. We're kind of like the YC of Australia, if you know what YC is. We raise funds every 6 months. We invest constantly through every cycle in about 30 to 50 companies every single year. Really early stage, that's where we like it. We have our thesis all around founders, so we're completely industry agnostic, and I guess we can dive in from there.
Thanks, guys. All of you have been talking about founders, and of course, when we invest really early, there are a couple of things we look at, and the most important thing that has been in my list, at least, is the founder, the quality of the founder. Now, how has it changed in the last few years since you're looking at these much smaller teams, where a team of 3 people can take a company to $1 million ARR? How did your requirement for the founder change in this environment?
Me first? Well, look, we're a relatively new fund, so for us it hasn't changed at all. It's always been the same. I come from a founder background, so prior to starting Empress, I had a software business for 20 years. So for me, and probably to add to that, we have a team that's both technical, so people who have founded AI businesses, exited those businesses, and I've got a high-performance coaching background. So we try and bring that really into what we look for in founders. And so it's really around, this sort of coachability. We look at the founder's ability to stay the long term. And if we look at the number one success factor for people, the word grit often comes up. There's some science behind that. And so we're often looking at why is someone going to stick with this company that they're starting over the long term? And money is only one part of that. And so looking for those traits, looking for founders that really not just understand their domain, but they can build, have the right sort of mindset is really important to us as well.
Anyone else wants to add anything to this? I guess what I'm thinking of more like the companies are changing from where you adapt AI and then you use it in part of your company, which still hasn't started yet, but let's hope that that's beginning. Instead of that, really, we're looking for AI native founders. So is that happening in your view? Are you looking at that in your company?
Yeah, absolutely. And I think our investment focus hasn't changed despite all of the growth and momentum in AI as a category. What we hold strong to is a problem-focused approach. So what is the problem that you're solving? What is the pain point? Is there a significant enough group of people who have that problem? And what unique insights do you have into the market? And what we find is that the industry insiders usually know how to navigate a skeptical audience. So they not only know where the friction lies around the edges when it comes to these industries, but how best to navigate a sales cycle that's unique to their background. Where previously we were open to, plucking founders out from large tech company X and having them work in industry Y, I think where we've seen success in our portfolio, at least, and I'm not saying there's one approach that's better than the other, is that person who understands the industry nuance. They usually have the patience to understand that specific set of problems that need to be solved, and usually have that frustration so that over the long haul, they're committed to solving that for their customers as opposed to someone who's been dropped in. So that's the way that we think about it.
So, of course, we're talking about grit and perseverance, which probably hasn't changed that much over the years. Now, Ben, you're in the middle of drilling down from 700 odd companies to 10 or 15 in the next program for StartMate. And you're in a cold face of when you're looking at founders. What are you looking for in the founders?
Yeah,
that might be different than what it was maybe 5 years ago.
Yeah, I think there's a lot of kind of maybe fear around AI and how it changes everything, but really it's just become like, it's not even an industry anymore. It's just a new layer that every company is now an AI company. If you're not using AI in your company, you're kind of behind now. So on that front, I don't think much changes from the way we look at companies. The only thing that really has changed, which is great for early stage startups, is that the expectation around speed has just gone up. So you can do a lot more with a lot less. It used to be maybe a few moons ago where a company might come to you and say, hey, I want X million to build out a prototype. But that's just so far from where we are now. You're expected to do way more with way less. So a company of 2 people, couple of co-founders can do so much and build out an entire company just with just themselves and a few coding agents now with Codex and all the latest that's coming out of the AI world, which is really exciting. And also gives them, if startups weren't already a threat to big companies, there's so much more now because the big corporates are taking way longer to get AI involved in their companies. And so early stage startups have probably the biggest advantage they've ever had in history. So it's a really exciting time.
And you started to talk about the metrics that you're looking for, and one of them is, of course, burn rate to profitability, and that time has constricted, and so did the number of people you're going to need. So what are other metrics that you'd be looking at?
Yeah, it's really interesting. Like a lot of people, and it depends on your stage, look for different metrics. We have a really foundational, simple approach to investing, which is all around people. I think outsiders come into the space and think we're stuck in spreadsheets. It's like the complete opposite. It's all about reading people and the foundations of what makes great outlier founders. That's what we look for. Like there's no metrics we look for specifically. It's all about outlier founders, and that hasn't changed. Like we're looking for now in the 700 companies, we have a specific system and a framework. And I think a lot of people who are new to the space or coming into the space, you ask experienced venture people, what do you look for? And they'll often tell you very implicit knowledge. I have all this experience. I've invested thousands of founders. I just know when it's the right time to invest. And because of StartMate, we have to teach other people how to invest. We run a program teaching people how to invest in early stage startups. We've made a really explicit framework that's really stood the test of time. We've been running it for 10 years now. And it's a really powerful way to simplify all the confusion around early stage startups and focus on the foundations that matter around the people building the business. Because we're at this stage of the venture ecosystem, we're building a portfolio of people, not a portfolio of companies. And so it's actually quite simple when you drill down into it. You can kind of forget all the metrics and focus on the people and what makes them amazing. And that makes it a really simple way to invest.
Yes, I guess with StartMate, you're looking at really, really early stage investments. Yes, what's your view around metrics? What are you looking for, given that you're probably investing not at the very early kind of accelerator stage?
Well, look, we do invest early. We primarily invest in that sort of pre-seed seed stage, but we do look at later. We have a few later stage companies, and in fact, we have some really later stage ones with companies like Anthropic that we've invested in earlier. Look, I think it is the sort of big thing we're looking for. It is coming down to people. AI, and our focus is AI. I would say one thing for sure. AI is not the product. AI, it does come down to that ability to learn and adapt. And I think in this current market, with the changes that are happening so quickly, there's a couple of founders in the room I know today that I've had conversations with, and we've talked about I've been freaking out about over the weekend about this VO model. If anyone has not seen this VO3, it changes the way video, changes the way we're going to have creativity in terms of video, and I think it's understanding how do I take these new technologies that are coming on and build businesses on the back of it that have some long-term value in it. So, I mean, when we're looking at metrics, sure, we can be looking at ARR and we can look at all these things, but one of the things with this phase, I think, is that a lot of the companies don't look like previous companies have in terms of metrics. And so if you look at, so I'll give you an example. We have a legal AI company we've invested in. We're seeing the uptake of that go through the roof in terms of exponential use by lawyers of this product. And they're the indicators where we start to see that, hold on, people are really finding value in this. So we're looking for where we have these signals of use of the product is really growing. And so for us, that's a really good sign that the technology is finding that sort of product market fit. That's a big thing for us. And obviously there's all the financial metrics around ARR and getting to a particular level.
So I'm not answering any particular question. I'm just going to keep going on that thread. So what we're seeing now is you've got these kind of entry-level land products, and they take various different forms. Transcription's a common one. Just simple information retrieval that never existed before is a common one. And these land products, and you guys will be familiar with this, they have massive wow factor on land in a way that your land products in traditional software just never had. So, in traditional software, you'd have to really convince the user to cough up. And now there seems to be a willingness to pay or adopt new tooling. And really, you could say that is just coming from the billions of dollars that has been invested in the underlying platforms, that CapEx that's gone into those platforms has created the ability for an app to exist and scale to $1 million of ARR without actually that much product built around it. That's not to be dismissive of those applications. I think that some of those applications are very interesting. To Ben's point, when you find a founder that can take that as a land opportunity and acknowledge that revenue as potentially, I've heard it called curious ARR, and they can go from there to say, I'm going to build some interesting sticky workflow, or I'm going to go and find some proprietary data or accumulate some proprietary data, like in a legal AI, for example. And from there, I am going to convince the customer to pay for my tool, not necessarily as subscription software, as we were always accustomed to, and I'm going to deliver you another feature. That's going to be par for the course. In 5 years, there'll be 10 things that look just like you. It's more, can I start to convince the customer to acknowledge the fact that this tooling and this workflow is creating higher ROI than software ever created? And it's potentially becoming agentic, it's potentially becoming multi-agent, it's starting to interface with my other systems, it's reducing the need for me to hire a person to do that job. And then we are starting to get closer to this point of what AI really should be, which is charging for the work that it is doing. So we call these systems of work, and it's an evolving sort of thesis that is starting to play out. I think we're seeing very, very early first wave of this. But it's effectively the promise of like a cursor, for example, for other applications. I think there will be a lot of really early ones that will go quickly: call centers, legal, professional services generally, software development and accounting are really natural applications of the technology. And then there will be other industries where it will take a little bit of time. So, because you are trying to convince a user to adopt a different kind of way of interfacing with technology. And then you need a founder who is willing to sit with that workflow for a period of time and do the work that the big horizontal players won't do, and go really deep on a vertical and understand the gray between the black and white data and the tacit knowledge to be able to build something that is actually agentic in its capability.
Yeah, sure. I was just going to add to Geordie's point around having an initial wedge into that ecosystem. And I think for a lot of the founders that we back who've seen success, they originally have a product in a very text-heavy, manual, inefficient industry, but because they've identified that as a salient point, and this is where some people go, you're crazy to do the amount of DD that you do, but a number of years ago, we looked at this borehole logging software company, Tablogs, that we ended up investing in. And I remember when I called up one of my LPs, who was a geotechnical engineer, just to do a bit of light market DD on, is this really a big annoying pain point? And he literally holds up a stack of papers. It's like, you need to see the amount of stuff I have on my desk. It is so manual, it's so inefficient. This is terrific. And it usually starts off as, a wedge of what would be quite a niche industry, but the power that that founder then has is they can then build out from that wedge into what is the operating system for these types of geotechnical engineers. And it's because he has that industry insight and that knowledge and that insider knowledge that makes it quite unique.
Thanks, Maxine. I think we're kind of juxtaposing the threat, Google and the big wallets coming in with their LLMs and, fundamentally spending and requiring enormous computing power and huge budgets. And then what the other side is the opportunities, which is solving real problems, which probably hasn't changed. For our investors here, because as you could see from the hands, there are plenty of investors here who are interested. Could you all, and maybe start with Ben, and then you can share the microphone. Could you all just highlight maybe 2 or 3 opportunities that you see in that ecosystem?
Around AI?
Keep it AI for now. Yeah, we'll have some other areas later.
Yeah, sure. As I say, like AI is just the foundation layer for everything now. So it's like kind of not that interesting in some respects. But we've kind of seen 4 categories. You've got the kind of hardware that sits underneath all of AI, like the data centers. Then you've got the LLM layer, which is all the big companies are playing in that space. And you've kind of got where most startups that we're seeing are playing either in the consumer space, applying it there, or in the enterprise space. And so in terms of opportunities, I mean, as I say, every company we're looking at, like the 700 companies, pretty much all of them will have some element of AI involved in them. So it's just everything's AI now. That's what I'm trying to get across. It's not like a specific couple of companies, a couple of opportunities. Everyone's playing in the space, and it's about where they're playing across that ecosystem. And as I say, most of the big players, the big funding, the big capital expenditure is in the hardware and in the LLM space. Very hard to compete in. But then in terms of the consumer and the enterprise space, I mean, the world's your oyster. It's amazing. Everyone's still figuring out how that's going to work, and that's the really exciting space right now for early stage venture. Yeah.
Maxine?
Sure thing. Just a couple of thoughts. I think when it comes, and I agree with Ben's point in that it's a part of everyone's roadmap. Otherwise, you're left behind. I think one thing to consider is with technical barriers starting to lower, I think the commercial and distribution hurdle has actually gone up. So it's not just about what wrapper you're building around these models for a specific application, for a specific segment. It's also what kind of unique advantage do you have to distribution? What kind of unique advantage do you have about your market? And how do you think about that moat? And how do you think about defensibility? There's a lot of noise out there, and I'd say, more than 50% of the leads that we have coming through our funnel each week are now companies that claim to be powered by or driven by AI. And I think Georgie mentioned one of the metrics earlier around curious ARR, which I like to call experimental ARR. So you'll sometimes see companies that have had this explosion of ARR interest in customer growth in the first 3 months, only for those customers to churn really quickly thereafter, because what they've been sold is they've been over-promising and under-delivering the product.
So in terms of specific spaces, I spend all of my time looking at vertical applications. So I think particularly out of Australia, anything infrastructure layer and sort of middle infrastructure layer and then horizontal layer is just difficult to compete with. And I think, in general, whilst Canva was a massive success, just the odds and the likelihood of having another Canva is extremely low. But what we do have in the Australian ecosystem is like quite a lot of really deep technical capability within specific verticals. We've got a really strong professional services market. So I actually think we have quite a right to play in anything legal, accounting, broking, that kind of world that needs a lot of automation, I think, and someone to sit and actually do all the integrations required and do the end-to-end kind of workflow build out to service that customer set. I think there's a bit of opportunity still there, although that will get a lot of competitive tension globally. I think you want to look at like where Australia really shines in like product development capability. So wherever we have like specific industries where we create our own products, insurance, fast-moving consumer goods, we're quite strong on retail, although highly concentrated. So just like specific areas where we tend to have big players, where we have a body of like concentrated expertise, I suppose, in a founder set that would be able to come out and apply the technology. I think that the first wave of this comes through from the automation of workforce. And so I actually think that in-field workers were really poorly underserved by traditional software because we didn't have multimodal. It was pretty hard to get anything on the edge on your device. You couldn't do we didn't have voice, we didn't have video, all of these like amazing modes that the LLM seemed to interact really well with just were really underserved. And so I think anything in like aged care, healthcare, construction, anything that can serve the end user of the product really well in the field is actually going to be quite explosive in the first wave.
Yeah, the consumer end. Yeah. Yes?
Yeah, excellent. Look, I think we're investing in all of those. As we do really focus as well on that, what we call vertical AI. There's probably a couple of terms that we're sort of seeing a lot of. That you know, there's a lot of AI washing, so everything is an AI company. We're seeing a lot of AI tourists that come along, and this ARR that we're talking about is people come along and they don't really use the products. But I think particularly that vertical. The other thing that we like to see is, you know, we're not scared of investing where there is some hardware components, where there is something else that's unique. Whilst we don't, you know, you could argue building on top of some of these large language models, is that really a business? But if we go back to the early days of the internet, you could argue the same thing about building on a database, and there's not a lot of defensibility of something like Facebook or, you know, many other applications that we use a lot. So, look, I feel like we are just seeing, you know, on specific areas around, you know, robotics and genomics. We haven't seen a lot of those things that are going to come out. We're really excited by what we're seeing, but I really feel like there's just these new business models that are going to come out, and we haven't yet seen those. So I'd say we're at two phases. The first phase is this automation. The second phase is the new business models, and realistically, we feel if we can get one or two of these businesses, they're going to really give us some amazing returns.
For the investors' sake here again, can we also highlight some of the risks in AI and generally in that field? And just focus on AI for now, because obviously it's got a very specific risks attached to it.
Look, it's a high risk, high reward, without a doubt. And you know, we are rapidly changing. So when we started this panel session, we talked about what do we look for, and we talked about people. If you fall in love with your product, you are screwed. And so you have to continually evolve, and you have to look ahead. And a lot of what we think about is, you know, there is a bit of history here. If we start to think about what could change, I think it's really important to really be looking ahead of what could happen, but build on top of not just features within a, you know, an LLM or anything like that, but what value can you build around all that? And so ours is, the more people, and I had this conversation with someone already today, which is humans are inherently lazy. So if you make it really easy for people, even if they could do it themselves, they probably won't.
Yeah, it's obviously a high risk because it's relatively early. So I would just, focus on the fundamentals of what does tend to de-risk. The best thing that can de-risk in the first couple of years of an early stage investment is having a really solid, ideally 3-prong founding team of people who have like really good deep core technical capability. So people who are on the tools that can build something without necessarily needing quite a lot of funding behind them, because they can go pretty far with very little now. And I think obviously, you know, early stage VC, embrace the risk, talk to people like us who do this every day for a living, who obviously have worked through how to do this at a portfolio level and still deliver a really good return whilst managing quite a lot of risk in the portfolio.
Men, 10 seconds each.
Oh gosh, okay. I think the way that we're thinking about this, maybe for some of the more deeper tech AI applications, maybe in health where, you know, the stakes are a lot higher, I'd be thinking about capital efficiency, and it's our job as investors to think about what are the inflection points or chapters that make sense for this company, and will they achieve those inflection points within the life of our fund? And have they thought about products in the near term that maybe have more market-ready customers that are willing to validate the commercial viability of what they're building in the long term?
Yeah, maybe just finishing on a call to action. I mean, I think the real risk here is not being involved, like sitting on the sidelines and not engaging. Like the closer you are to tech, the closer you are to future opportunity, whether that's as a country, which we need a hell of a lot more innovation, a lot more ambition, at a company level, or at an individual level for you, your kids, the future generation. Like get more involved at the edge of technology. Like StartMate is the earliest you'll see. Come speak to me. Like we have our funds, we cap them at 3 mil per cohort, and we kind of have maxed those out. But come speak to me and get involved. We're selecting right now. We let people into that ecosystem. We let you see it. We teach people how to invest in startups. So come speak to us, get involved in the ecosystem, because the biggest risk is just sitting on the sidelines and you know, out of fear or confusion or whatever it may be. Get involved, start mentoring, see the startups, and you'll be well positioned for whatever comes next.
Thanks, panel. It was fantastic. We will have one question if anybody's got a question. We're actually out of time, but I just wanted to open it up to the audience. There is one question over there. There you go. You know what? I'm going to stand up and take the microphone to you.
Hi, my name is KPS Kohli. Excellent panel. and we do see a lot of AI adoption. So I'm a lawyer back home, and I did hear Mr. Verma speak that they invested in a legal tech, AI legal tech, and also medtech. I heard. So I just wanted to understand that as lawyers and also as medical professionals, AI will reduce a lot of probably the brain work that is involved, the grunt work that is involved, where there's a lot of brain is used. That will, of course, reduce the cost for the lawyers and maybe for the client. But how do you value all this? Because ultimately what AI will do will reduce the number of billable hours for the medical professionals and also for the lawyers. So how do you value this? Because ultimately for an AI product, the customer is the lawyer. It's not for the individual. Because if you want to make an investment, you don't go to an AI and ask him questions and decide your investment on its output. You have to go to a lawyer and also his experience, and then you take a decision. And we do see, and as a lawyer, I can tell you, we do see where lawyers got it wrong. And so the question is, how do you value it? How do you value an AI startup, which is based on law or medical?
Some of our panels don't actually value yet because they're early investors and they might invest in safe. But those that are,
No, I think it's a great question from a not necessarily a numerical how do we value it, but every industry is having this question. So you use lawyers as an example. There's a new business model that's got to happen because the value, there's a race to the bottom otherwise, right? So you could argue I'm not going to use these tools because I'm going to bill less hours, which is what probably comes to mind for most people. However, as soon as your competitors start doing that and start to realize they can take on more customers, then maybe they could charge less. And from our point of view, with something like law, we go, well, isn't it better if people could have more affordable lawyers or legal fees? If we talked about medicine, we talked about almost every industry. If we talk about coding, couldn't we have cheaper ways to develop software? Now, if you're in those industries, you might initially say, oh, this is really bad. But I think what will happen is that people will be more productive. So we think there's a 10x productivity benefit to almost every industry from using this. So when you say, how do you value it? We value it. I mean, we think for the winners, it's going to be 10 times, 100 times more valuable than what they're doing. And we're seeing that. We talked about Cursor, a software company that helps people develop software. 1 million one year, 100 million the next year, just rapid adoption. I'll just pass this on to my colleagues, but I feel like there's massive value in what we're seeing. It may feel like it's devaluing, but for the winners, it's going to be really valuable. That's why we want to invest in this space.
Thanks, Yash, but we won't have time for any more answers, and I think you've summarized the response really well. Thank you very much.
Well, that was truly an engaging and insightful discussion on the trends shaping early-stage venture capital. Thank you once again to our panelists for sharing their perspectives. Now we continue with our showcase of exciting company presentations with Alex Bank. Alex Bank is Australia's only 100% digital retail bank, driving scalable, profitable growth. Please welcome their CFO, Craig Fenwick.
Thank you and good afternoon, everyone. Hopefully I can make this work. Is it forward for go? Yep, excellent, thank you. Introducing to Alex Bank. So we're Australia's most awarded new digital bank in the country. And, you know, if you think about it, where did we come from? We've come from an environment where we have some large, very large banks in this country who've pulled back from very profitable parts of banking over the last few years. And what we've done in response to that is we've developed a bank that's purely digital and focused on niche parts of the market and using significant levels of technology across our business to operate in a very fast, simple manner and to operate extremely efficiently for the benefit of our cost structure. Certainly where we're focused is we currently built the foundations for very strong and sustainable margins, a low cost of risk by focusing on high quality borrowers in Australia, and because we're a bank, we can access low cost deposits to get more revenue and also to serve more customers. Right now, some of our competitive advantages that we have are by being a bank versus some of the non-banks out there and being able to deliver using our digital-first infrastructure, extremely rapid onboarding of customers and managing risk very, very carefully in terms of both our losses, but also the risk of customers in terms of KYC and AML and making sure that we're dealing with customers who we know and who can make sure that they can deliver value for us and we for them. Where are we focused? We're focused on retail banking across the consumer part of banking, auto lending, as well as small business banking. And what's making us really accelerate now is the fact that we've got distribution digitally across finance brokers and other intermediaries, partners such as Qantas Frequent Flyer, and a number of other platforms that allow us to access customers on a B2B2C operating model. From the point of view of our customers, we are now delivering NPS scores in the 70 plus, and for our customer satisfaction, 4.8 out of 5 stars on Trustpilot. We think that that's the cornerstone of what we're delivering for our customers is speed, efficiency, and simplicity of operation. Because we're 100% digital and the only bank that's fully in the cloud today in this country, it means we can operate very safely, we can operate across jurisdictions, and we can operate when things go wrong as well, when we have natural hazard events. That means that we're operating without physical infrastructure, which means that over time we can be one of the lowest cost providers of banking services, not only in Australia, but compete in that category globally. Our scalable channels are all open today, so we have 1,400 finance brokers onboarded on our platform of the 20,000 brokers that are active across the Australian banking industry. And that means that we can access the majority of the market through the broker community, and those loans are onboarded from brokers digitally through our platform, and they're operating in the same way that a customer will come to our front door digitally. They come to us from a broker digitally as well. We are able to onboard a customer in a couple of minutes to actually get them into a financial services product, and then a lending product, make an instantaneous credit decision and have the funds with a customer within 2 hours of having applied for a loan, which competes very well with existing banks who can take up to some weeks to deliver the same outcome. We're highly efficient, and that's really driven by our proprietary technology that we've built to support straight-through processing and an end-to-end ability for us to not touch any loan applications and customer applications. So we don't have people touching any of our deposits as they come through our systems. And for over half of our lending, there is no requirement for human intervention. The technology does its work. And that's using Alex Intelligence, which uses 1,800 different data points to enable us to score a customer using a variety of digital waypoints, including credit scores, previous history, and their own data that enables us to price it effectively and make sure that we're operating within our risk appetite, so lending money to people who will pay us back. Because of that, we're also managing our risk maturity, and we're currently focused on building a bank that allows us to accelerate growth, but also taking measured risks. And that's really important as an Australian deposit institution and with the great privilege of looking after people's deposits. And from a team perspective, we have 40 souls working across Brisbane, Sydney and Melbourne who are all invested into the company in one way or shape or other and have joined the company to build something that going to make a real difference. Over time, we want to be the leader in next generation digital banking, and that's really about disrupting the Australian banking market and delivering for those highly profitable niche segments where the banks have moved away from, providing globally leading customer service and representing our customers every day in terms of working with retail brands that we'll affiliate with and do already to make sure that we're getting the best for our customers, both from our brand but also from other brands. We believe that achieving superior shareholder returns are possible from Alex Bank, and we're looking at being able to deliver a 20% plus return on equity, which is roughly double what many banks in this country deliver today. What drives that? Our low cost of operations and choosing niche markets where we can get an outsized return relative to the risk that we're taking on our products. And that's all about using technology to deliver both of those ambitions. We also have the opportunity for inorganic expansion in the Australian market, where there is a lot of fragmentation within non-bank lending and indeed in smaller banks and mutuals around the country. For those who don't realise, banking is one of the largest profit pools in the country of $40 billion plus per annum, and there are over $4 trillion worth of deposits supporting the Australian banking industry. And from a financial perspective, the price-to-earnings ratios and multiples for those businesses remain very strong. And so we see significant opportunity for investor returns within the banking market, which is also ripe for disruption. And as you can see here, from Alex Bank perspective, where we're achieving margins are at 3 times what some of the major banks are achieving. Our cost-to-income ratio at scale is less than half of the banks. Our return on equity will be almost double some of the major banks, and we're already achieving a net promoter score that's well into the high positive territory compared with the existing players who are largely negative or at 0, meaning that more than half of their customers actually think they're worse than the other half of their customers. From a market opportunity perspective, we see that consumer finance, which is $150 billion worth of lending assets, and small business, and we see small businesses less than $1 million worth of lending, is a $180 billion plus part of the market. So for us, we're focused on over $330 billion, where over the next 3 to 4 years, we're taking less than 1% of that market to create an incredibly and profitable business. Today, we have core products in market in personal lending for things like cars, home renovation, and other purposes. And on the pathway is small business lending and more transactional banking products. We're distributing those through brokers, strategic partners, and through direct customer channels, including our partnership with Qantas, which is where we're the first bank to introduce term deposits onto their platform. And that's all supported through our technology platform, which represents 5 years of investment to date in both our data streaming technologies, our data and analytical capabilities, and our API connections, which allow us to connect into platforms and also to make sure that we're operating extremely efficiently across our own technology stack. We're run by experienced bankers with a history in a number of banks across the country, and we have a non-executive director-led board of people who've had great presence both in capital markets, banking, and professional services. We're currently raising $10 million on an 80 money pre-money valuation, and that's to support regulatory capital to grow our lending assets and drive more revenue for the company. Thank you, everyone.
Thank you to Craig for providing a deeper dive into their work at Alex Bank. Next up is BankStack. BankStack powers banks with full stack infrastructure, disrupting legacy payment networks globally. Please welcome to the stage their CEO and co-founder, Evan Lau.
Thank you. Good afternoon, distinguished guests. I'd like to firstly thank Steve and his amazing team for coordinating this private capital event and for allowing us to all connect today. I'm humbled and very excited to share with you the story of BankStack. BankStack is a founder-led, self-funded payment infrastructure and innovation technology company partnered with banks. Our vision is to redesign payments as well as modernize payment infrastructure for banks and reframe their value proposition to businesses. Many banks across Asia are locked into payment ecosystems controlled by Visa and MasterCard. This has created significant challenges for product teams to launch bespoke solutions that meet the needs of their local market. Adding non-aligned payment networks and new innovations has become an integration nightmare, which requires extensive technological customizations which balloon project costs and delay deliverables. This has created a fundamental structural challenge for banks to keep pace with the local market demands and disruptive fintech solutions. Back in the early 2000s, Visa and MasterCard dominated all issued cards in circulation across Asia. At that time, there simply was no other option. Local card payment networks were a blip. Alternatives such as super apps and digital wallets weren't a thing yet. However, fast forward 20 years, and you can see the landscape has drastically changed. China's UnionPay now dominates the space with over 70% market share across Asia. Asia represents the world's half the world's population, and it is the fastest economic growth engine of the world. Fun fact, UPI is the world's largest card payment network with over 7 billion cards in circulation by over 2,400 banks. And here's the cool thing. UPI has chosen BankStack as its global technology partner to enable banks and merchants. But it's not only UPI. American Express, Japan's JCB, Alipay, and more have sponsored BankStack as their technology partner with direct global integrations into their payment networks. We have and continue to successfully disrupt a space that has historically been dominated by Visa and MasterCard. Now, in my conversations with governments, banks, and businesses, there has been a significant change in sentiment towards America. There is a real shared concern regarding systemic risks posed by their overexposure and reliance on American-controlled technology solutions. A tremor has occurred and a tidal wave is coming. Many of these stakeholders are aggressively seeking to mitigate geopolitical volatility and address trade uncertainty. BankStack has been engaged to de-risk these exposures and reliance on US and to some extent EU-based technology systems. Over the past 6 years, we have built a turnkey, battle-proven, fully hosted technology platform for banks to run their merchant acquiring business unit. We develop, deploy, and host bank-requested innovations which funnel up through all of their corporate clients, and we connect banks to any payment network. As a strategic partner to banks, we help remove all technical and financial barriers that would typically withhold innovation. Our customers and partners help us drive continuous growth of BankStack, creating a business model that builds momentum and reinforces itself as we scale. For example, payment networks recommend banks integrate with BankStack. Banks then bulk distribute our technology system, branded as the bank's own, to their entire customer base. Finally, businesses recommend us back to their other strategic relationship banks. We give control back to the banks, control over their payment innovations and technology ecosystem. We have enabled over 27 payment networks and growing. Our technology platform is architected for hyperscalability across geographies and regulatory boundaries. Our system and bank-requested innovations are designed for modular plug-and-play capability. We provide a secure and user-friendly portal for bank staff to manage their merchant portfolio. That portal is also used by merchants to manage their payment needs. Think of online banking, but supercharged for payment collection methods from any payment channel, digital onboarding, transaction processing with any payment network, fraud management, statements, reports, analytics, and all the various back-end bank-side technology systems that makes the entire ecosystem work. Here's a sample of some of the businesses that benefit from the infrastructure powered by BankStack through our bank partners. So we focus on partnering with banks and corporates across Asia. The market opportunity across Asia is approximately $13 billion per year based off of our existing margins with our banks partners. This excludes China, India, and Japan, by the way. BankStack has the right capabilities, and we are strategically positioned to make the most of this opportunity. Our leadership team has over 30 years of deep expertise in payments, technology, and banking. John, our chairman, founded WebPay in the 1990s, which was ANZ Bank's first payment gateway and their cornerstone investor. WebPay was acquired by eFunds and subsequently by FIS in 2007. John then founded Paycorp, a payments processor for ANZ Bank, NAB, St. George, and Bank of New Zealand, which was acquired by MYOB and subsequently by KKR in 2018. Stanley is our CTO and CISO. He has over 25 years of experience leading large technology projects for the Australian government. He has delivered strategic technology solutions for Westpac and led the digital transformation for critical Australian infrastructure in energy, water, and the Western Sydney Airport. Nina, our COO, has over 25 years of experience in corporate strategy and business development with Westpac, CNN, and LVMH. I round out the leadership team with my over 25 years of experience through an entrepreneurial journey. I started at 14, took over the family business at 21, and grew it to a 100% operation. I sold the family business and then went into investment banking for Citi and HSBC, where I advised clients on over $20 billion of strategic transactions across Asia, Europe, and the Americas. Together, we have built something fantastic. We've really enjoyed building BankStack since 2019, and we've achieved some significant successes. We've secured 6 banks across 3 countries, long-term perpetual contracts. We have forged strategic technology partnerships with global payment networks and completed acquisitions in 3 countries of Australia, Bosnia, and Sri Lanka. Thank you for allowing me to share our story with you today and providing a glimpse of why I continue to remain so energized about what we're building at BankStack. I'll also be speaking at the Alternative Investment Opportunity panel discussion later today, so I'll be around and I look forward to meeting you. Thank you.
And that was BankStack. It's really fascinating to see the innovation happening across various sectors today at Private Capital. Our next presenting company is New Orphan. They develop groundbreaking MS therapies to protect nerves and promote repair, transforming lives through innovative neurological research. Let's give a warm welcome to their co-CEO and CFO, Sean Cordes.
Thank you very much, everyone. Thanks, Steve and the team, for organising this conference, and it's great to see it being so well supported. My name's Sean Cordes. As in the introduction, I'm the co-CEO and CFO for New Orphan. This isn't the Australian Biotech Conference, so I'll try and keep it simple today. I'm actually a businessman by training. Our founder, our scientific founder, is actually presenting at a conference in Europe at the moment. I'm just assuming that a few of you might not know much about MS, so I'll just introduce the program to us as well. The investment case for this one is enormous. Multiple sclerosis is a huge market, and our therapy represents a blockbuster drug potential. I see here there's absolutely the ability to have over $1 billion worth of sales of our drug in the market, which can drive us to a unicorn valuation. In biotech, a lot of people avoid biotech investments because they're so long and they're so expensive to fund, but we're backed by 15 years of research so far. Our scientific founder, Dr. Stephen Petratos, is recognised globally as the preeminent expert in multiple sclerosis research. And me getting behind this project, why I'm so passionate about it, my other co-CEO, Liz Ferrentinos here, is the ability to drive huge social impact for something that has a huge unmet need. So what is MS? MS is an autoimmune disease and it destroys the myelin. Now, the way to think about it, if we're thinking about our nerves, is the insulation around it is the myelin, and the autoimmune response to this actually destroys the myelin, and the results of that are devastating. It's just, there's no discrimination about what it does. Blindness, paralysis, mental impairment, it's one of the most horrible diseases it can be. And very, very sadly, it strikes in the prime of one's life. So people in their 20s to 40s are the ones afflicted, and 3 times the number of women are afflicted than men. Horrible impact. MS has no cure. 3 million people today live with MS. In Australia alone, 1 to 2 people are diagnosed every day with it. Again, striking in the prime of life. Anyone here remember the 2000 Olympics? We have Betty Cuthbert, an Australian icon, 4 times Olympic gold medalist in a wheelchair, carrying the Olympic torch. And today we're dealt with the horrible news of Christina Applegate, again, a prime example of how this impacts people in the prime of their lives. Big Pharma is heavily invested in MS. Why is Big Pharma heavily invested in MS? Because there's a huge unmet need. It's because of its chronic nature and the long-term treatment duration. So billions of dollars are being poured into research. But none of them cure, stop, reverse MS. And that's where we come in. Diprotectome, which is the trademark name of our drug, which we have very strong IP protection around, does what other drugs can't do. It promotes remyelination. It repairs the damaged nerve insulation. And it has the potential to reverse it. Unlike the drugs that are out there, and I should have said that across all of the Roche and Novartis, etc., they're all called disease-modifying therapies. They're highly invasive. You have to go in for an IV, you have to go in for an injection, and what they do is they're just stopping your own immune system from causing further damage. So when we stop our immune system, we're exposed to other diseases. So cancer, all sorts of chronic disease happen, and that's why we see MS sufferers with such shortened lifespans. Ours is an oral therapy. So it's an oral therapy, very accessible for MS sufferers. It'll be a drug that they'll be taking for life. And that brings about the market opportunity for us. The market for this, as I've said, is absolutely huge. And we have a strong first mover advantage with a drug that repairs the nervous system, and it will transform the standard of care for MS sufferers. It puts us head to head with all of Big Pharma and makes us a very attractive target. So the Big Pharma at the moment have 19 regulated drugs in the market that are being given to MS sufferers at the moment that aren't doing anything other than what we call disease-modifying therapies. And for our drug, we represent not only what I call a monotherapy here, that you take the tablet for it, but those MS sufferers and their neurologists will be seeing us as being a combination therapy for stopping the progression of MS as well. And that makes us very attractive in terms of exit opportunities because we represent a portfolio extension to them. So we're in phase 2 human clinical trials now after this 15 years of research. We're getting very, very close to that point of having a drug in market. And every single one of those companies, the 19 regulated drugs at the moment, we're complementary to, and every single one of them would see us as being a portfolio extension to them. So this is our clinical pathway for where we're at the moment, and I'm just letting people know through the progression of a biotech, which can be very, very long. You know, we're not a startup. We're very mature in this business, moving into phase 2 human clinical trials. We're raising funding at the moment in preparation for those trials. We'll be recruiting 600 patients between Australia and Europe to commence those trials. And then after that, we'll move into phase 3 clinical trials in the US. And then we've got regulated drug in the market. So that's our timetable. Our ask is $3 million to conclude our GMP manufacturing of our drug that we'll be using in those trials and concluding all our preclinical studies. It's on a pre-money valuation of $30 million. Now, we have a chartered financial analyst that's done very comprehensive financial modelling on all of this to look at valuation and support. But when we look at comparables in the market, I can assure you that $30 million valuation at phase 2 is very, very, very compelling. And we're expecting that we'll double our valuation as soon as we move into our next raise on the next raise of our clinical program, which will drive us up towards a $300 million valuation as we look at comparables. Sorry, I've just come back. So it was on this slide I meant to say. And so I'm saying to everyone in this room is there is a potential to not only invest in a blockbuster drug therapy here, be part of a program that's going to deliver a scientific breakthrough and have a significant impact on what's a horrible disease. Thank you very much.
Thank you to Sean for sharing their important work at New Orphan. And finally, for this block of company presentations, we have Bay Street Hospitality. Following his earlier keynote, we now have the opportunity to learn more about their specific investment opportunities and strategies. Let's welcome back William Houston, General Partner at Bay Street Hospitality.
Thank you. Good to see everyone again. Cool. So hopefully most of you are here and I don't have to do like a recap, but I might as well just real quick. So Bay Street Hospitality is a fund we deploy out of Singapore, something called a VCC. The reason for that is various tax treaties that Singapore has that makes it more efficient for us to deploy capital. I started a firm called Bay Street Capital Holdings in 2018. And when I did that, we were recognized as Entrepreneur of the Year by the guy who did Shark Tank, Damon John. We were recognized as the fastest growing wealth management firm for diverse firms in 2023. We also got recognized as top 100 investor in the US. When that happened in 2024, I sold the business. We had a private hotel fund at the time, but I was very passionate about it. And so I decided not to keep that as part of the transaction. I guess for this would be sort of useful, I think. Why hospitality for me, right? So my father was a pilot, and growing like amateur pilot for fun, used to fly on the weekends every weekend. And my journey as an entrepreneur, the first 10 years I was in the Philippines, I owned call centers there that supported investment firms. So before I ever started a wealth management business, I was servicing New York Life, MetLife, MassMutual, Foresters. We had a government contract that handled the federal employees in the US. And when I got married, I took my wife to the Philippines. She said that she's not moving there. And so in order to stay married, I moved to California. And when I told my parents, hey, I own a call center, or hey, I own an investment firm, my parents' reaction was kind of like, yeah, just don't get in trouble, right? And my parents were teachers. But when my wife and I bought the first hotel that we had, I had my dad fly in and help me renovate it. And my dad was like one of these like HGTV guys where we had this like real moment where he was like, this is a real business, right? That sort of thing. And so we spent a couple of months together renovating this asset. It's like me, my dad, and like 8 guys with no teeth and like knocking down walls and pulling up carpet. So it was great, right? And that went very well. And about a year later, he passed away in a plane accident. The plane like literally stopped working, fell out the sky. And when that happened, I was sort of looking at my life as an entrepreneur, and I said, I've been doing all this stuff, but I'm not like super passionate about it, right? Like I literally started a business I was at Georgia Tech when I started. I started a business because in Georgia, if you start a business, you get in-state tuition. So I didn't have like some brilliant idea. I read a book called The 4-Hour Work Week, and I decided that I wanted to work 4 hours a week. I was in college, right? So that's a brilliant idea. And back then they didn't have like Upwork and WeWork. So I literally just flew to the Philippines and found some people to make phone calls. And I literally went door to door to insurance companies, said, hey, I've got some people that can make phone calls. Can we call for your insurance company? That's how we got started, right? And so when my father passed, I said, man, I got to stop doing stuff that I don't really care about, like just because I'm providing for myself and my family. And so I was sort of remembering that moment we had in hospitality, building that asset. And I said, I really like creating spaces where people feel welcome. The problem with that is that asset by asset is extremely hard to do when you have a finite lifespan. So what I wanted to do was build a platform for investors where we could get exposure to 20,000, 40,000 keys at a time with the best asset owners, operators, and developers. And that was sort of the thesis behind, I'm going to get rid of this wealth management business and get specifically into my purpose and creating these spaces where people feel welcome. Yeah. So I guess I should talk about my team. They're awesome too. Katie was at AQR for 10 years, was a large quant fund. We knew each other for years. She's a musician, I'm a musician. And then Ken was one of the professors at Cornell when I was there for the hospitality asset management program. Okay, so about hospitality, some things like what do we show investors as the reason why they should be allocating to it, even though there's such a small percentage of investors that allocate. So less than 2% of capital at the institutional level goes to assets, to hospitality. And here are the 6 things that we really like about it. The yield is higher. It's got global growth when you're looking at it from a global standpoint. There's lots of mispricing, even with people that are presenting their opportunities, they don't necessarily price it the right way. This is an inflation hedge because the rates are changing on a day-to-day basis. I can change my rates today if I want to, whereas I can't do that in any other form of commercial real estate. There's a lot of brand upside. So if I buy an asset that's non-branded and I put a brand on it, there's an immediate premium that I can get. And we're tracking things, again, at the macro level where I can look at, what is the sentiment for a Hilton in a submarket versus the sentiment for a Hyatt in a submarket, and understand when we're dealing with these developers, what should their next operating agreement look like, and who should those partners look like, and which one of those are going to provide additional return for that asset that they're building. And then for us, the reason why the operational edge is sort of in a different color is because we believe that is where our edge comes in. We have a pretty good process where we work with a lot of government partners that feed us the deal flow, that are introducing us to organizations that will have a larger liquidity event in the next 3 to 4 years. So typically with an asset, you can buy a hotel. The question is how are you going to get out? This is an extremely illiquid asset class, right? And so when we're investing at the holdco level, we are doing this, and contractually, we're making sure that the organization that we're investing in hasn't agreed to exit. And if something is not going right, like say, for example, the market comes down during the time when we expect this company to go public, we're going to have a yield that we're receiving because they've got so many keys that are already operational. So we're not just stuck in this one-off asset that could or could not go as planned, right? I won't spend too much time here because most of us have seen it. The base score at the top, this is actually two formulas. It's like basically it's just this. This E means the sum of, right? And so it's just adding all these things together. So this is what we spoke about earlier. It's market risk, it's government risk, it's currency risk, it's repatriation risk. It's every single risk you could imagine that we're looking at. Literally, like we literally come up with more things that we could like risk against, right? And the reason for that is because when we get these feasibility studies from third parties, in my life, I've never seen a feasibility study that says, don't put the hotel there, right? So every single opportunity we look at is always saying, yes, this is going to make money. And what we wanted to do was put a framework in place where this score would help us identify quickly, is this a deal that we should pursue, right? The adjusted hospitality alpha is what is the additional alpha that I should receive in this deal, risk-adjusted rate of return, as we spoke earlier. Is the base Sharpe, is the risk-adjusted rate of return. Illiquidity premium, this is how much do I need to ask or demand or expect from the investment that I'm making while I'm illiquid in this assets. And the liquidity stress delta is like worst case scenario, what happens if something goes wrong? How is that going to eat into the return that I'm expecting? A lot of people ask why we share this, like, aren't you worried someone's going to steal it from you? This is like several years old, and like these formulas are like V1 formulas. So just, so you guys know, our platform is pretty sort of beyond this. And I do this because my parents were teachers. I come from 4 generations of teachers. So I actually like working with investors that understand. Like when we built Bay Street, I said, don't invest in things you don't understand. So first and foremost, we want people to understand what they're investing in. And that's why we spend so much time up front showing how we express our investment thesis at Bay Street. Oh, I guess this is kind of cool too. I didn't talk about this. This is useful. And what I mean by that is in the public market, there's decades of data that we have on real assets in the hospitality space. But with private deals, very few people look at a deal and think about it from the private equivalent. So if I'm looking at a price to sale ratio, for example, I can compare that to the price that I'm going to pay for a block of assets and then the 12 months trailing revenue. And that's effectively a price to sale. So now, again, looking at this illiquidity premium, I can determine, should I even bother with this asset, or should I just invest in a public security that will not tie up my capital, or should I look at something in a different region? So I'm going to run through a couple of opportunities where we've applied this and it's worked well. One of the regions is Portugal. Portugal is interesting because a lot of the investors there are golden visa investors. So they have to put in 500K euros. When we build the hotels, we work with Hilton there right now as the operator. Our developer is a local Portuguese developer. We spend about 125K euro to build the asset. But because these are golden visa investors, they are investing for the purpose of citizenship, not for financial return. So they put in the 500K euros. We spend 125K of that during a 3-year period of time. So the multiple investment capital and the IRR, it's immediate. So you're making 2.5 times your money day one because they've got to put their money there and it's got to sit for 5 years in order for them to get their visa. we're only going to spend 125K of those euros. And once the hotel is done, what the investor receives is a hotel room and a visa. They're not even looking for a return. And then Hilton pays them fractionally the revenue that their room generates, right? So this works very well in Portugal. And 2 years ago, they changed the legislation where you have to invest through funds in order to receive citizenship. It used to be that you could go as an individual and buy land. And what happened is 95% of the assets in Portugal that are over 500K is owned by Chinese and Americans. So that shocked the prices. So they said, you can't do that anymore. You got to go through a fund. Our fund is one of 40 funds that are approved by the Portuguese government for the purpose of golden visa citizenship. Yeah, that's pretty straightforward. Here are some debt deals that we did in various regions. The Hyundai one is my favorite one. We got this a couple of months ago. It's cool because people have heard of this brand, and I speak a lot about risk-adjusted rate of return. This deal is unique because we're buying the asset, and they're actually paying us 9% while we are the owners of the asset while it's under development. So I'm actually being paid to buy something. And Hyundai has actually agreed that if we don't want the asset once it's built, they'll buy it back from us, right? There's no risk in that deal for me. And so even though the return is 9%, you would say, well, I can make 15% or 19% in my private credit deal. I would say, yes, I'll take 9% for free from a risk-adjusted rate of return standpoint, because Hyundai is not going to go belly up in a couple of years, whereas this thing, this 19%, obviously is coming with some additional risk. That's the reason why the yield is so high, right? I'll skip the rest. Yeah. I'm out of time. So you guys saw the video. If you didn't, just swing by our office and then our thing over here, and hopefully someone will be over there. And if not, it was great to meet everyone. Yeah.
Thank you, William, for sharing your unique journey and opportunities with us. Following these insightful company presentations, we now have the pleasure of welcoming our next keynote speaker. He is the founder and CEO of the National Renewable Network, a leading organization in the rapidly evolving renewable energy sector here in Australia. Please join me in giving a warm welcome to Alan Hunter.
Hello, everyone. Good afternoon. Thank you for coming along. So today my keynote speaker is going to talk about the from capital to infrastructure within weeks. Renewable energy in Australia, the project timeframe is very large for utility scale solar farm or wind farms. I want to talk about what we're doing at NRN and how we help capital get deployed quicker within renewable energy projects. So let's get going. A few years ago, we saw the cost of coal move from $40 a metric ton to over $400 a metric ton. And with 72% of our power still dependent on fossil fuels, such as coal, my energy bill went up and so did yours. In fact, it was announced this morning that your energy bill is going to go up by another 10% in a few weeks' time. Now, of course, there is a solution. Putting rooftop solar and battery on your home can reduce those costs, but with a $20,000 price tag, many are blocked out from doing so. So what if there was a world where you can get an energy plan that included a solar and battery system, just like your phone plan did? So do you remember the days where you had to buy your own phone and get a phone plan attached to it? And now today we all have new phones in our pocket because it was included in your phone plan. Well, that's how we see energy in the future. We see energy plans that will include solar and battery for consumers, which will help renters, it will help homeowners who can't afford it, and also social homes make the transition, meanwhile reduce their cost of energy. So I want to talk to you a bit about the platform. What is NRN? What have we created? Now, we see ourselves as a bit of a marketplace. Like, let's take an Uber. You've got a driver, you've got a rider, or Airbnb with a host and us as visitors. But energy is a little bit more complicated. So we have a 4-stakeholder relationship. I'm going to start off with a customer to start off with. A customer will put a solar and battery system on their home. It costs them absolutely nothing to do so. There's no finance associated to this. It's just bundled into their energy plan. The benefit for them, they save about $1,000 a year off their electricity bill. It's about 30% cheaper than what they're paying today. We then work with energy retailers. So they build the product. They'll put the solar and battery as part of the bundle, and the average cost of capital is the average cost of energy is about 30% cheaper. Now, they're selling the energy directly from the rooftop through the battery to the consumer, and then selling the energy from the grid and blending that. And that's where the cost benefit flows through. We then work very closely with the solar industry. Solar retailers have a huge challenge in front of them at the moment with such a competitive landscape. But they sell, install, and maintain our solution, and that helps us be able to scale this product across the country. And then lastly, we work with infrastructure investors. Investors that want to invest in the good, but don't want to lock up their capital for too long before seeing a return. So I just want to talk about the three problems we're addressing for the other three segments before I dive into the private capital space. So energy retailers are facing rising cost of energy, they're facing grid challenges and significant profitability concerns. Consumers, we're all facing it. We see costs surging, increasing affordability barriers, and also financial concerns. But for solar retailers, with 4,500 solar companies in Australia, they're on the race to the bottom. Their sales are down by 50% at the moment, and we're seeing a lot of those companies go bankrupt. But I want to talk about a new asset class for infrastructure capital, which is all around distributed energy resources, being solar and battery at someone's home. So we've packaged this together to be able to reduce the risk profile for an investor dealing with multiple consumers, but also give them a strong return in comparison to utility scale renewables. So we're buying assets behind the meter. Solar and battery system behind the meter is what we're purchasing. We do have security over the land. We have to register a caveat on the property. And the whole idea is that this asset would be sold at the sale of the property. So that's, I guess, where the transaction happens with this asset. We're currently achieving a 13 to 14% unlevered IRR. And that for us is proven to be sustainable and also significantly more than what we're seeing in the utility side. We get a fixed income for the next 12 years. We don't base our revenue from market volatility or energy generation, nor consumer using energy. We sell the asset at the point of sale of a property, and that will happen within the 12 years or at the 12-year period. That's where the asset is let go. And then finally, for every $10,000 invested, we're offsetting 36 tons of CO2 emissions. So the four bottlenecks that I want to address with, I guess, capital investing in renewable energy. Utility scale, we're seeing a lockup of capital between 2.5 to 4 years. In comparison to what we're able to deploy capital in 4 to 8 weeks. Returns are pretty much double. Most solar farms these days is anything between 7 to 9% unlevered IRRs, and obviously it's geared after that. The income style for us is fixed. Our merchant risk is with an energy retailer, not a consumer. We don't, again, trade within the market, or there's no power purchase agreements, as we would see in the large-scale utility space. And then lastly, it's very low regulated. We don't have to have long time waiting for community engagements or connectivity back into the network. We're able to deploy an asset very quickly. So the opportunity is quite big, especially in Australia. And beyond, we do aspirations to go global. For those in the room, who's very familiar with a virtual power plant? Show of hands. All right, some here. Excellent. So for those who don't, a virtual power plant is when we're connecting a solar and battery system digitally into one centralized control. We can dispatch power, we can charge power simultaneously from all of the systems across the country. That is viewed as a virtual power plant. Now, there's huge benefits for this. We've got grid stability, we have access to cheaper energy rates, cheaper distribution costs, and increased renewable within our grid. But the best virtual power plants is when there's no conflict of interest. That said, when a customer goes and buys a $20,000 asset for themselves, they're not buying it for their next door neighbor, and they're not buying it to make the grid more stable. So we've developed a virtual power plant that actually works for the energy sector, resulting in cheaper energy cost. Now, last May, AEMO, Australian Energy Market Operator, launched their integrated system plan. And they forecast that we're going to see at least 7 million homes purchase solar over the next 25 years. We're going to see nearly 2 million homes upgrade to battery storage in the next 25 years, which is an estimated cost of $142 billion spent over the next 25 years in Australia in distributed energy resources. Now, the status quo today is that mum and dad's money needs to be spent on $142 billion. Our view, and what we're doing as an organisation, is that it's the energy sector that can purchase this and not relying on mums and dads. So just to talk a little bit about the total addressable market, I'm not going to go for every segment, but the big limit we are constrained by is workforce. There's 285,000 solar installations that happen every year in Australia. That's $6 billion worth of capital that can be deployed in behind-the-meter renewable energy projects. So just a quick overview on us. We are a technology platform. We sit in the middle. We don't engage with consumers. We work very much with the energy retailer and the solar retailer, and then it all comes together. We've developed a solution where solar installers can go to their customers and sell this product within about 5 minutes of sitting around the kitchen table. We've got asset management software that tells us every 5 minutes the performance on a system, and algorithms that run in the background that alert humans if there is any trends that we should be looking at. And also, we're a bit of energy nerds. We sit with our energy retailers and we explain the best way that they can optimize their virtual power plant to increase their profitability. Our view is the more profitable energy retailers are, the cheaper plans they can produce for consumers, the more consumers we have. We've built a really interesting flywheel. So just some of the team. We are a startup. There's 23 of us in the team. Here's just some team members come from lots of different industries coming together to create this solution. Now, we are currently finishing a capital raise. We've been going for the last 4.5 years. We've got around $15 million of capital deployed over about 800 homes currently. And we just signed up 2 tier 1 energy retailers, and this product will be a mainstream product going into July 1. Hopefully you'll see us. So we're currently closing a $67 million Series A. Thankfully, it's 98.5% closed and done. It's about $1 million left, I think it is. The headline here is we've defined product market fit. We grew by 700% last year, which really showed us how we could scale. And this Series A is a split between senior debt, mezzanine, and also equity, as you can see on the board. But that's a bit about NRN and what we do. Thank you very much for your time.
So thank you, Alan, for sharing your vision and expertise, highlighting the immense opportunities within the renewable energy sector. Now, as we approach the final stretch of Private Capital 2025, we have our last set of company presentations, which offer a final glimpse into some compelling investment prospects. May we now call on Andrew Hayes, Managing Director at iMoney Capital.
Steve has put on another fantastic wholesale investor conference. It's wonderful to be here. It's great to see everybody here. So I'm here today to talk about the Consensus Award Winners Fund. So this is our flagship managed fund. Just a bit of a disclaimer. I won't bother to go through the whole thing. So about iMoney. So iMoney Holdings is an unlisted Australian public company. We operate in 2 key areas. So on one side, we've got the corporate advisory, and on the other side, we have our funds management business. Now, we operate in the ESG space. So we're looking for ESG-aligned investment opportunities here in Australia, Southeast Asia, and India. We've got a solid focus on healthcare, renewables, and technology. We've got a very, very strong leadership team. Between the directors and senior stakeholders, there's probably more than 150 years of experience. And iMoney Funds Management is the newly established funds management business owned wholly by iMoney Holdings. So a little bit about us. So we're here to unlock capital for a better future. Our mission is to unlock capital and strategic expertise to accelerate investment in bold ventures, in clean energy, in healthcare, in innovation. We're passionate about it transforming ideas into measurable impact and better futures. And we see that investment can be a force for good, leading Asia Pacific and beyond in turning breakthrough innovation into sustainable prosperity across energy, health, and emerging industries. And things that we value integrity. We value inventiveness. We're responsible and we believe in collaboration. So what we do. In corporate advisory, we do structured capital raising and strategic investment advisory. So we've got notable mandates, and some of our largest mandates are actually in India. So Steve's plenary speech this morning when he's talking about launching Capital HQ in India, I got goosebumps on the back of my neck. And I've met a number of investors here today who are very interested in India as well. We've got solar projects that we're funding that are north of $75 million, and we've got early stage technology of 10 million and more. Now, the funds management business, we are interested in creating innovative and ESG-aligned investment funds, and the Consensus Award Winners Fund is our flagship fund. So, who here has heard of the Consensus Awards? Can I get a show of hands? Yeah? Wow, okay, that's really good. Now, I've got my reading glasses on, so I can't see. Is Julian Day in the audience? Ah, hello, Julian. Could you stand up? Julian is the founder of Consensus. So, the Consensus Awards started in 2000, and it's going into its 26th year. And what it does, it identifies and awards the most innovative technologies in Australia and New Zealand across 8 tech award programs. So the first awards were presented in March 2000. So over that 25 years, there's been more than 1,200 evaluations of technology. They have more than 160 registered judges. So we've got a huge brains trust that are evaluating these companies. So just out of curiosity, are there any judges in the audience? Could we stand up? Yeah, thank you very much. And over those 25 years, there's been more than 200 winners. So an incredible success story. So the majority of the companies are Australian private companies, but there's also a small smattering of Australian listed companies, some New Zealand private companies, some New Zealand listed companies. And the results are that after 25 years, 9 out of 10 of them, of the winners, are still going and are still successful. Ones that have departed, 56% of them have merged or been acquired. And winning a Consensus Award generally is a pretty good predicator of success. So, I mean, there's some unicorns up there. So Atlassian won in 2004, TCS Banks won in 2005, and WiseTech Global won in 2009. So just as a testament to the success of it, let me just read the testimonial from Mike Cannon-Brooks and Scott Farquhar. Consensus and Julian Day encouraged us to enter the Consensus Awards in 2004 when we were launching our first product, Jira. It focused us to document exactly what our offering was, sharpen our USPs, define our target market, and confirm our go-to-market strategy. It was the first of many awards we received, but by far the most significant. It was so valuable as it gave us encouragement to leverage off the win and promote technology assessed by such a large and independent panel of industry experts. Thanks to the early recognition by the Consensus Awards, we are now generating, and bear in mind this study was done after 20 years, so it's 2021. Thanks to the early recognition by Consensus Awards, we are now generating over $610 million per annum and have a market cap of $90 billion. So what we are looking for with this is we're hoping out of the biannual awards that we are going to see the next 2, 3, 4, 5, 10 Atlassians over the life of this fund. So Richard White has also got a testimonial. I won't go through that because I've realised that I'm running out of time. So let me just run through the process of the awards. So people can apply to it and come in through a variety of channels. So through networking, marketing, incubators, startup hubs, universities, industry associations, governments, previous judges, previous competitors. There have been people who have entered 3 or 4 times. So once they submit an application, that goes into the collegiate judging round. So it's not a first past the post competition. It's not there's only one winner. If there were 10 companies that met the criteria to win, 10 winners will be announced. So, and that whole collegiate judging process, it's a 360 process. So people have their business models evaluated, they talk to the judges, if they find some areas of improvement, they go back, and it keeps going until we end up with the awards. Now, I forgot to bring the award actually up on stage with me, which is a bit of a shame. So when it comes down to the winners, there are 3 criteria that are vitally important. So it must be innovative, it must perform well, and it must have good market potential. So once a company has proven that, we can invest, and we're asset class agnostic. We don't care if you're listed, so we'll buy shares on market. If you're unlisted, we'll fund you that way. If you want some senior secured debt, we'll do that. Convertible notes, preference shares, it doesn't matter. So unlike other VC funds, because of the types of investments we're willing to make, we will also have liquidity, unlike some PE funds where you're going to be tied up for 5-7 years. So, yep, how to invest. We are a wholesale fund, so we're only open to people with a wholesale investor certificate. Minimum investment's $25,000, and the application is via our information memorandum. We're looking to seed the fund with $20 million US, and we're hoping to have that all in by 30th of June this year. So thank you very much, and help us transform capital into a force for good. Thank you.
Thank you, Andrew. Next up, we have NovaPep, who will be sharing their unique investment opportunity with us. This company develops biparatide peptide to treat sepsis and acute conditions with cytoprotective anti-inflammatory effects. Please join me in welcoming Jay Hannock, CEO at NovaPep.
Good afternoon, everyone. I've been told to keep the science out of this, so it's really about the investment opportunity. But there are 49 million cases were recorded of sepsis in 2017, and 11 million of them died. So 20% of the global deaths are attributable to sepsis. Now, there's antibiotics, and there are no other drugs for the treatment of sepsis. And what actually happens, it's a bacterial blood infection, and that it affects your brain, your heart, your liver, your kidneys, and there is no drug to protect that. So we, the University of Sydney and the Scripps Research Institute in La Jolla, which is the top-ranked molecular biology research group in the world, are investors in NovaPep, and the technology originated at the Scripps, but we're an Australian company. And what we've shown, and this is published data, that in a mouse model of sepsis, that one low dose of biparatide, which is the name of our peptide, increased survival from 31 to 53%. Now that really grabbed the attention of a number of researchers globally, and I'll dive into that in a sec. We've also shown it's neuroprotective, it's cardioprotective, and it protects the vasculature. So you can imagine the sepsis is going around in your blood, and if you can protect and repair the vasculature, you're going to protect and repair the vital organs. We're at a point now where Swinburne University has seen the data. They want to invest. They've committed $500K to a safe note, and they've asked for a co-investment of $200, which is why I'm here today. And we've already started a Series A funding round. We're primarily targeting US VCs, and we actually have had an unsolicited approach from a farmer already who's seen the data. So that is the data for those who are data nerds. And it was published in April 2024. So our development plan, Yogesh Lankadeva at the Florey is a world-acknowledged expert in sepsis. He actually has a therapy in phase 2, which would be complementary to ours. And we are working with him. We've done an initial rat study. We're doing a follow-up rat study. And he has what's called a good laboratory practice GLP sheep study in sepsis, and that is acknowledged, globally acknowledged. He's published a number of papers in that. So a critical thing when we're looking at this was just end cost. And the maximum COGS, our cost is around $1,000, and the market feedback is that this would be an $8,000 to $10,000 treatment given the potential. So when you multiply that by the potential number of people who get sepsis, it's obviously massive. John Griffin, he was the inventor of the peptide. Yogesh, there's also Gemma Figtree at Royal North Shore, who's a global cardio expert, has just come on to our scientific advisory board. We are also looking to modify the peptide for chronic indications. So what I've described with sepsis and acute kidney injury related sepsis, they're acute. It all happens in a pretty short time frame. But we're also developing it in a similar way to semaglutide. So Ozempic, Wegovy, we are doing that. And the people who are doing that, Akhtar Hussain, he's published recently on a modified form of semaglutide, which is actually cheaper and more effective than Novo Nordisk's Ozempic, Ozempic and Wegovy. And I'm not privy to it, but I know that they've got a patent, and I wouldn't be surprised if they're talking to Novo on that. I just wanted to quickly show this slide. I know it's data, but it's very important data. Whoopsie daisy, there's not a pointer. We did some work in colitis with our drug, and it showed that it was as effective as Humira. Now, Humira is a very expensive biologic. It's an immunosuppressant, and it's in the region of about $45,000–50,000 a year. We've shown we're as effective as that, way more effective than corticosteroids. The management team, we've all exited companies, so I won't dwell on that. But in summary, there is no what's called host-based treatment for sepsis. So it's will become a first-in-class drug. We are partway through the rat study. We did a very low dose that showed efficacy. We've now tripled that dose, and we'll go from there on the rat study. We'll then move into a sheep study, and we're actually planning to be in a phase 1 early the year after next. And that will, we think, that's just purely in safety. We've had in all of our animal studies to date, we've had no signs of toxicity whatsoever. So, as I say, we're closing a 700K round. We've got 500 committed from Swinburne. If there is good interest, we'll take a bit more than that, but that's our minimum. And as I mentioned, we're already in Series A discussions with VCs here, but we're going to be primarily focusing on US VCs. Certainly some of the studies will be done there. So that is the opportunity, and thank you for your patience and interest.
Thank you, Jay, for sharing your innovative work at NovaPep. Finally, we have our last company presentation of the day who will be sharing their unique investment opportunity with us. Please join me in welcoming Nicola Lanteri, CEO at Memento Blockchain.
Okay. Hi, everyone. So Nicola Lanteri, I'm the CEO and co-founder of Memento Blockchain. Memento is a Singapore-based company founded in 2017, and we specialize in blockchain services. We started our journey in 2018 when we closed a seed round, and we used that money to build our first product called DexTF. It stands for Decentralized Traded Fund. In 2020, we launched DexTF in mainnet, and we had a good traction with retail customer and crypto native users. Later in the years, in 2022, we actually saw an opportunity with banks to bring them from traditional asset management into blockchain spaces. And that's when we started our collaboration with Deutsche Bank. Since 2022, we've been working with Deutsche Bank and developed 2 projects with them. First one, Project Dama, where we proved to the bank how traditional asset management can be done on chain and distributed to their retail customer. thanks to the success of this first project, we started another project with Deutsche Bank with a much bigger scope to actually build the entire blockchain infrastructure that can be used to host financial software for traditional asset managers and banks. So we've been around for about 5-6 years. We have engaged with several regulators around the world, and we were awarded 3 innovation awards by MAS, the Monetary Authority of Singapore. And we've been working with Deutsche Bank now for a number of years. We've been talking to other financial institutions, traditional asset managers and banks in Singapore and in other jurisdictions. And we have a very experienced team. So they all come from traditional banking and asset management. Our main product, Memento ZK Chain, is about to go live in a couple of weeks. And I'll show you in a second on what this blockchain solution is for traditional asset management. So what's the market opportunity here? Transform the outdated infrastructure for traditional asset management. Today, traditional asset management is very inefficient. Investors get charged more than $50 billion a year in management fees. So this is money that all comes from your investment. And the reason for that is because there is a lot of manual processes, very inefficient processes, and there are too many intermediaries. There are banks, transfer agent, custodian, financial advisor. They all charge a fee, obviously, on your investment. With the blockchain, we can reduce up to 70% of this cost. And obviously, this is money that you save when you invest into a fund. The process is also slow for fund management. So when they need to create a fund, it can take up to 2 to 3 months to create the funds because they need to engage with lawyers. They need to find the right jurisdiction to create their funds. And it's a very expensive process. On blockchain, funds can be created in a minute. For investors, they can invest anytime, 24/7. There are no public holidays, no Saturday, no weekends. You can do that all the time. The global asset management market is huge. There were about $130 trillion invested in managed fund in the last 18 months. And the digital component of this asset under management is about $60 billion in 2024. This is expected to grow 10 times by 2030 and reach $600 billion. We are one of the few players in the market, probably the only one with strong relation with a bank like Deutsche Bank. And I'm confident we can capture between 5 to 10% of this market and generate $6 to $12 million of revenue every year. So what's the value proposition here for both investor and fund manager? For investors, have a transparent, low-cost infrastructure where you can monitor your investment in real time, 24/7. It's a blockchain base, so any type of funds can be tokenized. And for financial institution, this means that any type of asset can be now used as an underlying asset for fund management. Today, traditional funds are only possible with financial instruments that are typically available to investors. But with the blockchain, actually any type of asset can be tokenized, from gold, silver, art, whiskey, wine, any type of valuable asset can be tokenized and used as a fund. And obviously, operational efficiency. A fund can be created in seconds at a fraction of the cost. It doesn't take months to find the jurisdiction and create it. You do that 24/7 on the blockchain. And it's compliance. So what we build is being built together with a bank. So we make sure that everything that we build is compliant to the jurisdiction where the company is being set up. How we make money? So obviously, we charge a platform fee to fund managers. We can generate up to $12 million a year in fees. And we also have white label solutions for banks that want to use our application exclusively. So our product is a Memento ZK Chain. So it's a fund infrastructure that it's been built with financial institution in mind. So it's compliant, transparent, and has all the privacy features that is required. Our core product is Memento DFM, Digital Fund Manager, that's used to create funds and invest directly into these funds. So we've been running a couple of use cases with Deutsche Bank, but we're also in talk to other financial institutions to create new use cases in the next 12 to 18 months. So our roadmap is quite busy for the next 18 months. As I mentioned, our Memento ZK Chain blockchain is about to go live in a couple of weeks. We will run the first real case with a fund manager, specifically using a real estate fund. We will continue onboarding additional financial institutions in the coming months. And next year is all about adoption and new use case with financial institution. So we're also looking at other jurisdictions. Why we're based in Singapore? We're looking at Australia, Middle East, and also Europe and the United States. So our team is quite experienced. So myself, I come from traditional banking. I've been spending about 15 years in ANZ and in consulting firms. My other co-founder, they all come from traditional asset management and banking and consulting firms. So we are a very strong team. So we know what the issues are of traditional asset management, and we're trying to solve this issue and bring the efficiency and the technology advancement of blockchain solutions. We have a number of partners from technology firms, traditional asset management, and obviously Deutsche Bank. We're working with other financial institutions as well to onboard them in the coming months. And we see that this industry is evolving very quickly in the last 12 months. Comes to our investment terms. So we're trying to raise $5 million. That's our target. So the money is going to be used primarily to grow and expand in new jurisdiction. So until now, we spend all the money primarily to build our product. We now have a product that works. So we want to expand, grow in other jurisdictions. Middle East is a very important area for us. So we already have some rep office there, but we want to also grow in Europe and in the United States. If you want to know more, please visit our website, Memento Blockchain, or reach out to me. Thank you very much.
Thank you, Nicola. And that was Memento Blockchain. Following our final company presentations, we have one more keynote speaker to share his expertise with us. Giles Carhan is the founder of Valoop Australia. Valoop helps employees own the company they work for and offer business owners a great alternative to traditional selling methods. Their new platform, Valoop Exchange, helps transform the employee and ownership process, making it simple, fast, and cost-effective. To give us more insights on this, please join me in giving a warm welcome to Giles Carhan.
Thanks very much. Sorry, my voice is a bit croaky, but look, I won't keep you all very long. I'm quite excited to be up here. I have worked with Wholesale Investor for a long time on another business that I recently exited, and I'm very excited to actually launch this today. So been working on this for quite a while, and really excited about the opportunity that this new platform does provide. So I just wanted to start with something that I'm going to probably mention a number of times, deferred consideration. If anyone doesn't know what deferred consideration, when you sell a business, deferred consideration is the amount that you will get at a future date. And then the concept of having a surety against that. So exactly how it sounds is almost like insurance against the deferred consideration. So here we go. The grey tsunami, as it's been termed. There is a huge issue, there's a huge thematic that's going to run through the world over the next 10 years, which is baby boomers retiring and what happens to those businesses. So 90% of the people in Australia are employed by SMEs. So what is going to happen to those businesses? So we've got I can give you a few stats here that I do have. What have we got? There's 100 million SMEs globally, 125 trillion enterprise value, and 99% of those companies are 1 to 2 owners. In Australia, NAB just put out a report, it was about 2 months ago. There's 350,000 companies in Australia that need to transition ownership in the next 10 years. Who's going to buy them? How are they going to do that? So the question is, what's going to happen? So this isn't just something that I see as an issue, but government sees as an issue, everyone sees as an issue. So what are we going to do about it? So I've partnered with a firm over in the UK called Valoop. Now, where we're targeting is really helping employees transition from employees to owners. So what are we sort of focusing on? We're focusing on management buyouts, giving employees who normally wouldn't have that opportunity to own a company that chance. So when you look at any sort of business that we would have seen, your fish and chip shop, I was speaking to someone before about hotels. I've been talking to a guy who has a tyre business. What happens to those businesses when the owner wants to retire? goes to private equity. If you're not within a certain band and you don't have a growth profile that they really want, where do you go? So the natural buyers are employees. So employees come in, they take over the company. What we are doing is providing the surety to the owner that they will get paid. That's what we do. We provide a surety. So we've built a platform. It's 120 questions. It's not, it's not too bad, but it goes in stages, goes through a whole lot of different questions to, first of all, say, look at the business and is it financially viable and does it have a steady EBITDA and things like that. But also, does it have the culture? Does it have the key elements that it takes for a succession in a business? So getting through that gives us the tick. And from that, we can provide a surety against the purchase. So what we're really trying to do, the term don't sell out, sell in. We're keeping owner's legacy. So not only does the owner, they can have some input, they can really see that the business is still thriving. And why does every business need to go from a 2 million EBITDA up to a 10? You can still make a lot of money out of a 2 million EBITDA business that just continues going along. But that profile isn't very attractive to a lot of people. But hang on, you've got management in there who have, unfortunately, in this country, massive mortgages. They can't go to a bank and borrow money to buy that business. But if it's a good little business, and we're talking between enterprise value between 5 and 150 million. So we're not talking about tiny businesses either. Means that the management can come in, run that business, and they can potentially have that equity ownership that they never thought possible. The government profits because these businesses aren't just shutting down. So it's, as I've said, it's a win-win-win-win. No one loses out of the transaction. And so for me, that is hugely, hugely exciting. I have to say this is the first time I've given this presentation, so I have to refer back to the slides to see actually what I'm talking about. As we can see here, what we're doing is also reducing the complexity. Being able to go in for a simple, I think we're charging $50, to go in and see your business readiness, whether the business is actually ready to be able to make a step into employee ownership. But we're not also focusing, and it's something that I think it might be even on the next slide. We don't just say that the management get it. We make sure that there's an ESOP plan in place for all employees to benefit, which again gives the employees an opportunity they never thought they were going to have. And by reducing this complexity of going through private equity and there's a lot of people out there, and good luck to them, and we'll actually even partner. I've got a lot of friends who have had an exit on something, I want to go and help a business, and, little micro private equity plays because they see huge benefit. We can come in there as well anyway. It's not like we need to do everything. We want everyone to be inclusive in the transition of the business from where it is to the next rung. And we're not going to sit there and say that owners have to spend 5 years and it has to be a 10% per annum IRR or 20 or 30. Business can go along the path it has. Technically, and even go down a little bit. But we'll assist them in that transition from from one owner to the next. And as I said, owners, everyone wins. An owner is guaranteed that they're going to get that price. Might take a few years, but when you're either shutting it down or guaranteeing yourself an exit, it can be quite attractive, I think. So we used AI, as everyone does, but we've spent a lot of money building this platform. And, I think the complexity has been taken out. And now we have a real opportunity to help hundreds, if not thousands, of businesses globally in that transition. Why am I up here? Well, I just want to start spreading the word. I don't want to raise money. I'm not doing anything like that. If you guys, a lot of people here would be part of businesses. You might think, my boss needs to retire, I wouldn't mind, it's a good business. What the hell? Doesn't cost you anything. We're not asking you to guarantee your house. So we ask for a little bit of money, to cover their legal expenses. But other than that, you get potentially a large portion of a business that you've been working in for a number of years, and you can, see where you can take it. It gives you the power to be able to, continue your journey into the future. We're not advisors, so we're not going to tell you how things are done. We can tell you some criteria with which you need to fit, but otherwise we leave it to you to negotiate to make those deals happen. We can provide you with people to talk to, but we are not going to advise you on the deal. But we'll help you reduce the friction, reduce all those complexities that naturally will come when you try to buy a business. So look, I'm going to wrap it up now. I'm a few minutes short, so I don't know if anyone has any questions, but otherwise, look, thank you. And if anyone hears of a business that people want to transition out of please, my details are, ask Steve, our fearless leader over here. But yeah, I'm happy to love to help anyone and everyone.
Good afternoon, David's my name. Just explain how you're clipping the ticket. Are you taking equity in the...
Yes, so we take equity for arranging the whole thing and providing the surety.
Right, so just share that and how that
So,
works.
that's a negotiation at the start. So we will go in at the start with the company, with the management, and to come up with a small amount that each person will put in, $5,000, $10,000, to cover all the legals, etc. And depending on how much equity they believe that's worth and how much we think, we will go pro rata with them on the upfront fee, and then we'll take that equity at the end of the transaction.
And the owner of the business gets paid out when?
Between 3 and 5 years. So depending on the multiple that's paid.
That?
Sorry?
And you're guaranteeing
Yes.
that? Is that what you're saying?
Well, we're providing a surety against that.
I'm not a...
Yes.
I was at the back of the class in English, so what's the difference between
There
a
is
surety
none.
and...
There is no difference.
Right.
So we have insurance and then reinsurance against those transactions.
And what determines the 3 to 5 years between
multiple of EBITDA generally?
The owner payout?
Multiple of EBITDA generally. That's paid up front.
So the higher the EBITDA, the shorter the...
Higher the EBITDA, the longer it takes. Because the business pays the vendor in the end. Okay, so you've got a company, they're doing 2 million EBITDA, it's negotiated on a 4 times EBITDA multiple. Therefore,
why 4?
I'm just pulling a number out of the hat.
Right.
We wouldn't look at a growth company of that might want 10 times or something. It's not within what we're looking for. So that provides generally they will be, if it's 4 times multiple, then you're looking at probably about 5 years to pay it down. Can be shorter, depends on the performance of the company.
Right. Thank you very much.
Thank you, Giles, for that interesting keynote. We now arrive at our final panel session of Private Capital 2025, focusing on alternative investment opportunities. To guide us through this important discussion, we have highly experienced leaders in the alternative investment space. Please welcome to the stage Evan Lau, the CEO and co-founder of BankStack, Damian Collins, the chairman at Westbridge Funds Management, Akshay Chakrapani, partner at Creek Partners, William Houston, general partner at Bay Street Hospitality, and Steve Baxter, founder and lead investor at Beat and Zone Venture Partners.
Just turning my display to 5 minutes so my timer doesn't go out. All right. So I'll stand up here for the moderator. Now, I know you've actually who's heard from all the presenters so far today except for one? Okay, so what I'll do, because you guys have all presented, there's only one more person really to introduce that hasn't presented yet today. So Akshay, can you just give a bit of an introduction to yourself as a bit of a starting point?
Sure. Good afternoon, everyone. Thank you, Steve, for having me here. My name is Akshay, and I'm a founder of the firm Creek Partners. And Creek Partners is effectively a way to create a nexus between Australian wealth and the Indian VC ecosystem. We raise capital here and deploy into the various VC firms, domestic franchises who have exceptional track record, and we act as a fund of funds, but we actually execute as feeder funds. So that's a little bit about myself and Creek Partners. Thank you.
Perfect. Now, when we promise an alternative investment panel session, I think we really deliver. We've got Indian VC, we've got industrial property, we've got fintech payment solutions, we've got hotels, and then we've got defense tech. That's what I call alternative. Yeah, I know. I'm going to get roasted for that one. No one posts a photo of all of us on here on LinkedIn. All right. So just to kick off, Damien, you've obviously been a strong advocate for unlisted property as an investment class. What are some of the key advantages that you see over traditional real estate or even listed REITs for high net worths and family offices?
I think one of the key things is the stability of assuming it's a good quality asset. That's always the underlying criteria, of course, but it's the stability. As we see in the listed markets, the listed REITs tend to go sometimes plus or minus 30% over net tangible assets. So whereas unlisted, the valuations are done regularly and it's quite a much more stable asset. But you've got to be prepared to be the downside of it, of course, is you have to be prepared. You're locked in because it is unlisted. You can potentially get out if the firm can find other investors, but it's not as liquid as the stock market. So the trade-off is the positive is it's a more stable valuation, but the downside is it's less liquid.
And for you, Evan, mate, you're successful. Run your own family office. You got your own venture fund. You look at all sorts of stuff. You've got a helicopter view of the world. Why have you chosen payments as your area?
Thank you, Steve, and established panelists. What I would say is having my own family office as well as looking at different investment opportunities. One thing that we were looking at was what could mimic infrastructure-like returns, but yet provide the exponential growth of innovation and ongoing innovation. And there was really a few sectors that highlighted that capability. Payments was effectively that, and the reason why I highlight that is because there's not many businesses around the world that can mimic the cash flow that governments generate through tax. And if you think about payments, it's effectively a tax on GDP. Everything on your wallet that you use today will have a payments cost in it. So everything that you're using to pay today, a sense of that is probably coming over to our business as well. So that's one of the key reasons why we focused on payments.
It's been, 27 years since PayPal was introduced, and yet this is still an issue.
It is, and it's funny that because our chairman, John, he actually was tapped by the banks in Australia to defend against PayPal when they came into Australia. Successfully did that for the banks. Yeah. So but basically, you can imagine the banks are desperate, saying, well, how do we replicate the innovations from PayPal, from all these other fintechs out there disrupting our core banking business? And that's what we do. So we believe the banks need to be the fintechs. They need to be distributing these trusted technologies into their ecosystem because they're the ones that are financially stable. They provide stability in a sea of change.
You can just see an immediate relationship between them and Alex Bank, can't you? All right. Now, William, obviously you're focused on investing into hotels. Now, hotels are sort of quite known to be cyclical, obviously. How have you sort of looked at that from your approach to an investment perspective, and how have you, I suppose, countered that in the way you think about it when you're making the investment?
So yeah, hotels are cyclical. Our perspective is that that's why we take a global approach, right? So our view is hospitality is global, and so we want to build a platform that was didn't have a home bias, right? And my view is that if you approach the right type of organization that has a large enough sort of basis, you can deal with the cyclical nature of the asset class. And I actually want to second what you said, is most of these private assets are not necessarily volatile, they're just illiquid. So you need to know how to measure the return and what you need to price in for that illiquidity. And if you can do that properly, you can ensure that when you're in a down cycle, one, it's going to look a lot different because it's not going to waver as such. And a lot of money in the private market is actually made during these downturns, right? So I think you've got correlation. You kind of have a little bit of non-correlation happening in the private side, where even if you're seeing a market downturn, for most organizations, especially that are taking equity positions in these deals, that's where a lot of the money is made. Once the cycle, goes through the trough and re-enters the upside.
And Steve, for you, you're probably one of the most renowned sort of, you started career as an angel, like you built and sold your own business, started your career as an angel investor, then you launched 1013 to do syndicates, got an incredible success portfolio across the whole tech space, even include, I think, some medical device investments. And then all of a sudden you find yourself, not all of a sudden, but then you move your way into defense tech. From your perspective, why was that, from an investment thesis at a high level, why was that the place you landed where you feel this is where you can create most value for yourself, like for your own wealth, but also, for high net worths as well?
It's such an underloved sector. I think a lot of our profit and a lot of our returns will be driven on the buy side here. So not only is defence unloved because of various ESG hardware and other irrational issues, but as an investor, I love things that are irrationally unloved. So we take it one step further in our fund. We specialise in lethality and survivability. Don't like lethality, don't start wars, right? But the reality is we're about to get into a pretty hot period of history, and we're about to need a lot of articles in that space. Now, I'm a father of a kid, so I don't want any of this to happen, don't get me wrong. But there's an absolute investment opportunity. It's an unloved asset class. My job as an investor is really easy. I buy low and sell high. A lot happens between those two. Even a lot happens before the first one. But in essence, how do I get the lowest price possible for the best class of asset? I think we've got a great class of asset. It's a class of asset that defends our lifestyles and our way of life. And it's just irrationally unloved. And that's part. So in essence, we're an anti-ESG fund, to be quite honest.
Is there any journalists in the room? They can just take away that headline.
I can give you more. I can give you more headlines if you want.
You do that quite well. And Akshay, for you, like I've been blown away by what India has achieved over the last sort of 5 years. It's so beautiful. Like you think about Dubai as an example where they've got their sort of, here's our direction, here's where we're going. India really sort of sets yourself apart where, effectively there's the 2030 vision. How does that rising tide lift all boats, specifically in the startup and VC space from your perspective?
That's a really interesting question. Thank you, Steve. I think the thing that is sort of propelling it is all the groundwork that was already done in early 2013, I would say. There are two things that sort of coincided that's kind of propelling the growth. The first was the expansion of the Silicon Valley franchises, so your Sequoias and others who were globally trying to expand. And of course, the Silicon Valley connection with India as well. 1 out of every 4 startup founders in the Silicon Valley is of Indian origin. A lot of the major sort of technology companies also have Indians as CEOs, your Alphabets, Microsoft, Palo Alto Networks, and so forth. So that kind of happened around 2012, 2013. The second thing that also happened was consistency in policy. So the Indian government has set in motion a range of initiatives to ensure that investment is the climate is conducive for innovation and investment. Multiple examples, the change in GST, the digital stack, the cost of data right now is about 15 cents. For 1 GB, it's about $3 here in Australia. So it gives you a sense of how much digital adoption is actually happening in India. So all of these preparatory work has gone into place and therefore has set in motion what we are witnessing now in the VC ecosystem. There's about 150,000 registered startups expected to grow at 30%. The total number of IPs that were granted in India last year alone was 100,000. And the current GDP is around 3.8 trillion, expected to touch 7 trillion by 2030. So all we're trying to do is find the companies that are performing slightly better than the others to kind of, generate that alpha that you're looking for. Hence, the rising tide lifts all boats in India. And really, it's a once in a generational opportunity. There aren't that many large economies that are growing at 6-7%. And so that's where we're finding that there's going to be a lot of opportunity we want to capitalize on.
Brilliant. And Damien, for you, like I think this would have been such an interesting period for you, just being sort of in the property space, and obviously just seeing the absolute sort of boom in private credit over the last couple of years. What have you noticed has been the change of investors as it sort of moved into a higher interest rate sort of environment? How has their sort of preference changed when they're having conversations with you about what they're actually looking to invest into? And then how does that ultimately impact the sort of assets that you're looking to acquire?
It was quite interesting, Steve, when everything is really priced off the risk-free rate, which is the government bond. And of course, we had a government bonds short-term in Australia below 1%, and the Reserve Bank cash rate was 0.1%. So when you could investors with real estate, when you could get at them perhaps 7 or 8% yield, they were flocking to that, plus potential capital growth. So on top of that as well. When the market turned and interest rates went up and people could get 4 or 5% on term deposits, and credit funds are offering 10%, in some cases more, there was certainly a sentiment shift towards that. But we've really noticed in the last 3 to 4 months particularly, people are realising as much as private credit's great, you don't get capital growth on private credit. It's a fixed return, not guaranteed either. Of course, it depends what they're investing underlying loans are. We're certainly starting to shift back to real estate. People going, well, yes, my term deposit is coming off, and that's going to continue to come off as rates come down. So there is starting to see some money starting to shift back into real estate. I think it'll come in a bigger wave, certainly the second half of this year, if the forecasts are correct, and we do see those rates continue to go down. So it's a market that's very sensitive to interest rates, but certainly we've been buying assets, and I think there's good opportunities in the next 6 months before the really big wave of money comes in 2026 to pick up some really great assets.
Brilliant. And Evan, for you, like what I found really interesting about our sort of first conversation was you sort of gave me a bit of insight to how archaic some of the existing banks' infrastructure is. So I thought two things that would be great to do is to, one, give a bit of a highlight as to what that looks like now for some of the existing banks. Like what is their architecture, their software structure, their processes look like? And then a bit of perspective as far as how you see what does that future, what does the future look like from a payments perspective, and also how does that make it much more easier from a global transaction perspective?
Thanks for that. That's a complex question. Every single bank in different countries will have a different architectural setup. But you can imagine there are banks out there that are using technologies from the 70s and 80s still. There are tape drives still being used. So you can imagine
do they have any bunkers that they take them down to?
Like tickets, right? So you can imagine the challenges that one faces when they say from the business unit, how do we enable this new cloud-based digital payment acceptance capability? And then yet you go to their core banking systems, you're like, oh, wow, this doesn't communicate. You need it to communicate by telephone line. So it's a very interesting challenge set. Now that evolved over the years to where banks then owned the hardware, owned the software, developed everything internally, but that was monolithic and it wasn't conducive to innovation and to meeting the market needs. Fast forward, then the cloud came about, then the banks were exploring, well, how do we better utilize our resources in the cloud? So this is where kind of we stepped in and said, well, you know what, bank, that's a massive infrastructure investment, and you're not experts in that area. So let us take hold of that. We will run your bank infrastructure outside of what you're used to. But in the same instance, you have all the intelligence and feedback from your business community, your consumers, about what you need. And then effectively, in the old days, they would say, well, how much is the CapEx going to cost? Yeah. What's the business case? Are we going to do this investment and reach out? We simply say, don't worry, bank, we'll take the CapEx cost. We'll even take the innovation risk because the IP stays with us, but let's share the love. We're going to help you grow revenue, bank. And that's really gotten the banks super excited about de-risking this change, because before these technology update processes might be every 8 years. And then it went every 5 years. Now you're talking about every 3 months. You've got innovations coming out. Banks cannot keep up because it's such a highly regulated environment. So one of the questions I receive a lot is, why don't banks use AI more? Well, the problem with deploying AI within bank systems is because everybody wants to hack in. Everybody wants access to your bank account. They want your funds. So you cannot develop it without understanding the security architecture and how everything impacts the whole ecosystem. We can use AI to assist, but then at the end of the day, our security experts need to go through and ensure that it's impenetrable. And that's the challenges, and that's why banks have moved so slow. So we've been able to bifurcate core banking with modular capabilities, do all the stuff and keep the risk out. But then when it comes into the bank, when real money touches, risk has been removed from the entire technology ecosystem.
So to summarize it, you allowed bank CEOs to promise innovation with no CapEx cost.
Exactly.
Nice.
Exactly. and that's why they love it.
I know, it's perfect. Because I just to be blunt, I know that's actually one of the issues is obviously CEOs are performance managed and their options are tied to profitability. So they'll often not actually go invest in what they need to inside the bank because of that as an issue, because it would actually impact their own outcomes.
Exactly. So, and interestingly enough, the current kind of incumbents, the bosses of the divisions, they're typically usually the blockers to this kind of change. So if you focus on the second tier, the up-and-coming superstar that wants to show change, they typically make the biggest impact because once they come in, they can immediately show, look at this board, I've saved 50% costs on our technology. I've increased the revenue by 200%. Why? Because they partnered with BankStack, right? So that's kind of how we've positioned the solution to banks.
Brilliant. And William, for you, like I remember you did a post on LinkedIn where you sort of introduced this concept of quantum mental analysis. And I was already impressed by what you've done in your background, your experience as far as building, sort of selling companies and then sort of moving into this area. And also just the sort of doing global hotel deals. Just give some insight for investors about how they can think from if they're thinking about alternatives, if they're thinking about sort of generating yield for themselves in sort of hotels, how you blend the sort of quantitative models and also the fundamental insights, when you're sort of assessing opportunities and why that gives you an edge.
Sure. So quantamental, you know what it means is quant, and then fundamental. So the fundamental is who are the operators that I'm working with. So I actually want to second what you said. Like if you're not investing in
I think they're becoming friends really quickly.
Yeah, no, my Indian friend here. No, if you're not investing in India, you need to be investing in India. That said, that's what the data says, right? There's no country as large, it's the largest country in the world, large population, largest land mass, fastest growing
Modi,
country.
king deal maker.
Yeah. I mean, youngest population. It's really a Cambrian moment. It's not just like this is a once in a lifetime sort of thing to be making money in India. That said, operator risk is a very real thing. Like who are you working with in India? You touched on the technology, but I don't think people really comprehend what you mean when you say they have one portal where foreign direct investors are able to come in and actually do the types of procurement that we're familiar with in a country that's so large. It's actually easier to operate in the country there than some of the smaller countries that I think a lot of people are deploying capital. And the interesting thing is a lot of institutions don't touch India. I brought the Indian government over to the city of New York, one of the largest pensions in the US, and the government basically said, look, we're not going to let any of these deals go bad because we have 0 US institutions that are allocating money to our country. So it's $0 going in. We met with CalPERS, City of New York, State of Arizona, all these big pension plans. And I was shocked that the response was, we can't invest in India because we don't have any consultants in India. So even looking at the data and seeing the fundamental operators that they have as a partner, a lot of people are still going to hit their heads in the sand and say, well, it's not something I understand how to do, right? And so when you take a quantum mental approach, yes, you need to have the data, but you need to also understand who are the operators that I'm working with. And if I have strong government partners like Startup India, for example, which is run by the group that does Invest India, Nivruti Sai, the lady that runs that, she was CEO of Intel India for 20 years. And our largest investor, past CEO at Intel, Sanjay Poonen was the COO at VMware. And these are some of our largest investors in the fund. So where other people have a difficult time deploying capital in these regions because of the risks that are there, if you take that data-driven approach and you have a fundamental understanding of the teams that you're working with, you can diversify out a lot of the poor experiences that people have had. So that's sort of the idea behind taking a quantum mental approach as opposed to just doing pure algorithmic trading or just pure relationship based. Oh, this guy's cool. I was introduced to him by someone I like, so I'm going to invest in them. You see.
Brilliant. And Steve, for you, I suppose this is a question just regarding sort of innovation in defense tech. But when you sort of did your research on this as an area, when you were sort of doing a deep dive and thinking about your fund, what did you sort of observe about the role that innovation played in the outcomes of wars and just in the way in which I suppose the world has been shaped?
Well, there's no one more innovative than a young soldier being shot at. So, it does spur a fair bit of activity. I'll give you a more modern example rather than, innovation's moved that far in the almost 3 years since I started. It's almost not worth talking about. In the last couple of months, there's been an amazing revelation around what the Ukrainian government have done around what's called the Brave One portal. Just bear with me 1 second here. But there's a book called the Clue Train Manifesto, released in 1999. It's all about markets are a series of conversations, essentially. And if you're not online talking to your customers, they're talking about you behind your back. So wake up and get online. Very much a 25-year-old tome on business at the time. Well, the Clue Train Manifesto just met war. So the Ukrainian government have basically taken their online portals, they've taken their ability to deliver technology to frontline units fighting the Russian army to a web portal that looks like Amazon Web Services. Western countries get to put their, Western companies, any company gets to put their gear online and units get to buy it in an open marketplace. They get to give it feedback about how it fared in combat through a star rating service. They get to suggest modifications and adaptations back to that same equipment. So all of a sudden, we're in the West, we're doing innovation cycles measured in years, which is down from, decades, to be quite blunt. You're now getting basically weeks between innovation cycles. So this whole online business that you're getting, that you're closing the feedback loop, you're getting the whole hyperlinking. In the Clue Train Manifesto, they talk about that mass media has been defeated by hyperlinking, essentially. So you're seeing that now in combat. So it's coming full circle. And I find that just fascinating. I'm trying to write an article on it. I'm trying to wrap my brain around it, to be honest, because you are now seeing you're seeing common innovations in the Ukrainian side, for example, where they used to create some whiz-bang new thing, probably a drone variant. They used to test it on a certain part of the front line. The Russians learnt that fast, they'd adapt across the rest of the front line. So now when they get a combat innovation, they wait to deploy across their entire front, then launch it. So now they've got 7 to 10 days before that's been counted. Now that's mad. We as Western nations are still releasing tenders measured in years to get combat innovation. Please talk to your federal members. That's crazy, but like I said, there's no one more innovative out there than someone being shot at.
How's something like like Anduril's, I suppose, the example where their founder went from being the outcast of Silicon Valley to now, a respected sort of voice, on defense tech, and just going from a startup to a multi-billion-dollar company, winning government contracts, and also displacing some of the existing sort of suppliers, to defense. How has someone like them sort of helped create, I suppose, the new era of sort of startups in defense tech?
Oh, they've done well. They're not the first. So I think the first would have been Palantir, to be honest. I mean, all the pioneers who took the arrows were Palantir, probably SpaceX. Then you had Anduril, is probably the more recent one. That there are others out there as well. So and they've pretty much. They know Anduril especially have brought a Silicon Valley approach into defence capability and services and products and defence are called capability. It's a stupid term. That's what they use. In that they've built products first. They have found the demand. They've then built the product and then tried to sell it in, as opposed to convincing the government they need to release a tender to get to this process. So they've end run that. So it's a lot shorter there. Andrew now built everything from border post sentry monitoring devices through to missiles, drones, underwater torpedoes, basically small aircraft, the whole thing. And they're doing this at the speed of Silicon Valley. I feel Raytheon and Northrop, they're on the block. So, because things are about to change.
And
I mean, the Ukrainians defeated the entire Russian Black Sea fleet without possessing a single boat larger than probably a Manly ferry. Probably not even that size. Probably the lifeboat of a Manly ferry, to be honest. So they're all unmanned, automated boats, very cheap, lots of them. They only work 85% of the time, but they cost 100th as much. So there's 100 times as many of them. So we're not learning. And the opportunity for investors is the fact that we've got to replace all these big, expensive toys the military was buying with the cheaper, more plentiful, more commoditized, software-driven to a large degree tools out there. They only work 85% of the time, not 93% of the time, but they literally a 20th to 100th of the cost. And that's the new equation. It's cheap, it's lots, it's mass. It's called a treatable mass. You don't mind losing the things that only cost you 100 to the other thing. So you just send 100 times as many.
I remember one of the stories during the Iraq War where Halliburton, if they had a truck that blew a tire on a trip, they would literally just leave the truck.
Well, that's just Americans in general. I mean, you want to see people flagrant with capital, just go to an American military base. Holy shit. Excuse me. So, no, that's just not Halliburton. That's just Yanks.
So over to you, Akshay. Just a question. For investors, sort of used to Western markets and, I suppose used to our sort of, what is some of the nuances when it comes to Indian, to sort of dealing in India and sort of Indian VC and just the sort of startup ecosystem?
Look, it depends on where you're investing. I think there's, even within the VC, I think there's a distinction between early stage and growth. So I'll address the early stage. So if you're planning to invest in, a seed stage ideas, then I think the first component is cultural, because a lot of the entrepreneurs in India, they're not looking to buy a penthouse in Mumbai. They want to create jobs. It's more about they have a socialist bent of mind, and that's just a cultural thing. So whenever you engage with them, that kind of tone is a little bit different. The second thing is sourcing is really hard because, as I said, the system that is now in place, which I believe is the third iteration of the VC industry, so there's been a maturation of the founders themselves. They've exited multiple businesses. So if you're trying to source deals, then there's already a queue of people who are waiting to kind of invest. The third thing is that entrepreneurs already understand that capital is commoditized because capital is freely available. I think the other thing is that what sort of adjacencies are you able to bring to the table? So they are beginning to ask these sorts of questions. So if you're planning to invest, then you should be able to answer those questions. With respect to the growth side, again, there's a lot of opportunities for secondary funds right now to provide liquidity, because this is the first time in the history, I believe, the whole end-to-end VC ecosystem is available, right from early stage to growth to pre-IPO, private equity, and also onto listing. So I believe there's a nice sort of secondary market, and we already have the likes of Hamilton Lanes and so forth who are sort of playing in that space right now. I think that if you want to invest in growth stage, and you're looking for co-investment, as long as it is a positive selection criteria, good for you. But if you're just trying to deploy capital at a lower cost base, then that's not necessarily a positive. It is a neutral selection criteria. Yes, you want to deploy capital at a fairly lower cost, but just so that you're able to identify the right opportunities and you're getting the right kind of return profile. So those should be sort of your governing decisions as you're trying to invest in these stages.
Fantastic. Now, we're almost out of time, so I always love to finish with this as a final question. This is for each of you to answer. Start with you, Damien. I'd just love to understand your perspective on how you see your own thesis for how you see the various spaces that you're involved in playing out over the next 5 years. And I ask that from the investor's perspective, sitting in the room, that if you want to leave something in their brain as to how to think about things in the next 5 years for the space that you're focused on, what should they be looking at?
Well, certainly in real estate, the revolution to online ordering and deliveries, I think we're still in the early phases of it, and we're a long way behind the US. They are already at 22% of all product retailers now home delivered, and that's getting now, they're expecting it to get to 35-40%. So Amazon and bringing in same-day delivery around Australia, that's been commonplace in the US now for 6-7 years. So the thesis on industrial and logistics is still there. There's still very strong demand for that type of property. And the other one is the neighbourhood centre, though. The neighbourhood centre and the large format retail centres, they've all discovered that that sounds very good to have a warehouse out in suburban Sydney, but it's a long way to go from there right up to the North Shore and the congestion. So it dovetailed in with logistics and bigger sheds is also the fact that the neighbourhood shopping centre, like the supermarkets, that's where you're always going to get your groceries from. And you're going to click and collect is what they want. Same with the large format retail. They're very low cost. The percentage of turnover is quite low because you've basically got a retail centre, open car parking. People can come right up to the door. I think the days of going to big shopping malls is going to continue to decline. They're trying to get people in there with entertainment and so forth. But I think long run, they're on the nose and they're going to be very expensive to run. So the model of retail is changing. A lot more home delivery. but also for the retailers who are using their large format retail and neighbourhood centres as their distribution centres. We're not in the office space. There will be a time to come in the office space, but I still think the work from home, the downsizing effectively of office sizes, people realising they can do maybe 200 people in a 150 office desk just because people are working from home. I still think that's got time to work through. We would buy a really good deal office, but I still think if it had a longer lease, that would get us through the next 3 to 4 years of pain. But I still think the office sector is got some pain to go through.
This may be out of your wheelhouse, but do you factor in anything around sort of autonomous cyber taxis or robo taxis as far as you're thinking yet?
Yeah, look, they've got them in the US. I know when I was in the US last year, the guy gets, I've forgotten the name of the company, but he gets a driverless car to the airport when he goes travelling. So look, yeah, that's definitely going to make distribution more easy, but at the same time, I guess there's a lot of regulatory hurdles to get through that. To get that into even in the US, it's only in some locations. In the long run, yes, we will start to see more of that autonomous distribution. It's actually not necessarily the truck driving up, it's how do they get it out of the truck or out of the van. And that's the hard part for them. It's like when I went and did a tour of our Amazon facility, the internal packaging was unbelievable, but it was still manually getting the goods off the truck at one end, putting on the conveyor system to distribute it, and then they were repacking at the other end with manual labour. So there are still some things to get through before we will have completely autonomous home delivery.
I'm sure Elon's working on that with Optimus. And you, Evan?
With my investor hat on, where do I see payments and technology going in the next few years? Payment infrastructure will always be a thing. However, the interaction from the consumer and businesses and banks, that is what will evolve. So how you guys are using your phones and your wallets and your credit cards today, in 5 years' time, you're just going to pick up your assistant. Hey, Sam, book me a flight to the Philippines. I want a hotel at the Hilton. And by the way, reserve me a dinner at a 4-star Michelin restaurant and get me a taxi, please. Agentic AI comes in, does that whole process for you, takes care of the payments in the background. You get your itinerary sent to you. Boom, it's done. So the interaction, the payments function will always still be there, but the interaction is what enhances. So what we're ensuring is that we're building a robust infrastructure that will last the ages, and that ensures that, and the reason why it lasts the ages is because security will be robust, but the interaction within that ecosystem is what will effectively push and help banks transition towards.
Brilliant.
Yeah, I think, I'll push that even further. I think AI will actually, it'll tell you you're going to the Philippines and you're going to stay at this hotel because it knows what you're going to like, right? You're not even have to do that. I think private markets in general, not just hospitality, but everything up here, I made the majority of my cess was public markets. So we use a Bloomberg terminal. Yeah. I think that the public markets are entering like this Bloomberg era where instead of paying for a lot of external data that's unstructured and not really being able to make actionable decisions on it, every manager up here in the next couple of years is going to have something similar to what we shared earlier, which is a terminal that is allowing them to make data-driven decisions with some level of statistical significance, right? Because with what's happening in the AI space, you can take a lot of unstructured data and you can take a lot of structured data and you can take a lot of macro and micro data and you can start making actual decisions with a certain level of certainty and clarity that you just couldn't do, 2 or 3 years ago. So I think that, the type of public data that we have to make decisions is going to sort of proliferate into the private markets.
And so that's one perspective on how you'd make decisions as a manager. What would you think if you're thinking about sort of how you envision changes in the hospitality area over the next 3 to 5 years? Like I've started to notice, going to some hotels, there's no one to, you do self-check-in, as an example. What are some of the other trends that sort of been observed that you're likely to see play out across the next 3 to 5 years globally?
Yeah. So it's payments. OTAs at the moment take a lot of money. So the Booking.coms, the Expedias.coms, Priceline, all of that. There was just a recent ruling past a couple of days ago where Europe said that they have to stop charging the hotel operators so much. I think OTAs are ripe for disruption. I also think that the rewards for hotels are ripe for disruption. We haven't seen it happen yet, but I think with a lot of the like decentralization that's out there and the ability for someone to decide how they're going to disrupt this rewards program, I think that'd be interesting. One of the gentlemen that we brought out here, Tommy, I wish he was in here right now. I'd actually let him answer it. But he's working with a group out of China that have 100 million members in their rewards program. It's like mind-boggling, like how many members do they have, and they have 500 keys, but it's all isolated in China, right? So again, I think what organizations like this are doing is saying, how can I diversify out of a region that I'm in? How can I take advantage of this massive, membership base that I have, and how can I do that in a very efficient manner? And again, I think with AI, you can get some very unique approaches to solving for this. And as I mentioned, it's this sort of the world is your oyster if your platform is large enough to take on the risk of going into a new market and looking at the incentives that are in place to de-risk leaving sort of your home country where you've made the majority of your money. And most of these operators that are doing that are going asset light. So they're not putting a lot of capital in on the front end. They're just paying to operate the asset that's already there to test the brand in these new markets to see, does it make sense to continue to expand? So that's typically what you see.
I was going to say one other one I noticed is that I stay at like a Citizen M hotel in.
Yeah, they just sold to Marriott.
Yeah, and it's super interesting how they're actually like they've effectively turned the sort of lobby area into a co-working space,
right.
And they have memberships for people because they realize a lot of their people sort of come in from out of town. They spend 1 to 2 days a week at work, so they'll stay overnight. So they've converted that in there. And I found that really interesting, right? Converting what was typically a hotel also into, office revenue effectively and, and obviously food and beverage with that.
Yeah, and I think consolidation's a real thing. Like Citizen M sold, they have 35 hotels. When Aloft sold to Marriott also, they only have 14 hotels. When Dream Hotel sold to Hyatt, they also only had like about 10 hotels at the time. Graduate Hotels just sold to, so there's going to be a lot of consolidation happening in the space. And again, our desire is to get into those organizations before they take a larger exit and show them a compelling reason why they should take said, capital from us.
Great. And Steve, you?
My thoughts are far less deep and far darker. Well, we live in a world where our region's biggest tyrant's promised he's going to invade a small island democracy of 27 million people by 2027. It's a pretty unfortunate world, right? So I struggle to find. I look through. I'm a hammer and everything's a nail. I look through the military lens. And in since February 2022, estimates are between 4 and 10,000 Russian tanks have been destroyed with things you can buy from Dick Smith. All right, Russia now has no tank made after 1987 left in its inventory from things we made from Dick Smith. When you think about that innovation cycle, how fast that goes, and I mentioned before when I was talking up on stage about the confounding factor of AI for being an investor. If you're improving business outcomes at 6% a month or 12% a month, that's a lot of change in that cycle, and so you can be really, really confident with your capital where you're going to put it at that point in time. All I know is in the next 5 years, we're going from $1.7 trillion in the allied world to probably $3.5 trillion in the allied world, and I want to sell before it tips over the top. I'm out to make money for investors, and the defence asset class is the way to do it.
Thanks, Steve. And Akshay, final comments from you. Next 5 years, Indian VC market hitting 2030 and their ambitions. How do you see? What do you see as your world lens?
I think I'll just say two objectives that I would love for us to achieve, the firm. One is that I would love for Australian wealth to benefit disproportionately from India's growth, competing against all the other sort of sovereign funds and countries that are already investing. So I think that's one thing, because right now, Australian wealth is very underrepresented in Indian innovation, and it really breaks my heart. And as an Indian immigrant, it kind of changes the weight of the debate for me. I have a child who's born here. She's an Australian, so that really gets me thinking and gives you a sense of what motivates me. The other thing is, it's a two-way street. If there's something that we can do to really make it a strong economic corridor between Australia and India, so have Australian capital acquire assets over here in Australia or transfer of technology between both countries. And if we have done some small part to contribute to that seamless exchange of information and capital, I think I would be a really, really happy man in 5 years.
And I'll just add to that, I've been surprised about how many Australian founders are actually building businesses in India. Well, they're founders here, but they've actually got significant teams in India and all their operations are in India, but they're founders here, firstly. Secondly, I've been surprised how many Indian investment groups have, and it's not your sort of typical VC, but how much Indian investment has gone into Australian startups. One of the areas that comes to mind is sort of medical device, specifically like in the heart area. That's been interesting for me to discover. Because I don't think people would know a lot about this, as a connection. And it's good to see Irfan here. I know he's done a lot of work between building that bridge, between Australia and India. And obviously we're super excited to partner with you to actually help, escalate that as an opportunity and provide that pathway. And then likewise from your side, I love that you sort of think about it like that. So, ladies and gentlemen, we have successfully navigated the Alternative Investment Trends panel. As I said, we combined Indian VC investments, industrial property, fintech, hospitality, and defense tech all in one panel session. So that concludes. Please give a round of applause for the panelists. And on that note, we conclude Private Capital 2025. I'd love to say a big thank you to all of you that came today. Today's been a big day. Once again, I just want to say a big thank you to the Wholesale Investor team. I started that saying today, we have done a hell of a lot in this last month. I know most of you may have seen us at Emergence last year, but to pull off 3 different conferences between London, Dubai, then here, and also a 2-day workshop over the weekend, and also an office move, miraculous feat for a small team. So thank you to the WI team. Ladies and gentlemen, enjoy your afternoon.